types of financing, 100% theory chapter. Okay, so from business point of view, all the financial requirements can be classified into three varieties: long term, medium term, and short term. We all know long term and short term. Medium term is more used in practical world than in classroom. Most of the time in classroom you have only two things: less than 1 year, more than 1 year. So these medium term loans are for 3 to 5 years is what book says. 1 to 2 years, or rather less than 1 year in accounting, is for short term purpose, and anything more than that is for long term purpose. One fundamental lesson that every company should keep in mind, you should also know, if I am taking money for long term period, say 5 years loan, 8 years loan, then that long term fund should be used for long term asset creation. That is, I am purchasing a house in a housing loan. The house has 40 years life. Then if loan is also for 25-30 years, it's not a mistake, because both are long term assets. One is long term asset, one is long term liability. Both are for long term period. The mistake some companies do is they take a loan which is to be repaid in 5 years and use that money for their day-to-day salary, rent, and other expenses. When your duration of the liability is long term, the use of that should also be for long term purpose. Even reverse is wrong. Taking a loan which is to be repaid in 1 year and purchasing a site in that, because you're using a short term liability to create a long term asset. One of the mistakes, not the only one of the mistakes that Cafe Coffee Day was this: using long term money for day to day purpose and using short term money for long term purpose. Just think about it. This is not exactly Cafe Coffee Day. For your learning purpose, I'm explaining this to you. Suppose Cafe Coffee Day takes a short term loan, say repayable in 1 year, uses that money, goes far away from the city in a highway. They built one new Cafe Coffee Day unit. Now what happens? You have created a liability which is to be closed within 1 year. But using that money, you created an asset which will give you money in 5, 8, 10, 15 years. First year when you open a new Cafe Coffee Day unit, that too in a highway, people won't come to you. People don't even know that you are there. And those who are driving that way, first time they will see, okay, there is a Cafe Coffee Day. But they have already crossed that point now. So they will come to you maybe next time, because first time they did not even know. And it's not easy. There are already other dhabas and hotels and this and that in that area. So it is difficult to gain business in first 6 months to 1 year. You will start getting, but that will take 2 years, 3 years time. But the problem is the liability that you have created, the loan has to be closed within 1 year. One of the issues that created the financial mess in Cafe Coffee Day was something similar to this. They took a lot of money to be repayable in short term, but used it for creating long-term asset. Now Cafe Coffee Day building a new setup is all that furniture, the AC and all of that. That's not going to give you return within 3 months or 6 months. That's a fixed asset, like classroom, correct? You buy bench and this and that. You can't expect full money to be recovered in first 6 months itself. Basic thing that we should know. That's the point given here. Read the basic principle for meeting short-term financial needs of a concern is that such needs should be met from short-term sources, and medium-term needs should be met from medium sources. And if the need is for long-term purpose, your source should also be a long-term source. First one, long-term. In that, from company's point of view, either you can issue shares, equity and preference, or you can go for debt, which includes debentures, bank loans, and other debt instruments such as bonds. Everything is debt. In that, first discussion is on owner's capital. Easy to understand. Underline this: permanent capital, underline real owners, underline entitled to dividend after income claims of others. In the event of underline winding up, again after claim of others are met. Last one, cost of that is normally high. If they ask you to write a short note on equity share capital, these are the points to be covered. One, permanent capital. Why? Because there's no need to repay money. There's no EMI concept in an equity share. Second, they are the owners of the company. By saying owners of the company, you told them what? If you are If we are in loss, you also suffer. Right? You're not like debenture holders that even in my loss, I'll have to pay you interest. Third, they will get dividend only after you pay interest and preference dividend, taxes, and finally, these people may get, may not get also. Fourth one, when you close your business, winding up, what happens when you wind up the business? Again, you sell all your assets, pay to everyone else. If something is left out, then only equity shareholders will get money. Last one is cost of share is high. Now, why is cost high? Because the rate of return expected by equity shareholder is high. If I am the company and you are the investor, for you it is investment, for me it is source of capital. You take highest risk, therefore you expect high return. Rate of return to you is cost of equity to me, correct? In cost of capital, when you discuss cost of debt, cost of preference, and cost of equity, equity is normally high because out of these three people, equity shareholders take the maximum risk. Whoever is taking maximum risk will expect maximum return. Basic thumb rule in the entire financial management. Now, the same thing in exam, if they ask you, right, advantages and challenges, whatever we discussed now, some were good points and some were challenges or bad points. Read this. Permanent source, it increases the financial base. What is increasing financial base? Too many people will be part of your company. Tomorrow, if you want to expand, almost everybody knows about it. Think about it. Today, if a company like Infosys wants more money, it is easy for them to get because they already have so many shareholders from all these years. Right? Once you are known to a lot of people, equity people, it becomes easy for you to expand. If you want to issue additional shares, there are people waiting to buy because your company already has lakhs and crores of shareholders. Company is not obliged legally to pay anything. So at the end of the year, even if you are in profit, you don't have to mandatorily pay anything. Company can make further issue by making a right issue. Anyone knows what is a right issue? Underline. If you do not know, make a note there. Suppose you are all my existing shareholders. Now I want to issue fresh shares. I directly cannot go to public. I should first give offer to you. You have a right. Okay. If you don't want, then I will go to public. I repeat, I am the company director. You're all my shareholders. I wanted to issue fresh 100 shares. I can't directly go to public and issue. I should first give you an offer. If you take it, I have to give you the shares. If you don't want, then only I can go to outsiders. So normally I give you that right. That's why it's called right issue. I'll give you the right to purchase. If you don't exercise the right, I'll give you 30 days time. Within that you have to decide. If you don't want to take it, then I will go to general public. What happens if a company is really doing good? Whenever they come with right issue, their existing shareholders will happily buy because they're anyway happy. And this right issue price will normally be slightly less than the ongoing market price. If in market price is say 78 rupee, for existing shareholders, I will first give them an offer 71 rupee. Because you're already my shareholder, you should get some benefit compared to others. If you don't buy during that 30 days right period, if you don't exercise your right, that right will be lapsed. And once that is lapsed, then I can go to general public. Then I will issue it at market price itself. Why should I give discount to a stranger? Yeah. So what happens to a company if they already have 2 lakh equity shareholders and then they want 10,000 more? Out of 2 lakh, any 10,000 can pick up one share also. You don't have to go to public. Becomes much easier. Yeah. This side, challenges. One is it's costly. Why it's costly? Because they expect more return. Second, from investors' point of view, if you think it's very risky. Third one, excessive issue of shares will reduce the EPS. What happens if you keep issuing shares after shares after shares? When you do EPS calculation, denominator, number of equity shares will go up. And whenever number of equity shares go up, your earning per share will come down. Just basic maths, 100 by 10 versus 100 by 20, 100 by 30. As you keep increasing denominator, and if your earning is not going up, earning per share will come down. So shares are good, but too many shares will not create wealth to the shareholders. Another problem is it will dilute the ownership, because earlier it was just 100 people as owners. Now there are 200 people, 300 people, 800 people, 10,000 people, the original 100 will start feeling powerless because now there are so many additional people also. It's just like converting a sole proprietorship into a partnership firm. I was alone. I was having all the powers. Now I have a partner. Now anything I have to do, I have to discuss with her and decide. Now if I add her also as partner, now there are three people. Now if two of them disagree, I can't do anything. So I feel my ownership is getting diluted because now two is majority over me. If you add one more person as partner, now four people, they three can do meeting also. They don't even need me because 75% attendance they have, then why will they even worry or wait for me to be part of the meeting? Therefore, as I keep adding owners in partnership firm, partners in company, shareholders, you keep adding the owners, every owner will start feeling that his ownership is getting diluted. It's like me having one share of Wipro. If I don't go to AGM hall also, nothing matters. AGM will still happen. People will take decision. Resolution will get passed. But if I'm a sole proprietor in my business, and then if I don't go to my own office, it matters. Correct? So that is called power ownership that gets diluted. Second source is preference. These are special kind because they get slight priority over equity shareholders. Priority in what sense? One, every year they get some fixed amount in the form of dividend, and also repayment of capital when you wind up the company. Simple thing to understand: whenever you close a company, all assets will be sold. It becomes cash in hand, cash at bank. Then you pay to liabilities. Then shareholders. In that, priority is given to preference shareholders. Last of last is equity. Easy to remember. These are also long-term funds. Underline, these shares are cumulative in nature. What is the meaning of a cumulative share? In simple, what is the meaning of a cumulative share? If you are not able to pay dividend in this year, correct, it will be carried to next year, and next year not only that year's money, even the previous year's money I'll have to pay. When nothing is given in the question, we can assume that all preference shares are cumulative in nature. That means I can delay the payment, but at some point I'll have to pay. Yeah, not like equity shareholder that forever I can say I'll pay, I'll try, I will try cannot happen forever. Yes. The rate of dividend on preference share is slightly higher than rate of interest on debenture. Is it correct if I write like this? Debenture, preference and equity in terms of the risk and return expectation. Lowest risk is taken by debenture holder because even if company is in loss, they will get their interest. Therefore, the rate of expectation will also be very low. Equity shareholders have highest risk and therefore their expectation will also be very, very high. These guys are in between, slightly more than debenture, but less than equity. Most of the preference shares today carry a stipulated period and the funds have to be redeemed or repaid. So it is not like equity share. If somebody purchases a preference share, the principal has to be repaid. Please understand the difference. If you take bank loan, you have to repay principal on monthly basis, EMI. If it is debenture, you have to redeem the money. If it is preference share, you have to redeem the money. Maybe 3 years, maybe 5 years, maybe 10 years. That will be mentioned on the certificate. But then it cannot be forever. It cannot be an indefinite period of time. In case of equity, there is no such period written. Company is not obliged to even repay the principal. Forget about when to pay. Should they pay also? Answer is no. When is the second question. Yeah. Number one, preference shareholder money has to be repaid. Second, has to be repaid within stipulated period. That will be on the certificate itself. Preference share is underlined hybrid form of financing. Why is it called hybrid form? Because it has one feature of debt and one feature of equity. Tell me what is the common feature with debt and preference? Debt and preference. The rate of return is fixed. What is the common thing between preference and equity? If we don't have enough money this year, we can postpone the payment to next year. Correct? Whether preference or equity, both are called shareholders. Correct? So shareholder is a owner. Equity, preference are actually similar. Preference people are first in the queue. That's it. Everybody is in the queue. Everyone has some level of uncertainty. Right? As I told you, some features of debt and some features of equity. Some advantages: no dilution of EPS. Tell me why no dilution of EPS? Because they are not going to be in the denominator of EPS calculation, right? Second, there is leveraging advantage as it bears a fixed charge. What is this leveraging advantage? How much ever we earn, we are not going to pay anything more to preference shareholders. If you are a preference shareholder in my company, you have invested 100 rupee. I have promised you 9% dividend. 9% won't change. My company may be making 78% profits, but I am not going to give you anything more than 9%. In a way, you are similar to debt. But equity, they may get double the money also, triple the money also. They may get dividend, annual dividend in between called interim dividend. All of that can happen with equity. None of that will happen to preference shareholders. In a way, from company's angle, we know we have taken 100 from them, we will pay them 9 rupees. Next, there is no risk of takeover. Why no risk of takeover? Because these people are not as powerful as equity shareholders. Once you start learning company law, you'll get to know. In company law, there are specific rights which are given only to equity people. Those rights are not there for debentures. Those rights are not there for preference shareholders also. Some are exclusive rights given only to equity shareholder. It's not very common in India, but in US, there is this headache also. You will study this in company law. I'll just give you a brief in 2 minutes. If more than 75% of shareholders decide, they can even remove director of the company. Okay? They can remove auditor of the company. By the way, they will only appoint the auditor. And within few months, if they think, no, we should remove the auditor, they can remove the auditor appointed by them. And if 75% agree, then they can even remove the director. This is not very common in India. 75 of them saying okay to remove. But in US, this is quite a common thing. Many times there is something called AGM, which happens once in a year, annual general meeting. There is something called EGM, extraordinary general meeting. That is called whenever such emergency situation comes up. In the mid of the year, now February month, you want to remove one director. Now you can't wait for AGM to happen. For AGM, the date is far away. So you can call for EGM, and if 75% or more than that number, if they agree, then you can remove your company's director and appoint a fresh director. These powers are given to equity because ultimately it is their money, it is their business. They are the real owners. But in India, you will not see this happening much. It is more of theory as of now. But in reality, do they have this power? Answer is yes. Yeah. You would have hardly come across a news like this in India that all shareholders did one meeting and removed their own director. But they have powers. Once you attend company law class, you will get to know. They can remove auditor, they can remove director, they can bring in new person. That person also they can remove. It's not that only if they appoint, they can remove. Even if board of directors appoint, shareholders can remove. Ultimately, it is shareholders company, not directors company, right? There is something called board meeting, the meeting done by directors. With respect to dividend, directors can have a discussion and propose that. Ultimately, accepting or rejecting power is with equity shareholders. This has happened many times that board gives a proposal and shareholders reject. But it is very rare in India that shareholders decide and remove a director itself. If that happens, then imagine the goodwill of that company and the share price if it's a listed company. Now, why will anybody remove director? Must be something seriously wrong in that company. Therefore, people in India somehow try to not get into this mode that if a director is not doing well, then other directors, they themselves ask that person to resign or something like that. But in some other countries, this is quite a common thing and dangerous also. Then you will stop trusting any company because you'll get this doubt. What if this director is also a cheat like the other guy and this and that? Yeah. Something like this happened when Satyam problem came up in 2007-8. Everyone started doubting tech companies. They thought, what if our company is also like Satyam? You understand, being a shareholder, it's a common doubt. And Satyam was not in a mess, by the way. That Satyam company's director had a very good reputation. So when someone had such good reputation can do all of this, then people started doubting every other guy. Imagine if I was a shareholder of Infosys that time and not Satyam. Then also for a minute, at least the thought would have come to my mind, what if my company books are also fake like Satyam? Because my director also was talking good all these days. And by the way, that person, the director of Satyam, he was also a CA. Okay, his name is Ramalinga Raju. And he knew exactly how CA is going to check the books. So while doing fraud, he did such frauds where he can't be caught. Because you know how they are going to do the audit, correct? It's like a police doing a crime. Because you know how investigation is going to be. So you can escape in a very smart. He made sure almost many 3-4 years auditors could not find out that books are not true. It's all fake things. Then even auditors got to know. They got a doubt. They started investigating. They got to know. And then I think he gave them also some money. Even they joined him. Now, if director and auditor both join, how will anybody get to know what is happening inside the company? After almost 7 years of this, the matter came out. That means 7 balance sheets and P&L signed before that were all fake numbers. Okay, I am sure very soon one more. It's a good subject for web series. I don't know why no one has picked it up yet. 1992 scam series is done. Even Karim Lala Telugu's scam came as a web series. The stamp Telugu scam, if you guys know. But I think Satyam is a good topic. I think very soon this will come as a good web series. And that time people lost trust in stock market. And that person, Ramalinga Raju, he was given a lot of awards by many big organizations as an iconic business leader. Just 1 year before this, I myself have watched on CNBC TV 18. He got the award, Best Business Icon of 2007. 6 months after that, this scam came out. Okay. Therefore, when something like this happens, the problem is not only shareholders of that company lost money, the other shareholders who are of other companies also, they lost trust on audit, on balance sheet, on AGM. They thought all of this is just drama. 7 years somebody was doing, and that too Satyam was not a small company. Today you guys don't know that name. It's taken over by Tech Mahindra now. But that time when all this happened, it was quite a big company, as big as Accenture or Infosys, TCS, Wipro today. That was one of the leading companies. When that itself can go through all this, then people started doubting. Then they started doubting all the balance sheets signed by those auditors. If you can do fraud in one books, maybe you have done in other places also. Now that created some trouble in stock market for a couple of months, almost a year. People were not ready to invest in IT stocks itself because they started doubting all software companies. This is what happens. That is when the 75% shareholders can come and call one meeting, remove the director. So these are only extraordinary things in India. Though book says shareholders have too much power, in reality, it's a very rare scenario that shareholders meet and remove a director. Okay, you should know theoretically they have power, but practically very less. The preference dividends are fixed and pre-decided. In a way, gives you peace of mind. You don't have to worry how much they are expecting. 9% is what they are expecting because 9% is what you have promised. The problem with equity shareholders, how much ever you pay them, their expectation is higher because they compare your company with other company. They think they have taken so much risk. If Ultratech Cement pays 23% dividend, they'll compare with ACC Cement. And you match ACC Cement, they'll compare with India Cements. So there is no end because they think all other cement companies are giving good returns. Only my company is not giving. My company is more risky. Cement industry is in difficulty and I have taken so much risk. And share prices have fallen for almost 1-2 years. I stayed in this company. Then also I'm not getting any amount you give, shareholders will be unhappy. There were incidents like this. Friday after the stock market close, 3:30 after that, Reliance came with their quarterly results. And there was a quarter, I still remember last year, profit went up by 87%. Last year quarter, this quarter, 87% up. I thought Monday morning, this share will go up like crazy. Then Monday morning when market opened, share was down by 2-3%. Why? Shareholders were expecting 95% jump. Not happy with 87%. Yeah. So there is no upper number as to how much will keep them happy. You give them 7 rupee dividend, next year they expect 8. You give 8, they expect 9. 1 year you go back to 7.5, they are unhappy. This is the problem with equity shareholder. Whereas debentures, bank loans, bonds, and even preference shareholder, we have a fixed commitment, but beyond that, they will not ask anything more. In a way, peaceful. We don't have to worry about whether they are happy or not. Yeah. Disadvantage, there is no tax saving. Why no tax saving? From earning before interest and tax, you first pay interest, then EBT, you pay taxes. That means if you pay interest, you save taxes. But after that, when you pay preference dividend, you will not be saving any taxes. So there is no tax saving because of preference capital. These are cumulative in nature. Therefore, if you don't have money now, okay, you can postpone to next year. But understand, next year your trouble will be bigger. Imagine 100 rupee, preference dividend is 9 rupee. This year you could not pay. Next year you have to pay 9 plus 9, 18. And if you don't have enough money and you have paid only 4, now out of 18, if you pay 4, 14 is still outstanding. Next to next year, it will be that year 9 plus old 14. So, though it gives you that time flexibility that you can postpone and pay, someday you have to pay. If not now, someday there is a pain of paying 23 rupee. You can only delay, as I said, but you will have to pay. I am not getting into company law, but just giving you a brief. In company law class, you will study. If you delay preference shareholders dividend beyond 2-3 years, they will start getting additional powers. Okay, they do not have all the powers that equity people have. I already told you. But if you keep delaying beyond 2-3 years, then one by one power that equity people have, that will get added to preference shareholders. So it is not that forever I keep saying next year and next year and next year. Then they will almost become like equity shareholder. What happens when they become equity shareholders? I told you, they can remove director itself. More owners, correct? Therefore, delaying is okay, but forever delaying is not okay. In company law, you will study why I said 2 years. It's part of company law discussion. As of now, understand, we can delay, but too much is not good. Preference shares can be of these many varieties: cumulative, non-cumulative. You know already what is cumulative. You can pay outstanding money next year. Non-cumulative is if I pay now, take it. If I don't pay, don't ask next year. But this is theoretical. In real world, nobody will be like this. Then that guy will say, then I'll become equity shareholder. If I am taking so much of risk, why should I be a preference shareholder? Make me also equity shareholder. Redeemable. There is nothing called irredeemable. Money has to be repaid. The time duration will be mentioned on the certificate. 7 years, 10 years, 12 years will be there. Participating and non-participating. This participating is slightly dangerous. In classroom we can discuss, but reality, this is not possible. See what I'm writing. From EBIT, we pay interest and we have EBT, and say we pay 20 rupee tax. Observe here, EAT is 70, earning after tax. In this I have to pay preference dividend. Suppose it is 10 rupee. This I have paid. Now this is 60 earning available to equity shareholders. In this, we pay their dividend of say 25 rupee. Now from 60, if you take out 25, 35 is still left out. In that, company can decide that we will transfer 5 rupee to reserve. This 30 we will pay to preference shareholders. This is why I told you this is more of theoretical. Read what is the name given: participating. And next one is non-participating. What is participating? First they will get their money, and then we pay equity dividend. Then we keep some reserve. If some money is still left out, they can participate in this extra 30. Right? Now tell me why I said this is more theoretical and not practical. Why will equity shareholders agree for this? They will say, extra money, you give it to us. Anyway, these guys will always take 10. Correct? And these guys are ahead in the queue. Therefore, equity shareholders, anyway, they don't like preference people, because they are always taking money before we take the money. Therefore, theoretically, This is participating, non-participating. In reality, it is always non-participating. This 30 cannot be given to preference shareholders. Convertible, you give them an option that I will convert you as an equity shareholder after X number of years. Can be 2, 3, 5, 10. That will also be mentioned on the certificate. Next, reserves and surplus. After equity and preference, third discussion is reserves and surplus. The easiest, the simplest, and the most convenient way of funding your company. If you have your own money, why to issue even equity shares? Tell me, reserve belongs to equity. Equity shares also belong to equity. Now, if I am in need of 5 lakh rupee, if I use reserve, at least number of shares won't change. But if I issue shares, then number of shares will increase. And if number of shares go up, my EPS will come down. Though capital and reserve both belongs to them, it is better to use reserve than using capital. Always remember this. No company which is already sitting with good amount of reserve will go for fresh issue of shares. If I do not have reserve, then only I will think of issuing shares. If I have my own reserve in my pocket, why will I ask somebody for money? Use my own money. I don't have to worry about asking anyone. What if reserves are not there? Then I think of whether to go for debentures or preference or equity. Otherwise, the reserve is always and always the first choice. Underline this, they call it as plowing back. It is plowing back. We have made some profit, we reuse the money, recycling or plowing back of profit. Okay, who is the owner of reserves and surplus? Preference or equity? Only equity shareholder. It is their money. Correct. Such funds belong to ordinary share. Ordinary means equity share, and it increases the net worth of the company. If you remember, net worth is equal to share capital plus reserve. The more and more reserve you create, your value, net worth will go up. A public limited company must use some amount of profit every year, keeping in view the legal requirement in this regard and also for its own expansion plan. That means no company should ever pay 100% dividend. It's always better to create some reserve and reuse the reserve. Reserve in my and your case, whatever we earn minus what we spend, what extra we have is our reserve. That reserve, what do? We reinvest. If we don't even keep reserve, where is the question of reinvestment? Whatever we earn, we are spending entire money. No question of reserve itself. And tomorrow, if I lose my job and if I don't even have reserve, how will I survive? Did you notice whenever a bad news comes in stock market, all companies will fall? Top 50 companies fall less. Mid caps will fall more. Small caps will fall highest. Let's put some percentages. 2% down, top 50 companies. Then mid cap will fall like this. Then the smallest companies will fall 4%. Any bad news? Common bad news, say war. Now, when war is happening, it's a bad news to everybody. But big companies won't fall much. Okay, 3 months later, war problem is sorted. Now, this stock should come back to where it was. These stocks will come back also very fast. These will take more time. These will take very, 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 very long time. Please understand, because these are small companies. You know what is one difference between all the three? These guys have so much of reserves with them. Not one COVID, not one lockdown. 2 years lockdown also, these companies will survive. Because they're sitting with so much of reserve, they can still pay salary to all employees even if revenue is zero. But small cap companies, they're not sitting with so much of extra money. So in the event of anything wrong, the one who has some reserve will manage the problem. The one who is sitting with very less reserve, that too, in CA final you will study there is something called cash reserve, not just reserve. Liquid cash in the form of reserve. Now if you have a war problem, inflation problem, COVID kind of problem, these big companies are not worried. Reliance stock, if you check before COVID, after COVID, within 4.5 months it came back to where it was. Some small cap companies took almost 2.5, 3 years to come back. Some companies got even closed because they could not handle so much of cost. Imagine, let's take one cinema theater which is a listed company. Okay, say Inox. Now, if that company has enough reserve, and then lockdown happens. 1 year government says you can't have uh, cinemas running in public. Now revenue is zero, but you still have to pay rentals, those employee salary. How long can you pay? All that you have in reserve till that becomes zero, you can survive. Now if you have good amount of reserve, 3 years lockdown also you survive. If you have very little reserve, 5 6 months you can survive. After that you will need fresh loan. And in such situation, banks won't give you loan also because they know you are not in a good position to repay them. So the companies which have created good reserves will handle any bad news. I'm not saying it will not fall. It will fall much less, but recovery is very fast. Understanding? They call it as V-shape recovery. You know why it's called V-shape recovery? It falls also, comes back also very, very quickly. Today, check Reliance stock before lockdown, after lockdown. Within 3 months, it came back to where it was. Reliance was the first to come back where it was. Yeah, not today's price. Today it has been split. Okay, before splitting, that stock was somewhere around 2,000 rupees. Okay, during lockdown, it went to 900. If I remember, worst was somewhere around 750 rupees. From 2,000 went down to 750. Came back to 2,000 within 3.5 4 months. Because people also know they're sitting with so much of reserve. This 1 year, 1 quarter of loss can't shake the company that easily. Therefore, why checking reserves in any company's balance sheet is important. That tells you how safe this company is. Anytime, just think about it. Do you remember Maggie was banned few years back? Which company makes Maggie? Anyone knows? Sorry, Nestle makes. Yeah, Nestle Maggie is that. ITC also makes a noodle, but that's not Maggie. ITC makes one variety noodle. I don't know the name. Yep, Yippee is it? I don't know how to spell it. YIPPEE. ITC makes it. No, Sunfeast is owned by ITC only. Okay, smart people and then smartest people in the class. Sunfeast is ITC's brand. Anyway, that's okay. Now back to Maggie. Nestle, in addition to Maggie, they have so many other products, right? Tomato ketchup and so many things they have in FMCG. Go to your kitchen, you will pick up out of five, two, three will be Nestle. Yeah. Now, when such companies, such major product like Maggie, it was banned few years back. That day stock would have gone down because that's a main product. But that company could survive because they had other products and they had so much reserves. Then after few, I think couple of months, I don't know, Maggie fans can answer this question. It was on ban for about 6 7 months or more than that. I don't recall exactly, but I know it was not a very long duration. Less than a year. Huh. Now less than a year, government lifted their ban and the product was back to market. Now tell me, if it was not Nestle, it was some other small company, that one ban incident was enough, the company would have got closed because there is no other product. You don't have reserves. You can't even pay salary, and only Maggie is your product. Just a second. There's no cell in the battery in the mic here. It was charging. See, charging ಆಗ್ತಾ ಇಲ್ಲ. Yes. Sorry, there was some issue with the mic. If Nestle was a small cap company with single product, with single unit, then that one problem, would have killed that company easily. So when you invest in a company, if you know they have multi products and different variety products, not all noodles, many varieties, not variety, it's still noodles, right? So when you know it is that too in FMCG sector, companies will survive even if there is a recession. People will still be at least having tea, coffee every day, at least salt, at least sunflower oil, at least rice. So there are very famous quote in stock market: when you are in deep recession, which stock to buy? People say buy dal chawal stocks. Tell me what is the meaning of dal chawal stocks? FMCG products. If you don't know which stock to buy, because everything in stock market is red, best thing is to buy dal chawal stock, because even if you are in deep recession, you will still eat three times a day. Okay, maybe premium product you may not, but basic needs, at least salt you need, milk you need, milk products you need, basic rice you need. Tata Consumer Product, Godrej, Unilever, Nestle, PNG, these companies are always going to save you even if there is a big recession. Okay, it's popularly called dal chawal stock, and some people proudly say I'm a dal chawal investor. That means I always invest in a safe place. Tell me, in COVID also, did we all not eat more? We ate more. That means even in such a bad thing, these companies did good business. Now what more you want? When everything is good, happily people eat. When everything was so deadly, also people were eating more. Then what else do you need? That means it has tested both variety. Now if there is a war, will I stop having coffee from tomorrow? No. Will I not take salt in food? I will. Sugar I will. Cannot. These things you cannot survive without this. So many people believe in long run, dal chawal stocks are safest. Oh, but be careful if you are planning to make investment on this. Based on this, you should also know that today buying a DMart stock is not called dal chawal stock, because people can still buy dal chawal without DMart. So tomorrow DMart may get closed because you can buy through Blinkit today. Why do you need a store, physical store like DMart? I don't know what is the exact name. It was Big Bazaar, then Reliance purchased it. It's called Reliance Smart, if I'm correct. Reliance Smart, correct. Huh. Which are the other competitors in this segment? More, Vishal Mart, D Mart, Star Mart. Okay, never heard of. Okay, maybe yes. Then which is the other one? You know what I'm talking about, correct? Groceries in a supermarket type. Other than these 4 5, is there any other player which is into this? More also, I'm not saying too many nowadays. Used to be too many before, but now quite less. Now tell me, DMart shares, if it is going down, that doesn't mean people are not eating Tata Salt. They are eating Tata Salt, but buying through Blinkit. That means when you say FMCG investment, it should not be the channel of distribution. It should be the maker. So it is still Maggie, but Maggie is not coming through DMart or Big Bazaar. Maggie is coming through Zepto or Instamart. So ultimately, when you invest in the manufacturer, you are in a much safer position, right? So these companies, Nestle, Unilever, these are so big companies today. Not one, not two. 5 years you ask them to keep their factory shut. 6th year they can still comfortably run because they have so much of reserves with them. So one thing to test before buying any company stock is check in their balance sheet whether their reserves are increasing year after year. On Money Control website, last 5 years balance sheet will come to you. Equity share capital. Next itself is reserve. If reserve is going up and if turnover is going up, two things are enough for you to understand that one, business is increasing and they are creating more reserve. When there is a problem, that company can survive. Yeah. The fourth source actually is debenture. Debentures, number one, are for long-term purpose. Second, secured slash unsecured, need not be always with security. Maybe or may not be listed on any stock exchange. That means these are called unlisted debentures, public limited but unlisted. Now, can you buy unlisted debentures, unlisted stocks? There is a company, it has debentures, but it's not listed in market. Can you and I buy? Okay, do you know public companies are of two variety, listed, unlisted? Unlisted public company share if I want to buy. If you want to buy, is there a way out? Don't tell me Demat account, it's not listed anyway. Then what is the way out? Do you at least know Chennai Super Kings share you can buy? 210 rupees, roughly. Franchisee, CSK is a franchisee. Those who, and now, not fans of CSK, this is out of syllabus. RCB price, I do not know. CSK I know because there is one such quite popular unlisted stock. You know what they did? Whatever revenue comes from the entire IPL, half money goes to BCCI, the board, controlling board. The other half is shared equally among all franchises. In one of the years, I think 2023-24 year, from IPL, total revenue they made was about 46,000 crores. All ticket, advertisement, everything, sponsorship, TV, live, Hotstar, all of this together. 23,000 goes to BCCI. 23,000 divided by 10 teams. 2,300 went to CSK. This is the way these brands, these franchises can make money. Now they also want to expand because they want to buy best players. For that, they need money. Correct. It's as good as a business now. There is an auction, I think at least this you know. Now if they have to buy people, I don't know, buying may not be correct word, but technically it's buying a player. If they have to buy a player, they need more money. Now for more money, what do? They issue shares. You and I can buy, but it's not a listed company. It's an unlisted company. For that, I should go to their office or I should know somebody who holds it and who he should be ready to sell it to me. I remember long ago, 2018-19 maybe, CSK share was available for 20 rupees. Now it's around 210 rupees. Every year as IPL viewership increases, these Hotstar, Geo, these licenses, advertisement on TV, the ticket collection, ads, and so many sources of income they have. So you can even buy unlisted stock. But the problem is these are illiquid in nature. Okay, you can buy. After that, if you want to sell again, same difficulty. How will others know that you have share? Correct? If it is listed, I can log in and put sale order. People will know that I have the shares. If it is unlisted, becomes difficult. Again, you have to go back to that company, find out someone in your circle who also has the share and tell them that I'm ready to sell. Please find out if there is a buyer. This is one small problem with buying unlisted debentures, unlisted shares. Not that you can't buy, but you should know that people or that company, and then selling also becomes slightly challenging because you should know that person, correct? There is no online platform where you can buy and sell. Today, can I sell a flat on using any online portal? I have an apartment. If I want to sell, do we have opportunities? There is 99 acres, there is no broker, there is magic breaks, and so many places. This is what I'm saying. If there is a marketplace, it becomes easy. These illiquid shares, there is no market. If there is market, it's only stock market, and these are not listed companies. So it's not impossible, but slightly difficult. Those who are interested in RCB, go home and check. Yeah. And it's based on profits, not based on whether they win the cup or not. So that risk, you don't worry. I don't want to talk more on this. Some people will not like it. Anyway, can we continue? The cost of capital raised through debenture is quite low, since the interest payable on them can be charged as expense before tax. First of all, the risk taken by debenture holder is less, so return expectation is less. Number one. Number two, whatever we pay on that, we save 30%. First of all, we pay less, then 30% in that we take out. Then we actually debenture is a very cheap source of fund. So that is one advantage, cheaper. Second, there is no dilution of ownership. Number of shares won't change, so EPS will not come down. Disadvantage, interest and principal both are obligatory. If you do not repay, people can file a case against you, the debenture holder. Do you know this company Sahara, SAHAR? If you are a cricket fan, Indian cricket fan, not IPL cricket fan, on jersey we used to have Sahara India Parivar. Yeah, that's a company, Sahara company. They had this trouble. They collected money from public. Not now, earlier, much before. Now this company is not much there. They had collected public deposits, kind of debenture, but failed to repay. And when you don't repay, they can file a case. The people who have deposited money. This is called obligatory. If you do not repay, the investors can file a case. Shareholders cannot file a case. Equity, if you don't pay them dividend or if you don't repay the principal, because it is not obligated. You know what company will say? When did I promise you that I will repay? On equity certificate, no percentage is printed, no time period is printed. Why are you shouting? I never promised you. You expected. That is based on my past performance. I never promised you. But in debenture, that's not the case. Date, if it is 31st March, 8% per annum will be paid. 1st April itself, they can file a case if you have not paid before 31st March. They will not even give you some time flexibility. Second, debentures will increase your financial risk. Even if you are in profit, EBIT, positive, but if interest is more than EBIT, even after making profits, you are still in trouble. Yeah, there are a lot of companies which are like this. They earn enough EBIT, but that is equal to their interest itself. All that they do full year is only to pay interest. Now, what is the use of being a shareholder in such companies? That is the risk that equity will take, because now we have debentures in our balance sheet. Next one, since debentures need to be paid on maturity, underline a large amount of cash outflow is needed at that point of time. This problem you will not understand when you issue. Imagine today I am issuing debentures to her saying repayment after 3 years. Today I collect cash, no problem. 3 years later, she will come and ask me repayment. Like her, if I've issued to 20,000 people, collected 100 rupees from each one of them, 20,000 into 100, such a big money. How will I get that money that day? I have to prepare myself to repay such a big principal. I would have taken the money and would have purchased maybe land, would have constructed factory building. Now if I have to repay, I don't want to sell that and repay. Then where is the way? What is the way to pay that money? I should make so much money in 3 years that I create that fund every year, some amount. You in accounting you'll study. This is called debenture redemption reserve or debenture redemption fund. Correct? You know you have to repay after 5 years. Don't wait for that day to come. Every year, keep creating some amount so that that year, when big repayment has to be done, without a difficulty you can do. But how do you create this even every year? You should be in profit, otherwise you cannot create. Yeah. Debentures can be divided into couple of categories. One, non-convertible, fully convertible, partly convertible. Easy to follow. Non-convertible, you are a debenture holder. 5 years later, principal will be paid back to you. Simple, no question of conversion. Second, fully convertible. You are a debenture holder now. 5 years later, you will get an option to become equity shareholder. Say one debenture, I will give you 10 equity share. Partly convertible, that means half money I will repay to you, balance half money I can offer you 5 shares. Partly you will get cash, partly you have an option to become my equity shareholder. Simple to understand. Other varieties, number one, bearer and register. I think some of you know what is a bearer instrument. What is a bearer check? If I write a check without mentioning her name and give it to her, now can she pass it on to her? If I have not written her name, can she give it to somebody? Can she give it to him? Can he give it to her? This is called bearer instrument. Only my signature is there, amount is there. The person's name is not written. This is only theoretical. In today's world, there are no without name debenture certificate. Okay. Then what is registered debenture? The debenture is registered in her name. That means she can't give it to somebody. If she has to, then she should sell it. Tell me, if you have hard cash currency with you, is it a bearer instrument? If you have cash, if you give it to me, can I use it? Or will your name be written on the note? No, that means it's a bearer instrument. But if it is check with your name on it, somebody has signed saying pay to Mr. your name, then even if you give it to me, I can't do because my name is not equal to your name. Correct? So two varieties. Theoretically, in real world, we have only registered. It is with that person's name. I think you know at least this account pay check. When they say account pay check, then it has to be paid to that person only. It cannot be paid to anybody who brings that check. Simple way to understand the difference. Mortgage and simple. Simple is without any security. Mortgage is when there is a security. Redeemable, non-redeemable, again theoretical. Non-redeemable means principal will never be paid back. That means forever I have to pay you interest. If I'm not repaying principal, then forever I have to pay you interest. This is called perpetual debt. Again, in India, you cannot issue perpetual debenture saying forever I will pay you only interest, never ask principal repayment. Practically not going to happen. Then, next discussion is on bonds. Bond is somewhat like debenture with some basic differences, but what is more important is understanding callable bond and puttable bond. Mark this, extremely important. In future and option trading, sometime in CA final class, you will study call option, put option, and we're discussing call option bond, put option bond. In intermediate, they don't use the word call option, they write it as callable and puttable bond. Okay, two varieties of bond. First, read the bond definition. It's a fixed income security. Why did they say fixed income security? Rate of interest is known well in advance. Raised to create fund. Bond can be raised through public issue or through private placement. Only to some organizations you can issue a bond. Yes, let's continue. Read very slow. It's slight challenging to understand. Go slow. Bond can be divided into two varieties: callable and puttable bonds. A callable bond has a call option which gives the issuer the underline right to redeem the bond before maturity. Read once again. A callable bond has a call option which gives issuer a right to redeem the bond. I'm writing some example on screen. Suppose A Limited has issued a bond, Mr. D has purchased it. 100 rupee bond, 5 years maturity, 8% interest. Now what should happen? Every year 8 to be paid. Fifth year 100 is to be repaid. Simple. Now after 2 years, if A Limited wants to cancel this bond, now read the line. A callable bond gives them an option to whom? Issuer. Who is the issuer? A Limited. A right to redeem the bond. They can call Mr. D and say that I gave you one bond of 5 years. Today, I'm using my call option. Come back and take your debenture certificate. Right? Now understand, why will they do this? If they do this, in second year itself, they'll have to repay the money. But third, fourth, and fifth year, they will not have to pay interest. Correct? Think and answer. Under what circumstance a company will do this? Sorry? Listen to me. When you issued this bond, you offered 8% interest. 2 years later, in market, I mean in real world, you know other companies are issuing bond for 6% interest. But you are stuck in between because you have already promised 8%. So what do? Use your call option and ask the debenture holder to come and take back his debenture, give him 100 rupee. But you need money. Now you'll go for a fresh issue of bond, but that will be at an interest of only 6%. Rate of interest keeps changing. Correct? Sir, but this is only one-sided deal. Mr. D is always at risk now. Any day they may come and say, give my, I'll cancel the bond. That is why he will not accept it for 100 rupee. That's why they said this will happen at a predetermined price called as call price. To keep Mr. D happy, what they say is, I won't give you 100, I will give you 105 rupee. 2 years interest you got plus 5 rupee extra I am giving you so that you agree and I cancel this bond. From next year, don't expect any interest. So if I am Mr. D and I have a bond where company has a right, I should be prepared. Any day they can exercise the right and cancel this bond. But when they cancel the bond, I also won't accept just 100. I will also ask them to pay a little extra because I will be losing next 3 years interest. Correct? Now think, can reverse of this is also possible? What should be the reverse of this? Same dialogue. You change one sentence. A Limited issued a bond, 8%, 5 years, 100 rupee to Mr. D. Now Mr. D wants, after 2 years, that my bond be cancelled. Now tell me, who has the right to cancel this? Mr. D. And that is called puttable bond. Read now. Puttable bond gives investor a option. What option? Right to sell the bond back to the company before its maturity. Now 2 years later, Mr. D can go to company and say, look, I have the right. I want to cancel this bond. I don't want your interest for next 3 years. Repay my money. Tell me, when will he do this? If in the market, fresh bonds are getting issued at 9% interest. He will think, why should I stay in this company and earn just 8%? I'll take back my money and buy some other company bond where they are ready to give me 9%. Correct? But tell me, in reality, are you aware interest rates keep changing also? I said 8% has become 6 or 8 has become 9. Is the rate changing in real world also like this? Yes. The loan rate today, loan rate 3 years back, loan rate after 3 years won't be same. RBI decides the repo rate accordingly. FD rates, your loan EMIs, the interest rates, everything keeps changing. That is why companies are also very careful. They will not issue 15-year bond. If they issue, it will be with call option. You know why call option? Issue 15-year bond, and what if rate of interest in the market is going down? Any day they can cancel, and then they can issue fresh bond. In CA final, you have one full day discussion only on whether callable bond is good or a puttable bond is good, and when will a company use this call option? Is it good or is it bad? And understand one more thing: in callable bond, after 2 years, once they cancel the old bond, they won't keep quiet, they will issue fresh. Earlier it was 8%, now it will be 6%. Even if they save 2%, imagine total of all bonds is some 100 crore. You will save 2 crore every year, which is a big number. Yeah. So call option, understand two basic things. Call option gives right to the issuer. Put option gives right to the investor to cancel the bond before its maturity. Done. Sir, what if they don't use their call option or put option? Then both will keep quite peacefully for 5 years. Fifth year, anyway, it's no more an option now. Maturity period has come. You have to cancel the bond. If they want to do in between, they are free to do if that option is available. Yes, this is true even in stock market. If I say call option, I am buying a right to purchase something. Put option is a right to sell something. Here, put option is given to the seller, buy option is given to the company, issuer. Yes, market important. Read it once again today. Various bonds issued in India with their features. Try and guess what may be masala bond. I'll wait, don't read from textbook. Guess. What do you think is a masala bond? Suppose a student has not studied properly and he goes to exam hall and he sees this question. What do you think he will write and come? Sorry? No. Suppose a student has no idea what this is and this comes as 2 marks question. If you are that student, suppose you have not read this, what do you think? Correct. Spice companies, cardamom companies will issue bonds, and that's called masala bond. You know what? You're half correct. Not fully, but you're half correct. I'll read from book, don't worry. Understand first. Indian company wants to issue bond outside India. Then such bonds are called masala bonds. Now the question is, why did they select this name? Guess why did they select name masala? Because in the whole world, India is known for its masala. Therefore, if you say masala bond, according to study material, world will understand, okay, this must be from India. Now, I don't understand the sense behind this. If you say Indian bond also, people will understand. I don't know why they had to select this name. So, understand what is the story. Infosys wants to issue some bonds. To you and me, they don't need to go through masala bond route. It's a normal bond. I am an INR account holder. Infosys is also INR company. Local currency, no problem. But Infosys wants to issue bond to somebody in US. Then the problem is his demat account is in his country stock exchange. Infosys is here. Infosys deals in INR. He has some other currency. Therefore, what is a common point for these two people? Use this bond, and that bond is called masala bond. So if a foreign investor is saying, I have invested in masala bond, that means he has invested in an Indian company. Infosys masala bond. Wipro masala. I know it doesn't sound very nice, but that's the reality. Even now, whole world, they believe. One thing is true, our masala is special in the whole world. That I am not questioning. But you can say Indian bond, that is better than saying masala bond. Correct? If you know a little bit of history, you know this, but you don't remember maybe. The first chapter in history class, whenever you studied, foreigners came to India in search of masala only. Remember that? 1490, Vasco da Gama. Correct? Came in 1498, the first person to come in search of masala to trade only, right? And if you get the chance to meet anyone randomly also, tourist from outside, ask them how are they enjoying Indian food, and they'll tell you why they love Indian spices, masala so much. Other country food is your tongue, my tongue cannot have beyond 8 10 days. Yeah, first thing you do after getting down in Bangalore airport, cross the road, go to MTR, have one masala dosa, one bisbede bath, and one filter coffee. Then that Atma inside you will come out. Would have died by then, only physically you are alive. Then that Atma will get up because it is literally boring food in rest of the world. Some countries are good, not saying no, but Americans, European countries, therefore, if you give them bread and a bun, they'll live all 365 days into 3 times. And with bread, what maximum you can do? Even if you think most creative, it'll still be base bread only. Correct? It can't be very uh, flavorish. We don't understand the importance, but they have understood because their food is so boring, right? Whole world, even now we sell lot of cardamom and spices and all of this. We are famous in the world. Therefore, government thought maybe we'll keep this as a name, also as a promotion of our spices. Read. Masala means spice bond is an Indian name used for underline rupee denominated bond. That's why I told you an Infosys bond, which is in rupee INR, rupee denominated bond that an Indian companies can sell to investors underline outside India, or as they call it overseas market. That means a Singapore guy, a German guy, an Australian guy wants to buy Indian bonds, they have to buy through masala bond. You and I can directly buy the bond because we have same currency, but they have a different currency. Therefore, this is the way. These bonds are issued outside India, but they are denominated in Indian currency. NTPC, heard of this company? Yeah, Power Corporation company. They raised 2000 crore via masala bonds for its capital expenditure in the year 2016. Yeah. So keeps happening, not, and for NTPC 2000 crore is not a big number. For you and me it may sound big because they're into power generation. None of their investments are in lakhs. Basic itself is in crore. So 2000 crore is not something very big for them. Second one, give a try. Guess what do you think is a municipal bond? Here you are 100% correct if you guess also. Come on, guess. Issued by a municipal corporation. In Bangalore, it's BBMP. Correct? Like this, every city has its own city corporation. If they want money, they can also issue bonds. And that bond is called municipal bond. But they have to pay interest. Now, from where will they get money to pay that interest? Think if Bangalore Corporation or Mumbai Corporation, Delhi Corporation, if they issue bonds, bonds will come with interest. From where will they get money to pay interest? Government will give them money. Then government can give original money only. Why do you have to issue bonds first of all? They will use it only for those projects where they can generate income. That means something that is done for free, that cannot be funded through municipal bonds. Now tell me, your house, my house, we pay water bill. That water bill goes to the corporation. Now, if they want to do some water pipe network, yeah, some road digging and redevelopment of pipeline network, then they can take loan because they know after this we'll be supplying water, and once we supply the water, there is water bill, and we start earning money, and using that money they can repay the principal and annually pay the interest. Yeah, read. Municipal bonds are used to finance urban infrastructures, and these are now becoming much famous in India. Ahmedabad Municipal Corporation, they issued first time in Asia to raise 100 crore rupee for a water supply project in the city of Ahmedabad. Any city corporation can do this. Do you know government also issues bonds? Like Highway Authority of India, NHAI, they issue bond. Don't they get money from budget? Why do they need my money, your money for bond? Highways, don't they get money allotted through budget itself? Then why do they need extra money from you and me? Why municipal corporations they need? Why can't government of Karnataka give money to BBMP corporation? That money is not enough. If you use your central government budget to make all national highways, then 1 year we should not do anything else. Understanding to make. And by the way, a recent estimate in newspaper that I read, a normal road, my house area, your house area, a kilometer road is costing them almost 1 crore rupee. Normal road, not national highway. Now imagine national highway, 8 lanes, 12 lanes, and that to hundreds of kilometers cannot happen through tax money. And now we have our own questions on how this 1 crore came. Anyway, we also know the answer sometimes. That's okay. But national highway roads cannot be built, and it's not like just one layer of tar. Okay, it's multi-layered, and it should be such good quality roads, and also you have to maintain. Practically impossible through government budget allocation. Therefore, what they do, they create a new company, new organization. In case of highway, it is NHAI, and NHAI issues bonds. You and I can buy. Now tell me, from where will NHAI get money to pay us interest? They collect toll. So only revenue generating organization can take this chance of issuing bonds, because 1 year later you have to pay interest. Make a note if you want. Almost all power corporation companies, they issue bonds. For next category, government bonds, make a note. Almost all state power corporation companies issue bonds. That is the last one. Read government or treasury bonds. Government, also called as treasury bonds, are bonds issued by Government of India, comma, Reserve Bank, or any state government or any government department. You write example, NHAI bonds. There are many. If you want, REC in capital letters, REC bonds, Rural Electrification Corporation. You'll study about this in income tax class. Some of these interests are exempt from tax. Therefore, people like investing in these kind of bonds. They also said Reserve Bank of India. I think I told you in one of the discussions, Reserve Bank of India issues gold bonds, yeah, called as sovereign gold bonds. Again, you get interest and the principal will be repaid. But only one better thing in gold bonds is, if gold prices are going up, your bond value will also go up. Yeah, for that Reserve Bank of India, whoever wants, make a small note. Sovereign gold bond, SGB. Do you know roughly at least what's the gold rate now? Above 80,000. Hmm. Now, have you noticed one more thing? By the way, those who are watching this class, this rate may change depending upon when you are watching this class. But one thing is sure, last 3 years, 5 years graph you check. If I remember correctly, before 2020, around lockdown time, gold was somewhere around 2,900, 3,000, 3,100 range. Okay. Now 3,100 to roughly 8,000 plus, almost more than 100%. But if you think over 5 years period of time, growth of 100%, on simple average basis also appreciation is about 20%. Understanding what I'm saying? Sir, some stocks can give better appreciation than 20%. But the difference is, there is much, much, much less risk in investing in gold than in investing in stock. Okay, so when we compare also, it should not be just rate of return, 5 years gold versus 5 years Infosys share, and then I can also give 1 hour speech on this. But we should also know that you hardly have any risk when you buy gold. What is the worst thing that can happen? Gold price may go down. If it goes down, then go to the shop and buy gold and keep it with. Anyway, your families love gold. So downside also, you have a reason to be happy. Then don't cry, it is too costly, it's too cheap. Now go and buy. If it is going up, anyway, you have bond with you. And bond, those who want, make a note. This bond is called derivative instrument, especially gold bond. Why? It derives its value from another asset. What is that another asset? Gold. You are not buying gold, you are buying an instrument which derives value from gold. Anything that derives value is called derivative instrument. Futures, options are all derivative instrument. Nifty futures will go up only if Nifty is going up. That means Nifty future is deriving its value from Nifty. Gold bond is going up because gold prices are going up. Only two possibilities. Gold may shoot up like anything. You already have the bond. When redemption date comes, enjoy double money. If it goes up, if it goes down, fantastic. Go buy, keep it with you. Next 3 generations can enjoy. Even if you don't like it, someone else in the house is liking anyway. Give that only as gift to everybody in your family. Whoever is getting married, use it. Anyway, gold was cheaper. So when you compare, you should know gold return, silver return, stock market return is not always a correct comparison. If I have gold in my demat account, I don't have to check on daily basis. Correct? The level of risk that I take with stock is slightly higher. Therefore, definitely stock will give you the highest, higher than gold. But then gold gives you peace of mind also. But that you can't put it in rupee. There's no graph for peace of mind in any scale. Difficult to measure. So always my suggestion, whoever wants to invest in stock market, whatever money you have decided, split that into 2 parts. Let half go to gold and silver, the other half let it go to stock market, because it's always risk and return in a balanced way is better than too high risk or too low risk. I'm not saying do only gold and silver. That will also be boring. Yeah, you won't feel like checking even in 2 years, 3 years. And gold won't move like stock, sudden 5% up, 3% down, 2%. That doesn't happen. But in long run, you see any graph over a 5-year period, you will realize. So, okay, why government wants to issue these gold bonds, by the way? Maybe some reason. And we are in 2025. Those who know this news, have you noticed from last almost 1 year, RBI is not issuing gold bonds fresh. Those who are already there, only they are there. Normally they used to issue, I remember 2020, 21, 22, every year 4 times they used to issue. And every time they come with an announcement, it will be 3 days, April 1, 2, 3. These 3 days, log in and buy. Next, if you miss that, don't worry. July 25, 26, 27. Like this in a year, 4 times they used. Last 1 year, RBI has not issued fresh gold bonds. Tell me why they wanted to issue first and why they are not issuing now. Must be some reason, correct? Suddenly, notice, read today. I want all of you to do this homework. When was the last time RBI issued gold bond? You check. And before that, how frequently they used to? You check. You have Google and YouTube. You can find it out easy. One, they realized long ago. This was during the demonetization and that time when they introduced this. Lot of Indians have this habit. I think some of you in your house also have this habit. They give regular money to local jewelry shop and they keep buying gold on behalf of you. Okay, kind of unregulated because it has its own risk, because that person may be an individual jewelry shop owner and they write it in a piece of paper and there's no contract or agreement signed. I don't know which jewelry, maybe Titan, Tanishq one. They have these kind of schemes. Every month you can. Lalita Jewelry, is it? Okay. Bhima also has this. Madam knows a lot about this. Malabar Gold. Those who do not know, every month, it's more like an SIP. Every month you can give, say, 10,000, 5,000, 3,000 amount to them. They keep buying gold on behalf of you. And I think Tanishq maybe has this. 11 months you pay, 12th month they will pay that amount on behalf of you. So basically 12th month SIP is free. Lalita also has this. Okay. Madam Bhima Gold also has this. Okay. I'll read more about it. I did not know so much about this. One thing government wanted to do maybe was to make it more regular, more systematic. when you bring in RBI and government of India, people don't have a doubt about what if that happens, what if this happens. People have these question marks. One. Second, lot of Indians just buy physical gold and keep it at home. Neither they wear it nor they convert to cash. Gives them that feeling we have gold at home. We have these kind of people in every house. Somewhat gold should be there in the house. Yeah, that, and they don't even keep it home. They keep it in bank locker. And for that again they charge. Banks will charge, and you have one more annual 2-3,000 rupee cost also. Now, instead, if gold you want it to be in an investment form, then why do you have to buy it in physical bar, or they call it what, biscuit or coin form, and physically store it and check that Almira lock 10 times before sleeping every day? They understood people are unnecessarily taking risk by physically storing it. And by the way, gold we import. Again, if you keep buying physical gold, understand we are sending our cash outside India. Anyway, RBI will have the gold to print currency notes, and when RBI is buying gold, they buy in bulk, so they get a better rate than you and me. Me as an individual can hardly bargain. We have very less power to bargain. Therefore, maybe government wanted to bring it to more an organized way than keeping it in an unorganized manner. And lot of jewelry shops, there is a complaint that people do a lot of cash transaction. They do it without bill, and then they get cheated with duplicate gold and all of this. Maybe government wanted to pause this. They started, and many people invested. Now from last 1 year, even government RBI is not issuing bonds, because the bond, that SGB, it is not only capital appreciation. Whatever money you have invested, they are giving you 2.5% interest. That means today if they issue bond, and if you buy 10 grams, then whatever 82,000 rupee if you pay, they have to pay you 2.5% interest every year. And for them it's a cost also. Correct? When base amount is less, 2.5% maybe was okay to them. Now with double the money, triple the money in last 5 years, taking 8,000 from you will cost them 2.5% every year. And if gold value is going up, you get capital appreciation. From investor point of view, very beneficial. But from last 1 year, RBI has not officially issued any notification also as to when will be their next gold bond. And best thing is you can buy even from 1 gram as a starting point. You don't have to buy minimum some amount. Yeah. And there are ETFs, exchange traded funds, where you can buy even 100 rupee worth gold. I know it is not 1 gram, it is 1 divided by that very small number. But in an SIP, you never want to buy more at one go. You keep accumulating 100. That mutual fund will keep buying gold on behalf of you. So those who don't want to physically buy but want to invest in gold and silver, for you the solution is either RBI's SGB, or there is something called gold ETF or gold BEES, BEES, silver ETF or silver BEES. These are mutual funds which invest all your SIPs in gold and silver. They are called alternate investments because people can manage their risk well if they put some money in gold and silver. Yes. All right. We'll take a quick break and then continue. Don't drag. Quick, 5 minutes max to max. Up to UD you can go. Have tea and come. That's the duration of break. Don't take more than that. Okay, the next is loans from financial institutions, starting from bridge finance. Tell me, if I go to a bank, suppose I'm running a business, I go to a bank, I need loan of 1 crore rupee. On what basis will bank accept or reject my application? Suppose you are a bank manager. I am running a business. For business, I need loan. I come to you. What are the factors you check? You'll ask my, say, balance sheet P&L. Normally, banks ask 3 years, last 3 years. Okay, I gave it to you. Then you will ask for, or you will check my previous credit history. If I have other loans, I have defaulted, cases against me, all that. Okay, done. What else? Suppose both are good. Balance sheet P&L you went through, no cases pending, no loans outstanding. What else? CIBIL or credit score. That's basically checking my credit history. If both are good, balance sheet P&L is good, means I'm in profits. And second, I have a good credit history. Then also, will you have any other point or question before sanctioning loan? Do I have any other variety loans, debentures, bonds? That is there in my balance sheet now if I have it. That's why you ask my balance sheet, right? What else? Please understand, when a bank is giving loan to a company based on last 3 years balance sheet P&L, the EMI will start from next month. So more than how you performed in the past, bank wants to know how will you perform in future. Unless you perform well in future, how will they get their EMI? Correct? There is something called debt service coverage ratio, DSCR, which will help banks to identify whether company has ability to pay the EMI or not. That means they want you to prepare your projections or budgets for next 5 years. Suppose if you say I need 1 crore loan, first question they ask is what will you do with this money? If you say I will set up a new factory, I already have 3 factory units, this will be the 4th one. Then they will ask me, with this 1 crore rupee factory, tell me how much are you going to earn? Production, sales, profit, cash profit, and then how much is monthly EMI, whether you have the ability to pay or not. Now comes the challenge. They want me to prepare one projection, my budget of next 5 years. I will prepare the best possible budget because I want to show more sales, more profits, but bank won't trust my numbers. Bank thinks I'm kind of hyping or over showing my cash flows and profitabilities. What banks do, they will appoint another expert, or they have employees in their bank itself to check whether the budget that I have prepared is sensible or not. Otherwise, tell me anybody, if they want loan, they will show big number only, because bigger the number you show, higher the loan eligibility. Everybody knows this. I should show more number to bank, then only my loan eligibility will go up. Therefore, you always tend to hype or overshow your numbers. But banks won't accept your numbers. Bank will appoint maybe another guy, either outside consultant or their own employee, and they check whether your projections are correct or not. If they think you have unnecessarily overshot your sales, but you have not done proper cost estimation, they will send a reply back saying your projections are not acceptable. In this, sales growth is wrong. This is wrong. This is wrong. Prepare one more. Revise your project report and then submit. Now the problem is, this can take weeks to gather time. Some banks can go months together on this. And then they want somebody to come and sign as guarantee. Then they want some collateral security. One is primary security. Second is backup security, which is called collateral. Suppose I'm taking loan in the name of company. They want some property of director also as a security. That's not primary, but that's secondary. Now I may give one paper saying this is my land records, that site. Now that document may be fake. Then they will hire one lawyer to check whether that paper is original or not. And all of these procedures will take time. Some of the public sector banks, government banks, it may take months also, sometimes 2 months, 3 months after you submit loan application, by the time you get the sanction letter. But the problem is, the businessman who has gone there is in urgent need of money. He cannot wait for 3 months, 4 months. Therefore, what some banks do, when you go and apply itself, they will give you some amount of loan, and that loan is called bridge finance. They say, okay, you have come here for 100 lakh loan, first take 10 lakh and start your business. I will release balance 90 lakh only if you provide these documents. Now that may take 2 months or 3 months. You submit the documents early, we will process the balance amount early. Now this short-term loan given, the 10 lakh is given only to bridge the time gap. That's why it's called bridge finance. Some banks do even this. They will give you sanction letter, but not money. They will say, we are happy to sanction a loan of 10 crore on satisfying below conditions. Now in that below condition, there are 25 documents that you should give it to them. As I told you, land paper, balance sheet, this and that, and so on. But you know, by the time you collate all the documents and submit to them, it will take another 1 month. And then they have to check original or fake and all of that. Then it may take further some time. Therefore, what you request them, okay, but the sanction letter won't help me. Give me some amount so that I can start my day-to-day operations. And then you take your own 1 month or 2 months and then you sanction the major loan amount. So the whole purpose of bridge loan is to bridge this time gap between sanctioning the loan and actually transferring the amount. What will I do with that sanction letter if I don't have money? Okay, think of this, a new businessman, one of you, okay, you decide yourself that you have started one business. Now you want loan. You went to bank. They're saying, okay, congratulations, we sanction 85 lakh loan. Take it, go. What is the use of that letter? I want 85 lakh in my bank. They say we will give you, but you should give us these 25 documents. But you know, by the time you submit all of that and they check, it takes months to gather time. So what you do, you ask them to give you a bridge loan. Same bank will give you a bridge loan. That bridge loan is only for that limited period of 1.5 to 2 months. And always, for your knowledge purpose also, you should know this. If the loan duration is long period, rate of interest is very less. If loan duration is short period, rate of interest is very high. So whenever I take 1 year loan, 2 year loan, credit cards, these interests are very high. But when I take 30 years housing loan, rate of interest is very less. Can you tell me what's the logic behind this? Why long duration, low rate and short duration is high rate? Think from bank angle. If it is a 30-year loan, even if it is less rate, you get so many EMIs to collect. Less, but many times. But if it is 1 year loan, you can collect only 12 EMIs monthly. Within that only, whatever maximum you can earn, you should earn. Therefore, you want to collect more. That's why if you know of all the loans, housing loan is cheapest one. You get it 6-7%. But personal loan short term 14%. Because only 12 months EMI. Very high because the duration. It's not only duration, it's also the risk. But basic thumb rule, if the duration is longer, rate is lower. Shorter duration, rate is high. Now tell me, this bridge finance is a short duration loan for that 2 months or 3 months loan. Therefore, the rate of interest will be slightly higher. If your loan application was for 100 lakh and they have given 10 lakh loan, then they will give you only 90 lakh loan after that 2.5 months. Even if they give 100, you have to repay this 10 anyway. So they'll minus this money and pay you the balance 90 lakh. That is for 5 years, 8 years, 10 years. So the rate will be slightly lower. This bridge loan, because the duration is short, the rate is high. Yes. Read here. This is taken for short period because of pending disbursement of loans sanctioned by financial institutions. They will sanction, but they will not release. What will you do with that letter if there is no money? For the temporary 1 or 2 months delay, they'll give you some amount, very small amount, but at least you can start your things, right? Though this is of short-term nature, since the important step in facilitating long-term loan, therefore it is being discussed along with the long-term funds. Normally, underline, it takes time for these banks to disperse loan to companies. They will not do it very quickly. They take lot of time. Is there anyone who has applied for, I mean, not you directly, in your house? Have they ever applied for any loan and it took too much of time and they got frustrated also? Ever happened? Anybody? Yeah. Can I ask which bank? I have guessed already, but still. Cooperative bank. What was the loan, purpose of loan? Housing loan. Okay. Anyone else? SBI. Which loan? Business purpose. You or your parents? Friends? They got finally, or they did not get? From how many months? 2 months, still in process. Anyone else? Sorry. What happened? They have not. They gave. They took 5 months time for checking documents. This is what happens. This is a real story, not any rare case. Anyone you ask, it takes time. Especially some banks are known for delay. Okay. Some private banks are little fast, but even that little fast is not less than a month. Then you can imagine slow means you have the examples in class itself. It takes lot of time. Some of them are very strict on document one comma full stop here and there. Also they say no name is not matching. And sometimes especially land related loans, if you apply, they want the document of ownership of that land from independence time. Who was that guy who sold it to next guy, all those documents they need. That file itself will be this big with that many sale deeds and all of that. In that 1 year, one file is missing or somebody's name is not matching. That is enough for some of those institutions. They don't give loan. They think it is some disputed property, or they think papers are fake, and then they will check all these records in the local city corporation from that time. And that time it was not all digital, it was all manual files. So it takes a lot of time, especially land related layout or these things. It's not going to be very fast. But in Bangalore, I have noticed, even you may know this, apartment loans if you want, because that apartment guy, that real estate builder has done all that back end work. You getting loan will not take too much time because they have spent already 2-3 months in getting the sanction from the banks. But if you are buying an independent house like the one next to Yeshas, this kind of house where you only have to go to lawyer, you have to find out bank, you have to talk to them, then it's going to take a lot of time. For businessman, that waiting period of 2 months, 3 months is too much. By then some other competitor may open his shop next to you. By the time you go, you are late. Therefore they want this quick short term money. That's why it's called bridge loan. And what do we do with that bridge loan? It will be repaid or adjusted. If the original loan application was for 100 lakh and bridge loan was given for only 10 lakh, either you repay 10 or they minus this 10 and give you only 90 lakh. And remember, rate of interest is normally higher than the main loan. Whenever you see the word term loan, understand term loan means long term loan. That is 5, 8, 10, 15 years. And this one that we're discussing right now is a short term loan. Venture capital financing. Heard of venture capital? There are 4 ways also. Anyone knows what is venture capital? Market important. They've been asking questions on this again and again. Yes, go ahead. Anyone? If Ambani starts one more business today, is it called venture? No. If someone who has no business idea, first time he wants to start a business, is that called venture? Then what is venture? VC, heard of VC funding? Shark Tank episodes have you watched by any chance? Now those guys who come there to pitch their business idea, most of them are doing that for the first time. They're just from college, pass out, if you know. Have you watched, most of you, at least one episode? Yeah. Used to be very good earlier. Now too much of masala, I feel. The time pass part has increased. The real content has come down. Better watch on YouTube whenever they start, masala time pass stuff, fast forward the video. If the discussion is about product, marketing, equity, they discuss all of this. I'll give you share 10% equity, 5% equity. They discuss about challenges, competition. That is good, worth watching. The other than that, the drama part that they have, you can do a quick fast forward. Now, any new business guy who has an idea but has never done a business in his life, if someone is investing, they take high level of risk, and that's why banks don't give them loan. That means if you are not from a business family background, you do not know anything about any business, but you have one business idea, you want to start, you go to bank, you will get no loan from them, because banks give loan only if they are sure that they can get the repayment. Anyway, your history, there is no balance sheet P&L, no credit score because you have never taken loan. In future, will you do business successfully? They can't trust you because you have never proved or demonstrated anything. You give a project report, as I told you, but how do they trust? And for banks also, once they give you money, they should recover from you. If they can't recover, it's a problem to them. And most of the banks won't give loan without security. And for that, you should have any property, asset, land, building, something with you. If you do not have, then there are some government schemes. Other than that, just like that, if you walk into a bank today and say, I have a business idea, I want a loan, no bank will trust you. Therefore, what is the solution for these kind of investments? Go to these people who are ready to fund ventures. Now, ventures is basically a business idea which is still in seed stage. Okay, yet to start, just a thought, just an idea. Facebook was also once, Swiggy was once, Zomato was once, Zepto was once a small startup idea. The one who invests in that idea takes huge amount of risk, because that business can reach zero also in 2 years. But there is a potential if the business is successful now, like Zepto. If you have watched Zepto company's CEO interview, he's younger than you. I think he's not even 21. Some of you, he's junior to you, and he's a CEO of that big company. If you look at his interview, you feel owner's son is talking. He is the owner, by the way. And you know how they started the business. Very interesting video. During COVID, when people were not allowed to go out and get groceries, and that was a difficult task, these two people, the owners of Zepto today, they started taking orders of their apartment people, and they would go and buy on behalf of them and then give it to everyone. Then they created a WhatsApp group, entire apartment. If you remember that time, WhatsApp had limit only 240, 250 people in one group. Now entire apartment has one WhatsApp group, and they would message, tomorrow 10 o'clock morning, I'm going to grocery shop. Please send your requirement. I'll go, I'll get, and then come to your house and give it to you. And they started giving little extra money in addition to bill. Then they understood, why not convert it to a business model. That's how Zepto started. But then it created some trouble. Now if it's a apartment WhatsApp group, everybody knows what others are ordering. Many people don't like this. Why should I know what she's ordering? Why should she know what she's ordering? Many people were not okay for this. They wanted that to be kept private. Then these guys created a software for that, which is now in the app form. They created a small app. Then they said, you download this. In this, you place your order. But then once you make it an app, then you can't restrict to your apartment. People can start sharing the apps. Then somebody in some corner of Mumbai, he can place an order now for just one shampoo, who will go all the way and deliver. Then they understood, if this has to become a big business, only two of us can't be delivery boys. Then they started hiring people. Then that's when they needed big funding to hire people, their salary, the server, website, all of that. Then I think there was one website, I forgot the name of the website. There they wrote their business idea, like your Shark Tank episode, they wrote it in a PDF, 2-3 pages. Somebody who read it got impressed, and that person, I think US investor, he invested a big money. That's how Zepto started in 2020 during lockdown. Now, this is an example of what is investing in a venture. Now, what venture capital financing means is this: there are people who have money. They want to invest in these kind of startups, as you call it. But the problem is, they alone don't want to invest. So what they do, such 10 people collectively start one company, and that is called VC funding company. Let's take an example. I have 5 crore. I want to invest in startups. She has 5 crore. She has 5 crore. She like this 20 people. All of us have 5 crore each. We want to invest. but we don't want to invest individually. So all of us create one company, and that company is called VC funding company. And now we have 100 crore, 20 into 5. And then we create a website, put a advertisement there saying we are ready to invest. We have this much fund with us. Whoever has a good business idea, come to our office, do the presentation, come with a PPT. This is what you see in Shark Tank story. Background is what I told you. Those people who sit, those 8 people, they have enough money. They want to invest in risky projects, but individually they don't want to do. Collectively they want to do. Now this is a new age way of getting the money. Now, sir, I have an idea. Can I also get this people? Answer is yes, but you should know how to convince them. Watching Shark Tank episode is easy. That side is not easy. And you might have watched those episodes. They won't give you hours together time. Within that 3-4 minutes, you should convince the other person. Definitely not easy. Convincing your friend about your crazy business idea is always easy. I have a house, interest, I will do this, I will do that. It's easy to explain. But then when you are, giving that as a pitch presentation, definitely not easy. In Bangalore, there are a lot of places where they do Sunday meetings. Meetings of what? 50 people who have money, 50 companies who want money. And then there is one organization kind of group. And they will invite both people. And they book one hotel room for one full day. And they will allow all these 50 people to give presentation in front of these 50 people. Whoever is interested, they then continue. And you should first become member of that club. Like your Rotary Club, Lions Club. There is this startup club also. Bangalore, it's very famous. Almost every area has one club. I know Jayanagar only has one club. Jayanagar Startup, some fancy name. They meet every month, first Sunday. They meet in a place near Jayanagar. Whoever has good ideas can go. And first you have to submit a PDF. They will go through it. If it is worth, then only they'll call you. They don't want you to waste the time of those big investors, right? Now these investors invest in 4 varieties. One, underline, equity funding. What they do, they means the rich people. They buy 49% of equity share. What does that mean? The person who came with idea will still be holding 51%. And in company law, if you have more than half, you have more powers than the other party. Correct? The other party is called minority interest. You have 51%. So most of the decisions you can take. Second way, conditional law. Here what they do, underline. They say, I'll give you money, but I don't want just interest or profit. You have to give me royalty. Now what is royalty? When you make sales, you'll have to pay some percentage of sales also to me. Now what is the use of this? Even if company is in loss, if they're making some sales, the investor will get some royalty. 3%, 2%, 5% royalty. And once you start making profit, they will take some share in the profit also. Because they are equity shareholder, but they also want some royalty money. Third, income. Now, here what they do, they charge some interest also and some royalty also. So royalty you pay when you make sale. Interest, they'll wait some years, 2 years, 3 years, they won't charge. After that, they will start charging the interest. See, these are given in books, but how exactly this is going to be is designed by those two people. The one who wants to give money, the one who is taking the money. Need not be only 4 variety. They can have many layers of also. First 3 years, nothing to be paid. Next 3 years, only royalty. Next 3 years, only interest. After that, share in the profit. This can be very different from one agreement to another agreement. In book, they have given you 4 varieties. Last one is participating debenture. Here, read, they will charge at 3 stages. 1, no interest is charged in the initial 2-3 years. They say, don't pay me anything, I'll wait. After that, low rate of interest for few years. Say 0 to 3 years, nothing. 4, 5, 6, you pay 3%, 4%. After that, they charge a very high rate of interest. They may say, pay me 18% interest. So it is 0 for first 3 years, 3% next 3 years, then 18% for next 5 years. Overall, in long run, they will recover the money, but they should be ready to wait also. And for the person who is taking money, he is in a safer position because he will not have to worry about performing well in first 6 months, 1 year itself. Most of these guys are still doing R&D. Even after 6 months, 8 months, 1 year, They may not have launched their product, maybe developing the software, doing trial runs. You may not get that sales and profits in first 1 or 2 years. Even Blinkit, Uber, Ola, all this, when they started initially, everybody struggled. Blinkit was in loss for a very long time. Zomato was in loss from the time they started. These guys were never in profit. Once you start making profit, after that you can pay high rates also. Okay, venture capital, startup related discussions are very important even from exam point of view. Okay, yes, the next discussion is on debt securitization. There are three stages: origination function, pooling function, and securitization function. In CA final, AFM, Advanced Financial Management, securitization itself is a chapter. What you have for 6-7 lines here. Okay, so I'm writing one small, say, diagram or flow of activities in the textbook. In this chapter at the end, do you have a page space for additional note? There you can copy. Allow me to first write this. You understand first. Later you can copy. And what you are copying is more than what you need for CA Inter. Okay. Now, the wording is debt securitization. That means a process of converting debt into security, right? Please understand one problem that banks face. You need to know a little background for this to be able to understand. I'll tell you from when to copy. Don't copy now. Suppose three individuals, Mr. A, B, and C, all of them go to HDFC Bank and they want housing loan of say 100 lakh each, 1 crore, 1 crore, 1 crore. Tell me, against what document will HDFC release this loan? What is the security? What is the document they take? The house paper itself, the ownership of the house. Now understand what happened. HDFC has papers now. Against that, they have given 300 lakh loan. Correct? Follow what I am saying. From HDFC point of view, papers came, money has gone. Every month EMI will come, which has some portion of principal and some portion interest. But that will take 20-30 years. These housing loans are for a longer duration. Now the challenge is they have papers, but the papers cannot become cash. Tell me now, if HDFC had only 300 lakh with them, then now if they want to give fourth loan, another person, Mr. D, comes and says, I need one housing loan. Give me 100 lakh. HDFC has no money. Correct? Now what is the way out? From where will HDFC get money? They want you and me, public, to open current account, saving account, FD, RD, and all of this. Correct? Now saving account and current account, maybe interest that they pay is very less, very, very small amount. But FD, RD, they pay good interest. That means that comes with cost. What if people are not depositing much in the bank? Then from where will bank get money to give loan? Can they print extra 100 lakh and give? This you know from long ago. Now printing is not possible. Then how do they get money? Sir, HDFC will take loan from another bank and give loan to Mr. D. That idea you know is not going to work out. HDFC cannot take loan from ICICI and give it to, then HDFC will have to pay interest. So what is the purpose of you being in the business? You know what they do? These papers are called illiquid assets. Why illiquid assets? You can't convert it to liquid cash. It's illiquid. That is the meaning. You cannot convert it to cash. What they do, they create one company. Okay, in your textbook, it's given as origination function. Yeah. What they do, they create one company and they'll give a name for that. In textbook, they call it as SPV, Special Purpose Vehicle. Basically, one more legal entity. Okay, can be anything. Let's assume A Limited. They create another entity. And what is the purpose of this entity? All these papers worth 300 lakh. Papers are transferred to this entity. Understand, not money. HDFC has no money. HDFC has 3 house ownership papers. Let's remove this from discussion. 300 lakh worth papers are with them. papers are transferred to the special purpose vehicle. Now what they do, they convert this 300 lakh papers into units of 10 rupees each, and they call it as 30 lakh units. It's like mutual fund. In a company, you buy shares. In SPV, you buy units. And then they will call general public, X, Y, Z, P, Q, R, S, T, whoever is interested, they can invest. Now, Mr. X will buy 1000 units of 10 rupee each. Mr. Y will buy 800 units. Somebody will buy 85 units. Somebody will buy 5 units, and so on. Now, what are they buying? Keep in mind, they're all buying units. That's why the name is debt securitization. The debt is getting converted into security. Sir, if this man has invested 10,000 rupee, he should be paid interest on this. Correct. Who will pay interest? This SPV will pay interest. From where will they get money? HDFC will transfer that monthly EMI that they get. And from where will HDFC get money? A, B, and C will anyway pay monthly EMI. Sir, what is the purpose of doing all this circus? The purpose of doing all this circus is A invested 10,000 money. X invested. Y invested. Z invested. With this, what happens? 300 lakh rupee will come as cash to SPV. And that 300 lakh will be transferred back to HDFC. Now they can give loans to 3 more people. D, E, and F. Able to follow? At intermediate level, this much is enough. But in reality, there are many questions now. Sir, what if ABC run away? Or what if these documents are fake papers? What if this SPV gets closed? Why will XYZ invest? Because is it not risk? Because you are investing based on document. You are not investing based on any land building asset. It's the ownership document. If document is fake, then understand XYZ will all lose money. At final level, you will study much more about this. There are people called credit enhancers. They are like insurance. Now, this is not part of Inter. Don't get confused. You only need 3 things. As per textbook, you see 3 things they have. 1, origination. What was origination? HDFC created that special purpose vehicle. Origination. Pooling. What is pooling? They pooled 300 lakh and converted that to units. By the way, my example, all 3 were housing loans. One can be business loan, one can be personal loan, one can be education loan, can be variety of loans. That's called pooling. You combine all of that and you take 300 lakh. It was, and by the way, I took 100. It can be 100, 80, 10, 25. Every day, hundreds of applications go to bank. All variety. People take loan even for marriage. Unsecured loan, personal loans category. All these loans are clubbed and all of that is converted to unit. So first one was origination, second is pooling, third is securitization. What is securitization? You issued it to public, X, Y, Z, A, B, C, D, all the general public. Now, for writing purpose, this is the way. 3 people go and ask for loan to a bank, and in my example, it is HDFC Bank. These people, A, B, and C, these are borrowers, correct? These are the people who need money and they are ready to pledge papers, correct? But HDFC Bank, they don't want to keep papers with them. They transfer all these papers to a special purpose vehicle. They can give one more name for this: asset management company, ABC Limited, XYZ Limited. Normally, it will be a subsidiary company of the bank. Okay, can be independent also in India, most of the cases. If most of the banks have asset management companies also in India. There is HDFC, there is HDFC AMC. AMC is asset management company. Okay, they can create another legal entity. In textbook, they call it as special vehicle or special purpose vehicle. And what special purpose vehicle does? This will first create one fund, and that is called pooling function, and that is divided by 10 rupee, 20 rupee, and then general public like you and me can invest. Somebody can buy 1000 units of 10, somebody can buy 800, somebody can buy 80, and these people will have to pay money to SPV. SPV will give that money to HDFC. Now HDFC again has another 300 lakh with them. Now again they gave loan. Now 3 more loans. Totally there are 6 loans. Now again all that they had is over. But good news, this DEF would have given 3 more papers now. That papers will again be transferred to SPV. They will again issue. And this cycle will get repeat. Understanding? Now you copy. I will highlight. As I highlight, you copy. First start with 3 people coming and asking money. They are called borrowers. They are called borrowers. Need not be always housing loan, any loan. If you want, write separately also. That will be better. A wants housing loan. B wants machinery loan. C wants to purchase a site, for that he wants loan. Basically all secured loans. What they will give to HDFC is all papers. Correct? Those papers are then given to a new legal entity. And what is that entity called as? Special Purpose Vehicle, SPV. All those papers are then clubbed, and this SPV will create a fund. They will create a fund. In my example, it was 100, 100, 100, which became 300. That is called pooling. That is then divided by a nominal value. For my discussion, I have taken 10 rupees. It can be anything. In India, most of the times, mutual funds, etc., when they issue units, at the starting point, it is 10 rupees. Therefore, for easy understanding, I have taken 10. Then that is issued to general public. In my example, Mr. X, Y and Z, these people will buy units. And when they buy units, they want interest. Who will pay interest to them? Not HDFC, because they never bought anything from HDFC. They bought from that SPV. But SPV has no source of income. They have only papers. HDFC will give them. From where will HDFC get money? Anyway, borrowers will pay EMI. That money they transfer. Sir, why did we create that SPV? HDFC itself can do this work. No? All 100, 100, 100, 300, you directly issue units to general public. See, banks don't want to do all this job. This is not the primary purpose why you have set up the bank. Bank wants to focus on its main activity, give loan, recover loan, attract more deposits. That is their main work, not converting papers into units. Therefore, they create a separate company, and that separate company will have its own shareholders, directors, employees. They will do this job. Yeah. Yes, actually, this is much detailed. There are too many people involved in it, but so much of content is not there for CA intermediate level. You only need to know 3 stages: origination, that is creation of SPV; second, pooling, that is clubbing all loans and making one fund; 3, securitization, converting that fund into units of 10 rupee, 20 rupee, 50 rupee, 100 rupee each. And that general public will purchase. Yes. After debt securitization, lease financing. For easy understanding, I know it is not exactly equal. For easy understanding, can I say leasing is like renting? Not 100% true, but in simple way, I own an asset. I have given you an opportunity to use it on some rental basis. Correct? There are two varieties of lease: finance and operating lease. Mark it important. This is important even for accounts. There is an accounting standard on lease. Okay, AS, accounting standard on lease, and there also knowing this will help. What, sir? These units, they are treated as securities. Not all. Most of these are unlisted because SPV is not a listed company. You are not a shareholder, you are a unit holder. Please understand, what is this? Divide by 10 rupee. What will you create? You are not creating shares, you are creating units. Understand, if I buy Infosys shares, it is called share. But if I buy 10 rupee here, it's not called share, it's called unit. Not all units are listed in stock market. Like mutual fund. Is mutual fund listed in stock market? No. But mutual fund money is ultimately going to stock market. You can buy units, sell units. Here also you can buy units and sell units, but not in SEBI. It is not like share. These are units. That's why name is debt securitization. You're converting debt. Correct? These people came with loan, but you converted it to securities. But security is not share. Security is a big definition. Bond is also security. Share is also security. Unit is also security. People are not buying for 10 rupees to get appreciated. People are buying to earn interest on 10 rupees. This is more like bond or debenture. These are going to give you interest. Yeah. Yes. Finance and operating lease. They can ask you short notes on only one thing, or they can ask you difference between the two. Pay attention. First, finance lease. Risk and reward incident to ownership is underlined passed on to lessee. The lessor only remains underline legal owner. This side, lessee is only okay. We'll do one thing one by one. I'll discuss. When they say risk and reward incident to ownership is passed on to lessee only on paper, lessor remains the legal owner. Let's take an example: A and B. A is the owner of the asset. B is the user of the asset. They sign a lease agreement. Now, once you sign a lease agreement, he is called lessor and he is called lessee. For our discussion, A and B. Okay, follow this. Now read first line. The risk and reward incident to ownership is passed on to Mr. B. Correct? In my example, I am using B. A will remain as legal owner only on paper. That means once A gives this asset to B, tomorrow if the asset needs to be repaired, asset is not working, asset is not in good condition, the headache is B's headache, not A's headache. Only on paper, A will remain as owner. Able to follow? Sir, why is it so? You will get to know. Second, the lessee will bear the risk of obsolescence. Obsolescence means an item becoming obsolete, not in a usable condition. That means what if asset stops working after 3 months of lease? That headache is Mr. B's headache. That is not A's headache. Continue. Third one, lessor is interested in rental, underline, not in the asset. What does it mean? He may say lease period is 3 years, 5 years. 3 years later, he is not interested in taking that asset back and giving it to one more lease to one more person. Asset is in horrible condition, he is not bothered. All that he is bothered is how much of rent I can earn. That means he's not going to understand my wordings. He's not going to release it. That means I first sign with him 3 years, then take it back, again give it to her 3 years, again take it back, again. This I won't do. That's what they said. He's interested in earning the rental income. He's not interested in quality of the asset. Read. He must get his principal back along with interest. Therefore, lease is, please underline, non-cancelable by either party. What is the meaning of non-cancelable? Once you sign lease agreement for 5 years, after 3.5 years, if B says asset is slow, it's not working properly, it needs to be repaired, take the asset back, cancel the lease agreement, I won't pay you rent from tomorrow, these things are not allowed. That's why they said non-cancelable. Next one. The lessor enters into a transaction only as financier. He, underline, does not bear the cost of repair, maintenance, or any other operations. He says repair, maintenance, everything, overhauling, any spare part, small thing has to be removed, change, etc. Mr. B, you do it. I am not interested in keeping that asset also in good condition. Sir, then Mr. B only can buy it directly from the market. Why are you taking it through A? Please understand these assets are very costly. If asset amount is 100 lakh and B has no money but he wants that asset, then what is the way out? Only thing is take it on lease. That's why the wording A here is only like a financier. Why did they say financier? He has money but he's not interested in that asset. He will pay money, purchase that asset, give it on lease. After that asset is working in good, bad, slow, fast condition, he doesn't care. All that he wants is, I've invested 100 lakh, I should get back 100 lakh in rentals. After 5 years of lease agreement, asset is in bad condition also, he doesn't bother because all that he wants is get back the original investment. If B had so much money, why lease? He can directly purchase it. A has money, B has no money, but B wants that asset. The only way is take it on lease. It's like why I am staying in a rented house. I can only buy. If I have money, why will I stay? Correct? Somebody had money, they have a house, but I need a house. I can't buy or I can't construct. Stay on rental basis. Next, the lease is underline full payout. What is full payout? A single lease will repay the cost of the asset together with the interest. I told you A has invested 100 lakh rupee and he has signed a 5 years lease agreement. He will make sure that he recovers entire 100 lakh within one single lease in 5 years. Then I'll just take one example. He may keep 3 lakh rupee as monthly rentals. Now what happens? 3 lakh into 12 months, every year he is earning 36 lakh into 5 years, easily 1 crore plus, which is more than 100 lakh, he would have recovered. In addition to principal, he'll also collect some profit. 5 years later, now you tell me, even if asset is in bad condition, why is he worried? He anyway got back his 100 lakh plus extra money. Understanding? You know, in these kind of cases, one more thing will happen. 5 years later, anyway, he's not interested in asset. Sometimes he may even give an offer to B. B, do one thing. You pay me another 10 lakh, you only keep the asset. Anyway, I am not interested. Anyway, I'm not going to release it to somebody. Correct? But if I want to do that, then that lease is called this side operating lease. Now you see exact line by line, everything looks opposite. Here what are they saying? The lessee is only provided the use of the asset, risk incident to ownership belong fully to lessor. Now A is the owner, gave it on rent to on lease to B, but asset good condition, asset should be in usable condition, reusable condition, all that headache will still be on Mr. A. Read, the lessor will bear the risk of obsolescence. That means if something goes wrong, it is a loss of lessor and not of lessee. As the lessor does not have difficulty in leasing the same asset to other willing lessee, the lease is kept, underline, cancelable. Tell me, why did they say cancelable? Observe my wordings. He invested 100 lakhs. He gave it for 5 years. 2 years later, Mr. B says, I don't want to continue. I will cancel it. He says, okay, good, let's cancel. because anyway this guy want to do what again? Release it to another person called C. Maybe some repair maintenance to be done. We will redo it. Maybe we repaint once again, and then again I can give it for 3 more years or 5 more years. That means this guy is not only interested in rental, he is also interested in the quality of the asset. Any repair maintenance, if the machine is not working, B can't do repairs. He should call A and say, machine is not working, please send somebody for repair work. Now A will only send the people because he's interested in the quality of the asset. Correct? Just take one small example. Suppose in my house, in your house, there is a function and we need some pendal and chair and all of that. Now when we take that chair, are we taking it on finance lease or operating lease? Operating lease. 2-3 days we will use it and return it. Now don't you think that chair owner is interested in the safety of the chair? Because after that he can give the same chair to someone else. Now if chair is not working properly or chair is not in good condition, will I, who is the host of that function, will I sit and do the repair work? No, I'll call that guy. Please come and change the chair, or else come and do the repair, because I am not the owner of this. You should come and do all of this. Understanding? Next one. Usually lessor will bear the cost of repair, maintenance and operations. Just now I told you, if the asset is not working, B will not hire any specialist for repair. B will simply call A and says, you please send your team members, the machine is not working. It is not his headache. Yeah. Last one. The lease is usually non-payout, since the lessor expects to lease the same asset again and again to many users. That means if he has invested 100 lakh, he is not planning to recover full 100 lakh in single lease. Even if he gets back 40 lakh, it's okay to him. Why? Because he is going to again release the same asset to one more party. Now one more party, another 40 lakh, one more party, another 45 lakh, one more and so on. That means you can do this for maybe 20-25 years if asset is in good condition. That is why even he is equally serious about asset being in good condition. Able to follow? Lot of big companies, even biggest of the biggest companies that you know, they take asset on lease. They don't have so much money. Now think about it. Which airline manufacturer you know? Aircraft manufacturer. Indigo doesn't make those flights. Yeah. Who makes those aeroplanes? Boeing. Any other company you know? Heard of Airbus? Yeah. These are the two big companies in the world, Airbus and Boeing. I think this is the correct spelling. Sorry if I am wrong. Anyway, Airbus and Boeing. Now, if Indigo requires one new aircraft, they say, okay, buy it from us, 125 crores. Correct? If a car itself is costing now almost 10-12 lakh, bus is costing almost a crore, surely flight will cost you 100-120 crore. Now, two possibilities. Indigo has money, they will buy. Or if Indigo has no money, but they want that, then the best option is go for a lease. Now tell me, when they take it on lease, two varieties possible. If they say I need this only for 3 years, now Airbus is interested in keeping the asset in good condition, because that same asset can be released to some other airlines later. But if they say I'll take it for 30 years, then it can be a finance lease. Now Airbus says, okay, take it and no cancellation. 30 years you should only keep it in good condition, all your headache. I'm not bothered. Every month you give me so much of rent. One big trouble that Indigo was going through in the 2024-25 financial year, hopefully this quarter they may not have this problem, was this itself. They had lot of assets, or most of their assets are on lease, and that lease rentals are fixed expenses. Now imagine something like COVID lockdown happens. What is the big problem for Indigo? Rentals won't come down. Correct? Passengers are zero, revenue is zero. But then you'll still have to maintain that. Even if it is parked in an airport, for parking there are charges. That parking also has charge. It's not that I'll park somewhere and there's no other cost. Even if you don't use it, that basic maintenance has to be done. If my bike, your bike has to be maintained every week, even if you don't use it. People keep saying, if you're not using it, at least start once and move around for half kilometer and keep it. If our bike requires that maintenance, then flight requires lakhs of rupees of maintenance every month. Yeah. One car monthly servicing today, not monthly, when once in 2 months, if you go, car servicing is costing 5 to 8, 10,000. Premium cars, accordingly, everything is premium. By the way, BMW, Benz, maintenance itself is around 40,000. Every time you go for regular washing, cleaning, and service, cost you so much. Then you can imagine how much is the cost of maintaining these aircrafts, right? So, one big challenge Indigo has is high fixed cost. And what are the high fixed cost? The lease rentals. Second, the maintenance. And if you include non-cash, then the depreciation. Then fourth is a salary that you pay to all your staff, the pilot, the co-pilot, the staff members, and all of that. And that parking charges that you will have to pay irrespective of number of people traveling. And then you have to take the license from government. All these are fixed in nature. Hardly anything is variable for them. Imagine a 300-seater flight, 299 are seated or 300 are seated. Because of this one extra guy, what extra they spend? Flight is anyway going, whether that guy is there or not. Just like bus, correct? 45 passenger capacity, 40 are seated. Plus one happens. What extra they spend because of these two extra people? Literally zero. Bus is anyway going. Toll charge is not based on number of people. Driver salary, conductor salary, maintenance, all of that. Same like bus, even in aircraft, the biggest challenge for them is fixed cost. During lockdown, if you have time today, just check their share price. Fell down drastically. Obviously, because when revenue becomes zero, variable cost is zero. Anyway, it was zero before lockdown, after lockdown. But your fixed cost is in hundreds of crores every month. And that will not come down. And if you remember, during lockdown, couple of months they did not allow. Then they allowed only half capacity. If one person is sitting here, one has to be empty, and so on. Whether it is 50% capacity or 100% capacity, fixed cost is not going to change. Correct? And number of travelers were also less. Even when you allowed that one seat gap, people did not travel much. So almost if you count 1 year, 1 year fixed cost is their big loss. And they would have easily taken 2-3 years just to recover that loss. Even if you make profit, your loss is so much that you can't recover all the loss in immediate next year. That is one reason when you buy stocks of these kind of companies having high fixed cost. And by the way, Indigo is not a bad company. In India, 63% of people who travel in flight, they travel in Indigo. More than half. It's not monopoly. Balance is only 37%. Okay, we'll do one thing. You tell me which are the other airlines that you know other than Indigo. Vistara. Okay, next. Only Vistara. No. Indian, domestic. Air India, later bought by Tata Groups, correct? Actually went back to Tata Groups. It was their business longer. Okay. Vistara, Air India. Any other you know? Akasa Air. SpiceJet, do you know? In some trouble now. Any other that you know? Kingfisher is not there. RCB fans know what I'm talking about. Kingfisher Airlines, not there anymore. Anything else? Domestic, Indian companies I'm talking about. Now you know, it may not be even 63, it is higher than 63. Yeah, because number one, flights are less, not very popular, and so many flights, approximately, not exact number. Bangalore to Delhi, if you count it as one flight, one journey, they call it as one flight. In a year, Indigo does 7 lakh flights. Okay, Bangalore, Delhi, Bangalore, Chennai, same day. All places, all put together, full year, they do 7 lakh flights. In COVID year, if they do 0 also, their fixed cost won't come down. This is the headache. Yeah, when you do this much into number of passengers, into ticket, revenue is a big number. Even if it's not 300, even if you take 200, even if you take 5,000 average ticket plus food supplied and all the other things, their revenue stream is very high. But then the problem is, if your revenue is zero, your fixed cost will not be zero. Yeah, one good stock, if you want to invest in long run, follow Indigo stock for first 6 months, understand their demand, supply, profit, loss, P&L, and you see which quarter they perform well, where the loss is happening. They also have international flights, not just domestic. But this is a market leader as of now, 63% market share, almost two-third out of three people, two are in Indigo. Not a small number, right? There is competition, but with 63%, you are much ahead in the competition. For that competition to be happen, you should be less than 50. All other small are also not crossing 50. As of now, all small, you gave me 4-5 list, all of them together is 37. That means their shares is what, 3%, 8%, somebody 11, somebody 2. Alone Indigo is 63. All total is 37, not two competitors. There are 5 others. But even such a big company, if the fixed cost is very high, they are in trouble. Therefore, either they invest 125 crore and buy it. If they cannot, then they take it on lease. The moment they get into lease rental becomes their additional fixed cost. Yeah. Next, sale and lease back. Read the wordings. Sale and lease back. Read this. I'm writing 2 other names, P and Q. Q has one machine. It is worth 10 lakh rupee. But he wants cash right now. Sir, sell the machine. If you sell the machine, cash will come, but tomorrow what will you do in the factory? You want to continue your factory, but you want 10 lakh cash. So what you do? You do the heading, sell and lease back. That is, you first sign one sale deed between Q and P, as if Q is selling the asset to P. And then immediately, 1 hour later, sign another agreement as if P has given the same asset on lease to Q. From tomorrow, you will have to be paying lease rent. Sir, what is the advantage of this to Mr. Q? He got that big money right now. Correct? And then asset is still continuing. From tomorrow, factory will operate anyway as it is. And you don't have to even worry about quality of the asset, good or bad. Till yesterday, you are using that machine. You know how good the machine is. And you know reality. Actually, no movement of machinery will even happen. Machinery will be there only. On paper, they sign. As if I sold. As if they gave it on lease. This will be 10th January. That will be 11th January. Both will be signed together. So on paper, it sounds like, okay, I gave it to them and then they gave it back to me. Why should I simply send it to her office and then get it back? Let it be here only. We will on paper just sign. See, in textbook also they have given, look at this. The asset is not physically exchanged, but it will happen in records only. You first sell and you then lease it back. Please answer, what is the use of this to Mr. P? Why he should do this? He will get rentals from tomorrow, but he should be ready to invest 10 lakh. But good news is, machine is already there, customer is already there, and he is in desperate need. Now when Q is in desperate need, you can bargain also. Not 10 lakh, you say maximum 9.2 lakh, otherwise I don't want this deal. Now you know Q is in desperate need of money, you can bring the price down and then rent it to him, and monthly you will get the rentals also. You have a ready client, ready machine, ready paperwork. You just have to sign 2 papers, and if the cash is with you, then Mr. P can do. Otherwise, what is the deal? P has to first go to manufacturer of machine, pay 10 lakh there, purchase that machine, and then find out who is ready to pay, take it on lease. Then find out that person, then sign the agreement. But here ready client is available. Very easy deal for him. Correct? Q is there, machine is there. If you have amount, then no movement also. Only movement in paper. In reality, asset will not even move. Very convenient for Mr. P. The main advantage of this is that lessee can satisfy himself completely about the quality of the asset, and after possession of the asset, he can convert that sale back into lease agreement. Now, the Mr. Q, the lessee also has no worries whether asset is good asset, bad asset. Tell me one problem in Indian second-hand car sale and buy market. This is the worry. In India, second-hand car sale is still doubted by more people. People won't trust easily. Tell me what is the challenge there? The seller will not reveal everything. Seller will say best vehicle only. He knows all the problems, but he will never see. How will buyer decide whether asset is in good condition or not? You can get it checked by somebody, etc., etc. But then also there is something that the original owner knows which he will never reveal. Correct? You can do all the testing, but there is always that one thing that seller will never reveal, and that is where these companies have come into picture. I think Maruti and these companies have this resale outlet also. They do the health check of that vehicle. If it is good, then only they will ask the buyer to buy it. Now at least you have one layer of trust. You're not trusting the seller, you're trusting one car dealer. But again, people doubt, what if he has given some extra commission to these people to say that it is good asset? Correct? This is a problem. Same thing happens even in the world of lease. If I do not know the seller of that machine, what is the guarantee machine is in good condition? He will definitely say machine is good condition. Who will say my asset is bad condition? Right? You can get it tested by some expert, but then also there are hidden problems which only the seller knows. Tell me honestly, those who own bike here, there are some problems of your bike which only you know. Am I correct? Yes or no? If your friend is tomorrow planning to buy it from you, 99% chance you will not reveal it. You will say best buy. Don't worry. This is like life partner. I've never used a better bike than this. No problem at all. 100% guarantee. Anything you call me. Seller shows that confidence despite knowing that at some points it will give you the trouble. Therefore, the trust is never built. But if you have this sale and lease back, Q will never have a problem because he himself was using this asset from all the years. 3 years, 4 years he has used the asset. He knows how good that asset is. So instead of buying from a random Mr. J, where you can't trust the quality of the asset, you have the asset with you, no problem with that trust also. Right? Next one. Leveraged lease. Leveraging means taking some risk. Correct? Leveraging involves some element of risk. Let me write a small example. In the last page, I want you also to copy this. Listen, there is Mr. A. He wants to be a lessor. There is Mr. B. Wants to purchase an asset on lease, lessee. Now, asset will cost 100 lakh rupee. Don't copy, I'll tell you when to copy. Problem is, A has a customer readily available, but A has no money with him right now. So what he does, he'll go to a bank and ask them to give loan. Now, if bank gives loan, then Mr. A will buy the asset. That asset he will give it on lease to Mr. B. But if Mr. A goes to bank and says, I want money for purchase of asset, bank will ask, what will you do with this asset? If A says, I will lease it to somebody and earn lease rentals, then you know what SBI says? Make us also a party in that agreement. Yeah. Your EMI is 3 lakh rupee. You give this asset on lease to Mr. B. If the lease rent is 3.5 lakh rupee, ask B to pay us that EMI. You take the balance money. Able to follow? Yeah. Now, because of this, SBI is also in a kind of safe position because they know they are also party in that agreement. Now their signature is also there. It's not only A and B. Now Mr. B, he was anyway ready to pay 3.5. Instead of paying full 3.5 here, he will pay some money to the bank and some money to Mr. A. And now again, this will be a kind of secured loan given by SBI because that machine itself is a security. Anyway, it's against an asset. Tomorrow, sir, what if Mr. B runs away? Anyway, asset is there. Correct? A runs away. No problem. Anyway, bank is getting their EMI. In a way, bank is also playing very safe here. I am ready to give you loan, but in that lease rent, I also need a share. In textbook, they have given 80%. That means 80% of lease rental will go to bank. The balance will go to the lessor. Correct? You answer. What is the advantage in this deal to Mr. A? Why is Mr. A doing all this? Three parties, correct? You answer. What is the advantage to Mr. A? He wanted 100 lakh rupee. Now, bank gave him 100 lakh rupee. That means his investment is almost zero. Correct? But tell me in reality, will bank give you full money? No. If you want an asset for 100 lakh, SBI says, I will give you 80 lakh. You add your 20 lakh. That means the amount will be shared in the ratio 8:2. Now, if lease rental is 10 lakh rupee, the EMI will be 8 lakh and then the 2 lakh will go to this person. Why is it called leveraged lease? What if B is not paying rent? Tell me now, what about the EMI? Who should pay? Mr. A should pay. You know what will A do? If B is not paying, A will have to go to the office of B and take the asset back, and you find out some other lessee and earn rental income, but SBI wants its monthly EMI to come without fail. That's why the name is leverage. Leverage means advantage. And that advantage comes only if you take some risk. What is the risk? This is the risk. If B runs away, A will have to pay EMI. From where will he pay EMI? He has no money. He has to find out some other guy and lease it and earn the rental income and give it to SBI. You know, when will this whole deal work very, very smooth? If B properly for 5 years pays all the rentals, some portion to bank, some portion to A. Sir, one day this loan will get over, no? Correct. After that, entire money will go to A. If loan period is 5 years, asset life is 6 years, the 6th year, entire money will go to Mr. A only. Able to follow? Quickly write down. 3 parties, 1 bank, 1 lessor, and 1 lessee. All 3 are part of the agreement. One by one. SBI will give loan to A. A will give asset on lease to B. Correct? B will pay some amount to SBI and also some amount to A. If the asset purchase was in 80-20 ratio, then lease rental also will be shared in 80-20 ratio. And one thing all of you should know, anytime you want bank loan, keep in mind, you want to buy a site of 40 lakh, you will never get 40 lakh loan. Never. No businessman, no asset purchase will be funded 100% by bank. They say you first bring your 20%. 40 lakh site you are planning to buy, at least 8 lakh you should have. Balance 32 lakh, we are ready to give you loan. On that you pay EMI. They will never fund 100%. Always keep this in mind. No businessman will ever get 100% loan. Read what did they say here. The lessor borrows a part of purchase cost, say up to 80% from a third party. Now, third party in our example was SBI. Lender, and the asset so purchased is held as security. That means that machinery itself is a security for this loan. And lender is paid off from the lease rentals directly by lessee. Mr. B was paying directly some amount to SBI and some amount to Mr. A. And the surplus after meeting the claim will go to the lessor. Once that EMI loans are cleared, after that whatever lease rentals are to be paid, that will directly go to Mr. A. Correct? B will pay to A. Now SBI is no more involved. Understand basic thing. Loan may get over in 5 years, but lease agreement may be for 6 years. Then that 6th year lease rental, why should SBI get anything? All that money will go to Mr. A, the original lessor. You might have seen this board. There are a lot of companies which do this only. They're called leasing companies. Have you seen this board? Some A, B, C, leasing corporation. Their name ends with leasing corporation, leasing companies. They are into only this. Like SBI, I told you, they will fund people who want to do lease arrangement. And their EMI comes from lease rentals. Yeah. Tell me, what is the one risk involved in this whole story? If B is not paying rental, then Mr. A has to pay that EMI amount. That is a risk taken by him. Yeah. Now, by the way, what is the advantage to Mr. A? Without investing 100 lakh, just by investing 20 lakh, he is part of this deal now. Correct? Otherwise, he had to bring another 80 lakh and there was no possibility. So, he is making advantage here. That's why he has to take the risk also. If B is not paying rental, headache will be shifted to Mr. A. Sale, aid, lease. Here, okay, listen to this. You don't need to copy this. There is one big company which makes machines, machine manufacturer. And lot of individual companies go to them at random dates, different time. They are not connected to each other. All these people go there and ask for one modification in the machine. This company makes 1000 units of that machine. But one company, A Limited, they said, can you give me the machine with this modification? Now they say, boss, our production has a flow. Just for your one machine, we can't change the flow, separate spare parts, separate labor, separate training. We can't do for 1, 2, 3 like this. Okay. Deal did not happen. 1 month later, another company will come. They also go and say, I need to buy 3 machines, but I want one modification. And they also say the same modification. But now A Limited has gone back. He would have found out some other guy. Again, this machine manufacturer will say, no, I can't do the modification for 3 units, 5 units, 8 units. Like this, there may be many companies who want a similar modification. But if they go one at a time, machine manufacturer will never change the original design. So what happens? In between, there is one lessor. All these guys will go and tell him that I want the machine from this, but with modification. He says 3 machine, he says 7 machine, he says 1 machine, he says 1 machine, one more guy, 1 machine. Now what happens? This lessor now has a big contract of 15 machines or 25 machines or 35 machines with modification. When he goes, he can bargain hard now. One, you are buying in bulk, you get good rate. Second, when it is 35 machine, even this machine company will agree. When 1, 2, 3, 5 go and ask, it will not happen. If 35, 50, 80, 100 is asking, they will surely do. Correct? Now the challenge is, based on this 35 machines will be modified by this company and then they will sell it to lessor. After that, if lessor cannot sell it to these people, that is not machine manufacturing company's problem. They say, boss, we don't know who are these people also. You signed a deal with us. You pay money in advance, we will make it as per the modification. After that, if these guys come back and say, I need one more change in the setting, we cannot. That is why it's called sale, aid. Read this. A lessor will enter into a tie-up with the manufacturer for marketing his product through his own leasing operation. They say, sir, you make 35. I know how to sell it. I will get it sold. If they are not able to buy it, I mean, if B, C, D, these companies are not buying, that's not your headache. That's my problem. I will take care of it. Now, in a way, you will have 965 machines of one style, 35 machines with modified version, the machine manufacturer. And you don't have the headache anyway. The lessor has said that he will find out people and he will do marketing, he will go and purchase. So out of 1000, 2, 3, 5, 10 modification may be impossible, but 30, 40, 50, 130, 140 modification is possible. Yeah. Last, close ended, open ended. Pay attention. A and B sign an agreement, lease agreement on say 1st January 2025. 5 years lease. 1st January 2030. Please answer. Lease is over. Today is the last day. We are standing here. What will happen on this day? Asset is still there. Lease period is over. Tell me ideally what should happen. Can I continue using this asset from 2nd January? Can Mr. B use it? No. What should happen actually? B should return the asset and stop paying rentals. Now, if it is close ended, what will happen on 1st January 2030 is also there in a paragraph when they sign the agreement on 1st January 25 itself. Two possibilities. Paragraph may include this point saying what? B will return the asset to A without any comma, full stop, over. Second possibility, B will pay additional 5,000 rupee and he will keep the asset from there forever. What will happen is decided. But if they say open-ended lease, you know what they include in that paragraph? A and B will mutually discuss and decide what to do on 1st January 2030. That means what will happen on that day, that option is kept open. Now what may happen? B may say, take the asset back. A will say, okay. B may say, I will pay 5,000 extra. I'll keep the asset. Then A may say, no, not 5,000, pay me 7,000. Let them negotiate and decide at that point of time. That will not be there when they sign the agreement on 1st January. That's why name itself is open-ended. Anything may happen. What if asset is in not usable condition? B will give it to scrap dealer. Why should B return to A and then A will give it to scrap dealer? Correct? Therefore, all of this will be entered in the agreement. If you don't enter that paragraph, then it is called as open-ended lease. What will happen on 1st Jan 2030? We will decide on 1st Jan 2030. Now tell me, if asset is in a very, very, very good condition, what may happen? A will say, return it to me. Because he can do some more repair, modification, give it to lease for 3 more years. But if asset is in a not so good condition, then he may offer to B, pay me another 5,000, you only keep the asset. But that they can't decide on 1st Jan 25. So they will keep the option open. Decision will be taken on 1st Jan 2030. Done. Open-ended, close-ended. Simple to understand. Anyone is staying in a leased house? I don't know other cities, correct me. But in Bangalore, we have this practice. Not only rented house, you can stay in a leased house also. Other cities also have this house on lease. They have. Okay, where else? Hosur. Okay, it's a common thing. Anyone here who is the owner of the house given on lease to somebody? You are the owner. That's okay, sir. Your father means you only know. Okay, your family is the owner. You have given your house on lease to somebody. For how many years? 3 years. Okay. What will happen after 3 years? Okay. This is called close ended. When he knows after 3 years what's going to happen, he said money will be repaid and we will lease it to someone else. That means option is not open. What happens in an open ended lease? They'll say we'll discuss that time. We'll see. Maybe same person can continue for 3 more years, but that option should be kept open in the lease. It depends. Two varieties. Some people mention that I have seen some houses in Bangalore 10 years lease. Now 10 years lease, 10 years later, what to do? Difficult for people to decide sitting today. It may sound easy, but practically, who knows what's going to? Can you visualize yourself 10 years from today? It's very, very long time actually, 10 years. That time, real estate market, demand, supply, you may want to demolish that house if it is old one and construct a new. You may have 100 thoughts in your mind. 10 years is actually very difficult to make a prediction. 3 years at least there is some certainty. So if you keep the option open, we call it open ended. Yeah. Lot of companies buy computers, laptops, everything on lease nowadays because they don't have big money at the starting point. So they take it on rentals and then again open ended. They have an option. Use it for 3 years. After that, pay one lump sum amount. Then you can become the owner or else return the asset and take the cash back. Both varieties depends on what type of clauses are there in the agreement. Anyone else owner of the asset who has given on lease? No. Anyone staying in rented house? Okay. Anyone is the owner of a house who has given it on rent to somebody? Same or one more house? Okay. Some houses are on rent, some are on lease. Huh. Now tell me, in rent, is there any doubt what will happen after rent agreement? No doubt there. You have to leave and go. In lease, you have an option. You can pay some lump sum and ownership may get transferred. I told you, depends on whether machine is in good condition or bad condition. So there is no one answer whether all agreements are open ended or all agreements are close ended. It depends whether you want to keep an option open or you want to have it pre-decided now itself. Some people you don't know, not talking about him, there are a lot of people who are very clear. 3 years later, I don't want this tenant to continue. I want to change the tenant every now and then. Some owners don't like same tenant also. They somewhat like changing the tenants. You know what I'm talking about. Some people don't want same tenant to continue. And there are some people who want same tenant to continue for 15, 20 years. They don't want new people. And this family is good. We don't want to change. Yeah. I am staying in a rented house. Before I came to that house, the previous tenant was staying in that house for 21 years. Okay. I was there when we were about to sign the rent agreement. The shifting and all was happening. Owner and I saw this. Oh, nice. Never thought all this will happen. Owner and tenant, they were crying. Now, 21 years if you stay and first floor is owner, ground floor is rented. So they know each other now for 21 years. Almost they have become family. I was about to say, why don't you adopt this family? And who am I to say? So I kept quiet. There are both variety people. Some houses, they don't want to change. 21 years and tell me what is one practical problem of keeping same tenant for such a long time? Think practically. Same tenant in the house where I am in that house now from last 3 years. Okay. What is the practical difficulty if you keep same tenant for very long time? You can't increase the rent so easily. Because if they become kind of close to you, every time you can't change it. Even if you change 5%, 8% only. But if that tenant goes, new tenant is a stranger. You can start bargaining on a much higher amount. Understanding? This is one challenge. But some people feel, okay, it's fine even if we don't get big rental increment. But we don't want to trust stranger people so easily. Therefore, some of them are okay, some of them are not okay. This is where your open-ended helps. You can decide 5 years later what to do. Like rent, even lease. But if that tenant is not a good tenant, then you will have a problem. You want him to leave, correct? But if that person leaves, then you lose rental income. Now, luckily, with all this no broker, magic bricks, and all of that, finding a tenant has also become easy. For tenants, finding a house is also easy. Imagine these were not there, then it would be a problem even to fight with tenant and remove him. Then new guy won't come that easily, and for 6 months, 7 months, if you keep the house vacant, even if you count say 20,000 rent, for 6 months you're losing easily 1,20,000 rupees. If somebody stays there, you don't pay anything extra. But if somebody stays, you earn 1,20,000. When it's a rented house, they pay electricity bill, they pay water bill. What do you pay? Nothing. Only once you have paid. But as I told you, both variety. Therefore, open-ended is preferred for those people who can't decide whether same tenant should continue or not. Have you noticed most of the petrol bunks, they don't change location so easily. Most of the landmarks in Bangalore are petrol bunks only. You'll find one petrol bunk, take right there. Because from 25 years, it's a petrol bunk only. Even if that Indian Oil goes, some other will still be petrol bunk. It won't become another hotel. Because all these, you won't believe, some of these are 25 years lease. Because they don't want to change. Because petrol bunk, what you see is only one part. Below that is the storage part. And that construction is a big costly thing. And if you say we will sign for 2 years, that petrol bunk owner has to spend so much money for storage and then leave. Now who will recover that money? It's a capital investment. Tomorrow if some hotel comes, they will use that for no reason. Why will they keep it? It's a waste of investment, correct? The storage cost is huge. That construction of underground is huge for them. Therefore, they say we will sign only minimum 25 years. That's why you notice from the childhood you have seen some locations there have been only petrol bunks, nothing else. Company may change, but petrol bunk is petrol bunk only because that storage capacity, that construction, that's a big cost. Even banks, some of you may notice this. That building is bank building only. SBI may go, HDFC will come, but bank building has not changed because most of these banks have one room called safety strong room. That strong room is for cash, and that is not built in the normal style of cement and concrete. They use some different variety stone and all that for that, which is not easy for others to break. Now, once you construct it, tomorrow somebody comes and says, I will convert it to one hotel. What is the use of that room? What will you keep there in a strong? And that strong room construction cost is much, much high. It's not the normal brick and cement. Correct? Therefore, even banks sign 15 years lease agreement. Owners also insist because we are spending so much for that safety room. If you leave after 2 years, that investment, how will I recover? So sign for minimum 15 years, and first 10 years you can't even cancel that lease. If you want to leave, you still have to pay 10 years lease rent and then leave. Because that strong room construction is very costly. Tomorrow some other bank will only come because even every bank requires for cash and gold storage, they need mandatorily strong room only. And the strong room entry exit is always blocked. You need some password and some pin, etc. Only bank employees have it. Such construction if you have done and it's much bigger wall than the normal wall, it can't be like a normal with a POP type, etc. is not possible. Imagine you keep gold inside and wall is not strong. So because owner has invested money, they will keep longer duration. Yeah, I have seen some of my clients building is also leased for 15 years, 18 years, 20 years. Petrol bunk is easily 25 years. They won't take it for anything less. So this lease period and whether it is open-ended or close-ended, that depends on case to case. Yeah. Yes. Let's continue. Short-term sources of finance. First one is trade credit. Now, when I say short term, easy to understand, repayment has to happen in less than a year, right? In months, 2 months, 3 months, and so on. Now, trade credit, when they say, if I am buying goods on credit, that person who is giving me goods and giving me some time to repay, Is he not indirectly funding me? Think, I repeat my sentence. I purchased goods, or okay, we'll start with this. Mr. A purchased goods from B, 10,000 worth goods. A has purchased, so A has to pay to B. B says, pay me after 30 days. Now tell me, can I say indirectly, Mr. B is funding A? How is it funding A? He purchased goods which are worth 10,000. Imagine if B says cash and carry only. Then Mr. A had to arrange that money. Imagine A had no money in his pocket. Then he had to take money from bank loan, that 10,000 rupee, then pay to B, then purchase. Now, because there is 30 days time, can I say indirectly, A is using B's money, not money, but goods worth 10,000 rupee. Now, what may happen? Follow this. You got 30 days time now. It's not cash and carry. You sold it after 23 days for 10,800 rupee. 800 is your profit. Now 30th day you will pay 10,000 rupee to Mr. B. Now don't you think without investing even 1 rupee from his pocket, A made 800 rupee profit? Think, where did he invest? He bought, he sold, he collected first, then he paid. He collected more, he paid less. The difference is his profit. That means his 800 profit he made without investing a single rupee. Correct? And imagine 23rd day itself he sold it and 30th day he paid. In between he had 7 days time also. He could have invested elsewhere. In 7 days if he makes another 3 rupee gain, then it is not only 800, it is 800 plus 3 rupee profit also. You know, when will the problem comes? If payment is to be done in 30 days, but you are not able to sell goods even after 30 days. Now suppose you are selling this on 40th day. Now the problem, 30th day B will call and say, please give me money, I waited for 30 days. Now A cannot say, please wait for few more days, I'm yet to sell. Boss, I gave you 30 days time, why are you asking few more days? And what if I give you few more days and then you again say few more days? Correct? Then B will not wait for so long. Correct? Sir, we'll do one thing. B, let him collect extra interest also. What do you think? Will A pay with interest? If he says pay in 30 days 10,000 rupee, if you delay 1 day also, every 1 day I will add 10 rupee interest. Think practically, will this work? You have not understood this problem yet. Give some money to your friend once and try to recover within 30 days. If not, add interest and recover on 31, 32, 33rd day and show that to me. That, sir, I collected money from my friend with interest. The day that happens, I will accept that B can collect interest. It is practically impossible. Classroom we can say, actually in the invoice, backside of the invoice, that the rate will be written. Payment must be made within 30 days, otherwise blah 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 interest. Many people don't even read that side. Forget calculating and paying. And you know, if A keeps delaying this, B will come to a point where he says, boss, forget 10,000, at least 9,500 you give, and once for all, I'll forget balance 500. Forget taking extra. Principal also you'll have to give discount to get back your own money. Or you appoint one agent to go and collect and again pay some money to agent to do this job also, to collect your own money. You pay another 200, 300 rupee. Some agents charge commission, 2%, 3% on invoice value. If invoice is 10,000, now another 300 rupee because agent has to be paid. Correct? Therefore, you reverse for a minute. If you have sold goods to somebody, okay, and that somebody, you gave them 30 days time and that guy is not paying, and today is 31st day, tell me, what will you do? What can you do? Think from reverse angle. What can you do? Call him 10 times, message, email, SMS, WhatsApp, everything. He is not responding. What next? No. Tell me practically, what next? What is the answer? What will you do? You are the seller now. Sorry, we'll go to his house and then do what? I know you can't say everything. It's okay. Say what can't be said in public. Those things you will say. Whatever you are imagining, that sentence, that word. Then also he is not giving. Now what? You'll say whatever possible, you at least pay off. This is what I told you. Forget taking interest. Your principal, original invoice value itself won't come down. Okay, if he is not even ready to pay that, you gave him an offer. Okay, 10,000 bill, pay me 9,000, I'll leave you forever. He says, I can't even pay 9,000. He's not coming out of house only, first of all. Talking is secondary. If he picks up phone, then you can shout at him. He's not even picking the phone then. And this is not a rare thing. Once you start a business of credit sale, this becomes a common problem. Okay. Any answer? Finally, what will you do on 31st day? Go to his house, shout at him. He will say, okay, 5 days time. After that also he won't pay. Now 36th day, 40th day, 50th day. Finally what? Finally pass bad debt journal entry. That's the last thing. Can we file a case to recover this money? Sale of Goods Act. Can we say we will file a case? Okay, if you file a case, what next? Court. That is step 2. Court. Now for that you need a lawyer and you have to go and then you spend money there also. And once it goes to court, whether it will get over in 2 months or 2 years or 20 years, who knows? And once you file a case and matter is in court, now you can't even go to his house and threaten him. Then he will file a case against you. Because then the matter is already pending in court. You can't try to do out of court settlement. If you want to do that, first take the case back. You can't talk to him. If you talk to him, he'll say, come to court, you have anyway filed a case, will answer there itself. And once the matter goes to court, there are hundreds, thousands of cases already. This is one very big practical problem. In Bangalore, we have a court. That court is only for commercial reasons, like the one we are discussing. Alone check bounce reason. Hundreds of cases are filed every single day. Only single reason, check bounce. I sold goods to her, she gave check. I went to bank, no money in her account. This is called check bounce case, right? And I file a case against her. Like this, hundreds of cases every single day. And what I'm talking is not even check bounce. Forget giving check, is not even talking to you. That means filing a case theoretically yes, but practically no. You know, on an average in India at any point of time, 3 crore 20 lakh cases are in progress. On any random day. Today also, this many are in progress. Sir, some judgments will come today. Correct. New cases will also be filed today. On an average at any point of time. These many cases are pending from Supreme Court till the lowest level of court that we have, from Taluk level up till Supreme Court. Yours will be one more. And judge has no reason to take your case on urgent or priority basis. One more check bounce case, one more customer running away case, one more non-payment case. Like this, there are hundreds and hundreds of cases. Therefore, in classroom, we can learn, we can write also legal action should be initiated. But practically, you should know legal action won't solve the problem. By talking to him, requesting, as madam said, give some concession, then take some money, cry, beg, do something. At least some money can come. But once you file a case, even that money won't come. And then on top of that, you have to pay lawyer fees also. That you minus from the invoice value. Yes. And court, you don't know. It may be 3 years, 5 years. 5 years later, if you get judgment in your favor, money would have lost its value by then. Even if you get 1 lakh bill after 5 years, it's not worth 1 lakh. And how many times you have to go to court, pay to the lawyer, and uncertainty. Nobody wants this. Therefore, trade credit from supplier angle, debtor when you are from a seller. Either way, when you see this delay, if you use 30 days and pay on time, both are happy. But you take 30 days and then 300 days you drag the matter, then next time you will never get credit from such transactions. Why will anybody trust you? Accrued expenses. Again, say this building. If I use the building for entire March from 1st to 31st, I'm paying rent on 1st April. Tell me, can owner come to, can I am asking, don't tell me agreement, it's not written, just a hypothetical question. Can owner say, every day morning, that day's rent you pay, then only open the door. Suppose we are paying 3,10,000 rent divided by 31 days, daily 10,000 rupee rent. If owner says, pay 10,000 morning 7 o'clock, then only I'll give you key, open the door, use it. Next day again, while going home, you give key and go. Daily rentals. Can they do so? Practically, no. Correct? If they start doing it, now tell me what happens. Every day, we should have that much cash with us. But now what is the scheme? 31 days you use, then you pay. Now don't you think we are keeping their money for 31 days? The tenant of this building is keeping owner's money, building owner's money for 31 days, because building owner could have said this. Morning you give cash, then only I'll give you key. Anyway, monthly rent divided by 31 days. Simple also, not complicated calculation. This building almost rent is about 4.5 lakh rupees. Now if 5 lakh is rent divided by 30, every day rent is about 20,000, 15, 20,000. Owner can always say, if owner is next door, I can always say, morning you pay, then only I'll give you key. Simplest way. But they say it's okay, pay after 30 days. Indirectly, we are using their building for 30 days. That means we are using their money for 30 days. In first example, I said we are using somebody's goods. Now we are using somebody's building. They are giving me time. Okay, we went to owner. Let's discuss this. And we requested one more thing. We can't pay rent on monthly basis. Once in 3 months, we will pay you. Okay. Now tell me, by dragging that to 3 months, are we of some advantage? Is it some advantage to us? March, April, May. Together we will pay on 1st June. This is our request. Imagine owner says, okay. Are we in some kind of a benefit in this deal? Instead of paying on April 1st, May 1st, now we are paying everything on June 1st. Even if we have money, if we get time, we can deposit in bank. We can earn 2% interest. Even if you say 0.5%, 1% a month, you can easily make about 1.5%, 2%. But we will pay same rent. Correct? Imagine another deal. Sir, full year we will use. Once for all, we will pay full year rent. If they agree, then now you know we have money on day 1 itself, but we will pay after 364 days. That means indirectly we are using their money. That's why it is under the heading source of finance. They're not giving their money, but they're letting us use their money, keep their money, and that money we can invest. Understanding? Remember, when it is money, if someone is giving you time and say you pay me later, it is as good as you took their money. Understand what I am saying? Suppose she is supposed to pay me 100 rupees today. If I say it's okay, don't pay today, pay me after 3 months. Now you know what I gave to her? Interest for 3 months. Because 3 months later, she will pay me same 100. For 3 months, she can deposit somewhere. Even if you earn 1% interest per month, she would have made 103, but she will give me only 100. She made 3 rupee using my money. That's why it's a source of finance to her. She is making 3 rupee using somebody's money. Last example on this. You are Mr. A. You have bought goods from B. 10,000 rupees. You have cash with you in your pocket. You thought it's a cash and carry deal. You went to that shop. They gave 10,000. You are about to, pay cash. That guy said, sir, we offer standard 30 days time to everybody. Now tell me, will you say, no, sir, take now only? Normally you won't say. Now tell me, you have cash, you have 30 days time, you can invest that. Even if you make 25 rupee return on 10,000, 1 month later you will pay 10,000 only. That means if someone is giving you time, they are letting you use their money. This 25 extra that you did is because of them, the guy who gave you time. Understanding? Advance from customer, same thing. Time given by creditor, reverse advance from customer. Customer gave money to you today and said you dispatch goods after 1 month. Now tell me, I am keeping his money for 30 days. 30 days later, I can call him and say, boss, sorry, I can't give you goods. Take the cash and go. Now we made interest in this 30 days period. Correct? Next one, market important. Commercial paper. Anyone knows what is commercial paper? Sorry. Commercial paper. No. Don't copy this. Easy way for you to remember. Commercial paper is like a debenture. But don't copy this. You can't write this in exam. Debenture is for long run. Commercial paper is for short run. Like debenture is issued at par, premium, discount. Commercial paper, same way. Debenture is redeemed. Commercial paper is redeemed. Debenture interest is paid. Commercial paper also interest is paid. Everything is same, but the duration. Commercial paper can be for a period of 14 days also, 21 days also. That means I take money today, I will redeem it within 21 days. But debentures are not like 14 days, 21 days. It's 3, 5, 10, 15 years. Read. Commercial paper is a short-term, underline short-term, money market instrument with fixed maturity value. Underline short-term. It is a, underline, certificate evidencing unsecured, underline unsecured, company debt for short-term maturity. It is, underline, generally issued at discount, but it can also be issued in interest-bearing form. I'll explain with example. CP can be directly issued by company to investors or do it via banks. These are always unsecured in nature. Listen. A Limited has sold a lot of goods on credit on 1st January. But all these customers, they wanted 60 days time. A agreed because it was a big order, big client, big customer, they agreed. 1st January, goods are sold. Now all this money will come on 1st March. All good debtors, they will all pay on time, but they have taken so much time, 60 days. The problem is A Limited would have purchased a lot of raw materials. They have a lot of employees. They have factory building, office, showroom. All these expenses are to be paid on monthly basis. Now last day of January, 31st Jan, all these expenses become due, payable. Now you can't tell your employee, please wait for another 30 days. Once customer gives money, I will give you salary. Practically not possible. That means now what is the challenge with A Limited? They know they will get money, but that will be after another 25-30 days. But they are in urgent need on 31st Jan itself. They will not go to bank loan, because if you go to bank loan, bank will take 20 days to check your papers only. You are in urgent need of money. That's when you issue commercial paper. They said short-term duration. Now what is the duration of this? Issued on 30th January, redeemable on 10th March. Now tell me, what is your scheme? You take money, pay salary and all of this, and anyway on 1st March you will collect from customers. That money itself you repay here. Correct? Now it's not that you have shortage of money forever. You have shortage of money for next 20-30 days. You keep a margin. Don't accept 1st March itself. Keep 5-6 days extra. So even if these guys delay, there is still no problem. They said unsecured. That means for this 25-30 days, nobody will give you any security. No land paper, building paper, nothing. It's more like unsecured debenture. One company did one wrong thing with commercial paper. Okay. Yes. I'm writing this. Follow. 1st January, I will issue commercial paper of 10 lakh rupee, redeemable in 20 days. That means 20th January, I have to redeem, means repay with some interest. You know what this company did? 18th, they issued one more round of commercial paper to be redeemed on 8th of next month, and used that money to redeem this one. Understanding? Now this becomes due on 8th. They issued one more series on 6th took that money, redeemed this. And now this 6 has to be redeemed on 26th, issued one on 24th, kept doing it. Now a short-term loan became a long-term loan. It is like take from him, promise within 20th day I'll pay. Go to her on 19th day, take from her, give it to her. Now 20th day I have to pay her, take from her 2 days before, pay it to her. Keep rotating this. Tell me what is the risk in doing this? That company is in big trouble right now. I'll tell you the name. You first tell me what is the problem of doing this. Previous session, I told you one thing about the rate of interest. When the duration of loan is short, the rate of interest is high. This is a very costly source. Correct? Following one. Second, if you keep doing this, after 7-8 times, the 9th time when you issue commercial paper to general public, they will know you are doing this every time. They will check your balance sheet. What if nobody applies to your commercial paper? Here, in this case, on 24th, when you wanted people to buy your commercial paper, no one purchased. Now we have 25th only, because 26th morning, this old one has to be redeemed. And in one day, you can't even take bank loan. Correct? And then you will request these people, wait 2 more days, 3 more days, and then I will. Once you do this delaying, next time nobody will ever give you loan, because they've understood you will delay. You know which company did this? Not exactly same thing, but almost something like this. Diwan Housing Finance Limited. If you have interest, read about it. DHFL, Diwan Housing Finance Limited. They kept issuing short-term debt after short-term debt only to redeem the previous one. 21 days, 20th day. Again 21 days, 20th day. Keep repeating. One, interest is high. At one point, if people don't buy your commercial papers, then how will you redeem the old one? And they could not. Not 1, 2, 3, 5 rounds. And then they kept asking their investors, wait, give me few more days, few more. They filed a case. Then the matter went to court. And then this company is right now in big trouble. I'll just show the news to you. Commercial paper. Again, commercial paper is a full topic in CA final. As of now, just able to read? Yeah? I'm just reading the news. According to a statement from rating agency, DHFL has 850 crore outstanding commercial paper. What is outstanding commercial paper? You have taken money, you are yet to repay. It is between the 21 days period. Out of it, 750 crore is due in June. And the first commercial paper maturity is on 7th June. And with liquidity inadequate. Liquidity inadequate means not having enough cash. As on the date to service this debt, visibility very low on timely fundraising. CRISIL, this is the rating agency which gives you your credit score, said it expects the commercial paper to be in default on maturity. What is defaulting on maturity? They will say we can't pay. Yeah, and that is what happened. On 11th May, CRISIL had downgraded their rating on DHFL commercial paper to A4 from A3, citing more than expected reduction in company's liquidity because of further delay in fundraising from sell down project finance loan. And then finally, that became a reality. DHFL defaulted 225 crore unsecured commercial paper. Defaulting means what? That day they told their investors, we cannot pay. Yeah, this detailed story here. Diwan Housing Finance Tuesday managed to meet 40% of 375 crore repayment commitment towards commercial paper, highlighting cash flow stress at the embattled mortgage lender. They could not repay full. They could repay only 40%. Okay, this is a problem that companies will face if they unnecessarily take too much of debt. Okay, commercial paper is good. Just now we discussed unsecured and all of this. This is CA final. You have one full topic on commercial paper, practical sums and all of that. As of now, you only need to know this much. Yeah, but DHFL is a good example of what you should not do with commercial paper. Yes. Treasury bills. Whenever you see the word treasury, easy to understand, issued by government. Now, when government is in need of money, like bonds that they can issue, they can even issue bills. Now, this will be again short duration. They said 14 days to 364 days. That means if government has to make some big investment or payment, but they know they will get money little later, then they take money from you and me. And with government, there is no risk, unlike DHFL. You saw their CRISIL, there was a rating system. You saw this A4 plus, A3 plus, etc. For you and me individuals, it's called CIBIL score. For companies, it's not called CIBIL score, it is credit rating. Triple A, double A, and then what you saw, A4, A3, and so on. And in India, NHAI is the one such government organization with best CIBIL score. They won't call it CIBIL score, they call it credit rating or CRISIL. There is one more organization called ICRA, again credit rating agency. CRISIL is quite common, and NHAI has the best credit rating. What is the meaning of best credit rating? They have never delayed repayment of principal and payment of interest. By the way, in this case of commercial paper, forget interest, principal itself they defaulted. By the way, even for the 21 days you have to pay some interest, correct? If principal itself they are not repaying, you know what would have happened to interest component. Some companies even do this. Instead of giving interest, they say issued at discount, redeemed at par. No interest given to you. That 2 rupee itself is your profit. Understanding? I'll issue at 100, redeem at 100, and then give you 2 rupee interest. Instead, I'll issue at discount, redeem at par. I won't give you interest. Anyway, you made 2 rupee extra. 2 by 98 into 100 is your rate of return. But that percentage is only for 21 days, not for per annum. So you will have good rate of return. Yeah. But again, one more challenge with commercial paper, the base amount itself is high. It's not 10 rupee, 20 rupee, not like share. Minimum 3 lakh, 5 lakh, 8 lakh, 10 lakh. So many small investors never invest in commercial paper. Yeah. Certificate of deposit, a saving certificate with fixed maturity, not less than 15 days up to a maximum of 1 year. More like keeping FD in bank, but FD is for longer duration. If it is for 90 days, 180 days, they call it as certificate of deposit. This is quite common. Bank give you advances in many ways. What I discussed now is not bank, correct? Treasury bill is government, commercial paper is market. This is from supplier, this is from building owner. Now what we're discussing is from bank. First one, simple to understand, short-term loans. They give you a loan with a condition that repayment should happen in 3 months, 6 months, 8 months. And we are discussing only short-term, not long-term. Long-term we discussed yesterday, 5 years, 8 years, 10 years, and all of that. Second is overdraft. I want you to tell me, what is the difference between loan and OD? I have 5 lakh OD versus I have 5 lakh loan. What is the difference between these two? You understood my sentence? I have 5 lakh OD. I have 5 lakh loan. How are they different? Which one? Loan. Loan is with security. Your second point is correct, but first point was not fully correct. In OD, do I get money? For example, I go to bank and say, give me 5 lakh rupee OD. Do they give me 5 lakh rupee money? Will they transfer amount to my bank account? If I go to bank and say, give me 5 lakh loan, will money come to my bank account? Understand, fundamentally that is the difference. When I say loan, money is transferred from bank account to borrower's account, my account. In OD, if I say 5 lakh rupee OD, they say, okay, sanctioned, What does that mean? I don't have 5 lakh with me. But when my bank balance reaches zero, if I give a check to somebody worth 5 lakh, bank will not say insufficient balance because I have OD. So OD is like a facility. OD is not transfer of amount. Please understand. In loan, I want 5 lakh loan, 5 lakh will come to me. I can use it however I want. In OD, 5 lakh is a facility added. That means when my bank balance is zero, I give a check to my suppliers. They go to bank. Bank will not say insufficient fund. Check will not get bounced because they know up to 5 lakh I can overdraw. That's why name is overdraft. I can draw more than what I have. One. Second difference is in loan, I take 5 lakh loan. I have to pay interest on full 5 lakh, whether I use it or not. In OD, 5 lakh is the OD limit. If I use only 10,000 in that, my interest is paid only on 10,000. I reach zero balance. I gave one check to somebody, 10,000 rupee. That means OD used is only 10,000. Interest is only on 10,000. There are many people who have OD but never use OD. Understanding what I'm saying? They have 10 lakh OD, but they never use OD because they never went below zero. The day you reach zero and you still have to pay something, that's when you touch that money. Otherwise, why do you want to use OD when you already have balance in your own account? Number two. Number three, is OD more like a credit card then? When I use it, then only I pay. If I don't use, I don't have to pay. And when will I use credit card? When I don't have money in my debit card. That is when bank balance is insufficient, but I want to spend. That is when I touch my credit card. Same way for business, overdraft is a backup facility given. You use your regular current account, but that current account has a 5 lakh OD facility. Even if you reach zero, you write check and give. We will consider that because up to 5 lakh rupee, there is no problem. And this OD has to be repaid within less than a year. That's why it is part of short-term funding. Yes. One question to you. If I have credit card, can I go to ATM and withdraw cash? Possible or 100% not possible? It is possible, but never do. It is possible, but I don't want anybody to do this. Now, if you have, please don't go after the class. Okay, the charges are very high. And you know what they do? Whatever you have withdrawn, they will convert that to a bill. And that you will have to anyway pay with huge amount of charges and interest. Then where to use credit card if I can't withdraw? What is the use of having credit card if I can't go to ATM? Can I book tickets, bus ticket, train ticket? Can I do using credit card? Cinema ticket can I? In hotel can I? Shopping can I do? That means credit card is meant for spending. They want you to spend more. So one way of that is even if you have zero money, you want to go and watch a movie, use credit card. So it is mainly to make you spend more. My suggestion, till you get the ability to earn your own income, do not use somebody's credit card, please. Because you do not know what happens at the end of the month. When we spend, we don't have a control. That too, if you have credit card with us. In debit card, once it reaches zero, we have to control. No question of getting tempted also, you can't spend because balance is zero. Phone Pay, Google Pay also, once it is zero, those apps won't work. But in credit card, if you have 3 lakh limit, if you reach zero, when you swipe card, you will not even feel because money isn't going that day. But if it is not your card, say your family members, parents' card is with you, and if you are swiping it, somebody has to pay that bill at the end of the month, right? And once you get into that habit of overspending, it is very difficult to go back to not spending. It's a very, very difficult habit to reverse, that spending habit. First of all, I feel, I don't know what is your opinion on this. With UPI, we are already spending more. Because of QR code, by default, unknowingly, we are spending more. Because earlier when 200 used to go from my pocket, I would feel, okay, so much is going. And same day, many times if I pay, evening I myself would control, enough now, I've spent enough money. On QR, that feeling doesn't come when money goes. Scan it, 200 goes, 20 goes, 80 goes, 50 goes. We have in a way lost the control on our expenditure. Ultimately, money is going not in cash form but in bank form. On top of that, if credit card comes to your hand, it's a very dangerous recipe for a disaster. So please, even if your parents have credit card, let them use. They know how to control spending, or they have ability to pay that bill. Okay, unless you earn, you should have a credit card. I have 3 credit cards. I use once in a month to keep it active. All three: HDFC, ICICI, I think SBI third. All three I use just so that I can get some points, coins, and all these benefits that you get for that purpose. And something, if I am booking something on website and if they say use HDFC card, you get 5% cashback, I use. Otherwise, I don't. That too, once in a month I've used. Second time I won't even use. And all three banks, I have 4 lakh limit each. Up to 12 lakh I can swipe. 4. But once you get into that excessive spending habit, it's a problem. Coming back is a problem. Starting is easy always. Yeah. Then you can't stop spending. So in a month, if I'm doing one bus ticket, I'll use one card. One cinema, another card. That's all. Once I do one, second also I don't want to do because I know the problem. Once I did not do for 6 months, then I got a call saying if you don't use it will get blocked and this and that. Since then I'm using. But all 3 cards together also I don't cross to 2,500 under any circumstance. You should have that control once you get into. If not anything, your TV dish bill you can pay through credit card. Wi-Fi bill you can pay. If I don't get anything to pay, I use this 600, 300, 200. I use, but I know to keep a control on it. The problem is many people don't know how to control that spending. Feels good initially, but month end it won't feel really good when the bill is to be paid. And what happens if you don't pay credit card bill? Your civil score will go down again. Correct? Next time if you want credit card, nobody will give you. And if you want some big loan for house construction or something, this will create a problem. Many times you have delayed, therefore your score is very low. We will not give you. So even my reason of holding a credit card is because if I need some big loan in future, my score will improve if I have a credit card. But that should not make me overspend. Same with OD also. Even if you don't have money, you can give check and bank will honor that check. They will not say insufficient fund. Yeah. Many companies have OD, but they don't want to touch that. Such an emergency situation, they use OD. Clean overdraft is given to those people, see this, financially sound and reputed for their integrity. Now, without much of questions, without much of paperwork, without security, some companies will get OD. Terms and conditions will be in their favor. Interest will also be less because their credit history is very, very good. Yeah, this is why it is important that if you have a credit card or a loan, you should maintain your credit score. Otherwise, in future, if you want loan, it will not be very easy. Cash credit, almost similar to OD, but the only difference is they can restrict on purposes of usage. Imagine one bank offers me a credit card with a condition that this card is usable only for online shopping and nothing else. Now, what is the difference between other credit card and this credit card? Usability. Where I can use, what for I can use. Some banks give you OD facility and say with this money you can do anything. That 5 lakh OD, you can purchase machinery, you can purchase furniture, you can pay to supplier, you can do anything. But some banks give cash credit and say this should be used only for supplier payment, nothing else. That means they put a condition on what to use it for and what you should not use it for. If the condition is added, then you cannot violate the condition. Yeah, some places there is no condition. So otherwise there is no much of difference between OD and CC. Advance against goods. Name itself tells you. You will get some loan by giving goods as a security. Goods as in inventory, RM, WIP and FG. Now, see this. They may be agriculture commodity, raw material, partly finished means WIP, work in progress. Bank will sanction loan against these goods. I need loan. I have too much of stock sitting in my warehouse. Give that itself as a security. But tell me, there is one danger when bank gives these kind of loans on inventory. Any movable asset, if that is given as a security, then there is a chance of loss of that asset. Correct? Destruction, accident, theft, anything can happen with RM, WIP, FG, plant, machine. But if it is immovable property, like you give land paper, house paper, then bank is also in a less risky position because they know there is very less chance of something going wrong. That is another reason why housing loan rate is cheap, because the security given is an immovable property. But if it's a vehicle loan, best example, I take a vehicle loan and then tomorrow I cry vehicle is stolen. If I have insurance, to some extent I am safe, but insurance also won't be 100% refund of money. Correct? Now bank gave loan based on this bike. Now bike is lost. Now I don't pay, and bank comes to my house, says we will take the bike. I said take. Where is the bike? I lost the bike. Where is the money? Then I have applied for insurance. Claim is yet to come. This is the extra headache for banks if they give loan against movable property. But if it is site and you give that paper, then if you run away, bank is actually happy. Instead of collecting from you, now they have an asset, and that too, that land is going to appreciate. By the way, whoever is following this news, you will know this. Vijay Mallya's, leaving the country, taking loan, all this part, you know. But he did not get loan without security. You know what is the security that he has given? The UB City building in Bangalore. And that UB City building is a commercial building, earns so much of rentals. And that also has its own valuation. And tomorrow, if that bank sells that property, all that money goes to the bank because it is given as a security. Therefore, when it is an immovable asset and that guy runs away also, banks won't cry too much. And immovable asset will always appreciate. That to commercial property, you earn monthly rentals. I think it's about 10 or 12 floor building, maybe bigger than that. If you have 12 floors and all offices and cafeterias, hotel and this and that, you earn so much rent also. Imagine today if SBI is the owner of that building, you are earning so much of rental income. Plus, any day you can sell that. And when you sell, one, building has value. Second, that land parcel, that land has value. Even if building is depreciating, land will have appreciation. Yeah. Therefore, don't read only half story about Vijay Mallya's case and make your own conclusion. That's all good for sharing memes and reels on Instagram. But in reality, he has given his house a security. I think in Mumbai he had a real estate property. In London, if I'm correct, London he had one big palace type hotel. That was also given as security. Now all of that is with bank. He can't use it. Any rental income goes to bank. If they sell, entire money belongs to bank. And banks won't sell also easily. When you're getting monthly rental income and appreciating asset, that too in Mumbai, real estate is super costly. They know it will appreciate anyway. That is the reason why from bankers angle, giving loan against site is less risky, because if you run away, they don't cry. They have site with them. If they want to sell, they sell. Otherwise, anyway, it is appreciating. What is the problem? That's why you see housing loan is 6.8, 6.7, less than 7% rate of interest. But some other loans are 10, 12, 14. Education loan is much higher rate of interest because degree of uncertainty is high. In land, because it is immovable, uncertainty is very less. Bills discounting, do you know what this is? Anyone? And why is that a source of money? Our heading is source of finance. Why is bills discounting is a source of money? Do you know what is bills discounting first of all? No. A sold goods to B, 30 days credit, and A has drawn a bill, 10,000 rupee, and B has accepted it. So it's more like a contractual obligation. But now on 1st January this happened. 3rd January itself, A is in need of cash. on urgent basis, what he can do? Go to bank, and bank will do what? Discount it. What is the meaning of discounting? They will take some charges. Assume 100 rupee, 9,900 rupee. They will give it to A. On due date, B will have to pay the money to bank. If B fails, then bank will come back. But at least for 25 days, you have cash early with you. Instead of waiting till 30th day, you got on 3rd or 4th itself. That means if you have a bill drawn on somebody, and if you need urgent money, you go and encash it, and bank will have some charges. Yes. Just a second. Have you studied, I don't know, maybe 12th, ADR and GDR? Do you remember having American Depository Receipt, Global Depository Receipts? 12th, is it? Foundation Economics. BCom. First PUC. Because before we enter international trade, from here everything is about import export. In that, one of the important things is ADR, GDR, euro bonds, foreign bonds. Here, anyone knows? If you don't know, I can share some. Okay, do one thing. In your phone, type this: Infosys ADR. Capital ADR. After ADR, I think ADR price comes. ADR share price. Actually, it is not share. That's how people search on Google. Infosys ADR share price. What's the number? Sorry. No. Do one thing. I'll read out. Type this. Type exactly what I'm saying. Infosys ADR. Yeah. Now we're getting some website links. Is it something like this? Investing.com or marketwatch.com? That investing.com, you click on that. Are you getting a number 21.41, something like this? Are you getting this? This is the screen that I'm getting. 21.4. Now, you know what is this? If you come down, Infosys Limited ADR, there also you have 1, 5, 15, 30. Can you see? 1 day, 1 week, 1 month, and so on. Today at home, read something about these ADRs. Okay, instead of me reading from textbook, read a bit and come. I don't know, 11th. Somebody said 11th. That was business studies, is it? Economics of foundation. BCom economics. Sorry. Yes. Next one is financing of export trade by banks. Packing credit. Quite interesting. I'll read out first and then we'll have to draw a small flow of activities. Packing credit is an advance extended by bank to an exporter for the purpose of shipping goods to an overseas buyer, that means foreign customer. An exporter having at hand a firm export order placed with him by his foreign buyer or an irrevocable underlying letter of credit LOC opened in his favor can approach a bank for availing packing credit. An advance so taken by the exporter is required to be paid off or liquidated within 180 days. I'm writing few things. Understand first, not very easy, then you copy. There is Mr. P, exporter. He is in India. He deals in INR currency. There is one USA customer, Mr. Q, importer. He is in USA and he deals in dollars. Now he says, Mr. Q says, please send goods to me. I will then pay you money. The problem is, within India, if I am selling something on credit, that itself I have doubt what if customer runs away. And now if this guy is a foreigner and if he is not picking my phone, even for me to go there, it will cost me so much. And then this filing case, etc., can't even happen. He is in some other country. Therefore, what P says, do one thing. The invoice value is $1,000 in INR, let's say 83 rupee conversion, 83,000 rupees. Okay, $1,000 is the value of the goods that you are asking me to dispatch. You go to your bank, say Bank of America, and deposit $1,000 and ask them to give me one letter, and that letter is called letter of credit. Okay, this is an acknowledgement or a proof that you have deposited money. Once I get that letter, then I will dispatch goods. Okay, now the problem is goods have been dispatched, but it will take time to reach US. What is with Mr. P now? One document, but that's not cash. What he can do, he will go to his bank, say HDFC Bank in India, and he will say, look, I have a document, a proof of $1,000 deposited. Keep this and give me 83,000 rupee loan. Able to follow? Now you know what HDFC Bank does? They will not trust the document given by Mr. P. They will check whether this document is original or not with Bank of America. Because there has been case, not one, many, where people created fake LOC and said somebody has deposited money in that bank, my goods are on the way. They created all edited PDFs. They took one original from somebody and then scanned it and they changed the name and gave it to HDFC, took loan. Now HDFC, not HDFC, any bank, they are not giving loan. They will first check with the bank because this LOC will have a number, correct? Acknowledgement number, OTP kind of special number, and that they check. If Bank of America says yes, it is genuine, I only issued it to Mr. P, then HDFC will trust and then they will give loan. Okay, now understand what will happen once goods reach Mr. Q. Goods will reach the port of his country. That port authority of that country, they will give an intimation that goods have reached. That intimation is sent to Q also, P also, HDFC also, Bank of America also. Correct? Now tell me, money is with Bank of America, $1,000. That $1,000 is in a form of document with P, but it is not even with P now, it is with HDFC. And HDFC gave loan. Correct? Ultimately, once goods reach this place, HDFC will call Mr. P and says, please take your LOC back. Okay, and return our money. That's what they said, within 180 days, all of this should happen. Right? Now the money will come from Bank of America and this loan will get closed. Sir, why is Bank of America doing all of this? They will ask Mr. Q to pay some charges. And why is HDFC doing all of this? They can charge some interest. Tell me, what is the advantage of this to Mr. P, by the way? He is safe because if there was no Bank of America, no LOC, then he would doubt what if Q runs away. Goods will reach and then Q won't pick up phone. Then I told you, another country, some other law, you can't go and file a case in Bangalore court against foreigner. Police station, what will they say? Why? How can they take complaint against somebody who is not their citizen? Correct? You have to go to US to file a case. Practically, this is not going to happen. P can't trust Q, but when Q deposits money and Bank of America gives a letter, Mr. P can trust bank. And that document, LOC, he gives to HDFC. Even HDFC is not trusting P. They are checking with bank. Two banks can trust each other, but two individuals can't trust each other. That's the advantage. Sir, but we have to pay charges for both these guys. Correct. To avoid this, you know what you should do? These guys should find out, is there any bank which is in both the countries? Yeah. In India, we have one bank called Exim Bank. That has one branch in India also, one branch in America also. Now, instead of doing it through two different banks, if you do it in Exim Bank America branch and Exim Bank India branch, then charges need not be twice. Charge will be only once. Number one. Number two, then this checking the document also will not be necessary because it is their own bank, another branch. That employee can log in and check with his own user ID password. Why do you have to check with someone else? It becomes faster. One of the primary reason why Exim Bank was started was to help import people. Right? Tell me, is there any problem to Mr. Q in this deal? He was anyway ready to pay $1,000. Only thing, instead of waiting for goods to come, he had to go and deposit. That too, we are not asking to deposit in HDFC. He is depositing in his country's his account. What is the problem? Sir, one last doubt. Goods are on the way. What if something happens to goods? Some accident, all these goods are 100% insured. You cannot send anything outside the country without insurance. If something happens to goods, 83,000 will come from insurance company. That's not a problem to anybody. Done. Can you please copy? Do one thing. I will highlight in that flow. You also copy. Heading. Concept of packing credit in bracket LOC, letter of credit. Yes. First, write Mr. P, exporter in India. This side, Mr. Q, importer in US. Then this arrow mark, goods will go worth $1,000 converted 83,000. For that to happen, he should deposit amount in his bank, Bank of America. And Bank of America will issue a document. Document is called LOC, letter of credit. They've used the word in textbook irrevocable. That means you can't cancel it. It's not like a check. You give a check and then say that check is cancelled. Irrevocable means cannot be cancelled. And that LOC, Mr. P will give it to HDFC and says, dear HDFC, please keep this and give me equivalent money. HDFC will keep this document and release loan. On what confidence? They would have checked with Bank of America. Now think from HDFC Bank's angle. They know money is already deposited in Bank of America. They trust bank. And they know goods are on the way. They know goods are anyway fully insured also. What can go wrong to HDFC? Maximum goods are lost. Then anyway 100% insured. And money is not with Q, money is with bank. They are trusting another bank. They are also not trusting Q. Correct? Done. Instead of two different banks, you can have a single bank called Exim Bank, Export Import Bank of India. They will have a branch in every country. Then instead of paying charges and interest in two places, you can do it in a single place. Becomes easier. Done. Also called as LOC. And all of this transaction, go back to the textbook. They say this has to be closed within 180 days. Anyway, you don't need 180 days for goods to reach US. Okay. Even through ship, waterway, it won't take beyond 1.5 months unless there is some serious problem like war in between those areas and they're not allowed to move, etc., which is not a common thing. 180 days is quite a good time for anybody to repay this loan. Yeah. In this, there are three varieties. One, clean packing credit. You know what is packing credit here? This 83,000 loan that they are giving. That was the whole purpose of this story. I have to dispatch, he will deposit, I got a document, I went to bank, I took loan. Ultimately, we wanted to know how to get loan. Okay, three varieties. One, clean packing credit. This is given to those who have good credit worthiness without much of documentation, and things will happen very fast. They may not ask any security also. Second, packing credit against pledge or hypothecation of goods. They say you give some security, normally goods, against that only I will give. Third category, ECGC guarantee. Long form is given at the end. Export Credit Guarantee Corporation. This is owned by Government of India. You know what this guy does, Mr. P? When he has to export it from India, you have to go to the nearest port. Yeah. In that port, you have to submit all your documents, all the proof of business, your GST number, this number, that number, and everything. Government of India has set up this Export Credit Guarantee Corporation of India. Under that department, he can apply for a guarantee. Now, what is that guarantee? This ECGC will give guarantee to HDFC Bank saying that if Mr. P fails to repay this 83,000 rupee loan, we will pay. Now, HDFC Bank got one more layer of surety that even if this guy runs away, I have no problem because guarantee is given by Government of India. Now, tell me, why is government doing this? Because they want to promote more and more exports. This is the only way they can help Mr. P. You want to export, money is the problem. I'll give you guarantee letter, give it to HDFC, take loan, and then dispatch. If you don't repay, we will pay to them. Lot of schemes. I think in uh, this year, last year, if you know, there is a scheme by government called Mudra. Heard of MUDRA for all medium and small businesses. I forgot the name. Even for street vendors, okay, there is a scheme in which up to 50,000 rupee. These are all small vegetable shops and all of that. Specific street vendors only, not fixed establishment. No pani puri shop, vegetable shop, fruit juice, such small cart, such businesses, flowers. These guys of these kind of businesses, they get up to 50,000 rupee without any security under the scheme. Now, who gives guarantee? Government of India. Now, bank is also happy. Give loan, collect interest. If they are not able to pay, government has given guarantee. Government will reimburse that money. And this is used in a lot of tier 2, tier 3 cities. Is a very popular government scheme. Lot of these barber shops, all small businesses. Loan won't be more than 50, 60,000. I think maximum is only 50,000. Not beyond that. All small businesses, all street vendors, they get this benefit. And government gives guarantee. So why to worry? Mudra is for slightly bigger shops. Again, not very big, but slightly bigger than street vendor. Somebody wants to set up a hotel, needs some furniture, some machines, tools, all of that. Somebody wants to do some job work, repair, bike service center, car service center. These kind of businesses, they get Mudra scheme. If it is outside India, then they have set up Export Credit Guarantee Corporation. Now, if you have that, then this will be even faster. HDFC will not even think too much before giving you loan because you already have that ECGC guarantee letter. We need to start from page 232. Is that correct? After ECGC guarantee. Yesterday, I think the last thing we have written is letter of credit related small diagram and the explanation about it, correct? So the next discussion is other sources of financing. First one is seed capital assistance. Underline IDBI, Industrial Development Bank of India. This is a bank exclusively set up for helping the businesses, especially small and medium businesses. We call them as SMEs, small and medium size enterprise. Not that IDBI will not accept my and your SB account, but the primary purpose of setting that bank is to help businesses, that too small and medium businesses. 1 year back, there was a news that this bank is going to be privatized and Axis Bank was planning to take over this. That's when it was in news for some time. Now it has been just continued. IDBI. They have a scheme wherein, read this, all the projects eligible for financial assistance from IDBI through refinance are eligible under the scheme. The project cost, mark this, should not exceed 2 crore and the maximum assistance available is only 50% of the required promoter's contribution, which means they're not going to fund big businesses. They say project cost itself should be less than 2 crore. That means you want loan for more than that, you are not going to get. That means 30 lakh, 20 lakh, 80 lakh, 70 lakh, these kind of loans. And the maximum amount that they are going to give you is only 50% of the required amount or 15 lakh. That too, whichever is less, not more. Now, when they say whichever is less, that means you are not going to get a big amount in this scheme. Correct? First of all, less than 2 CR. In that 50% or 15 lakh, whichever is less. That means who can use these kind of loan schemes? Look at the name, seed capital. Seed is a small contribution. That's why the name is seed capital. I will help you at the start of your business, but don't expect me to give you 100% funding. I'll give you a bit of contribution, that too at the beginning. Then why should I go to IDBI? I can go to any bank, ICICI, SBI, any bank can give. The advantage when you take loan under any of these schemes is that you get at a lower rate of interest. One. Second, As I discussed in the previous session also, you have these uh, mudra and these loans wherein the government gives guarantee to the banker. So banker also will not ask too many questions. And now the reverse trend has started. Government has given target to the banks to give mudra loans. 10-15 years back, taking loan was difficult, but now getting loan is not difficult. You have apps through which you can get loans. You have easy access to credit in simple. And not only banks, now you have non-banking finance corporations also. You have this Tata Capital, Bajaj Finance, Muthoot Finance. There are so many other than bank where you can go. And in Karnataka, you have something called KSFC, Karnataka State Finance Corporation. Basically, State Finance Corporation is there everywhere. Kerala State, Maharashtra State. Basically, SFC is there in every state. One more place where a businessman can get loan. IDBI is still a bank, but bank meant for helping the business. Originally, when HDFC started, they started for housing loan. Name itself is Housing Development Finance Corporation, HDFC. But then it became bank, and now almost all banking activities are done there. Same way, IDBI also does all banking activity, but the primary purpose of setting up IDBI was to help businesses, in that mainly small and medium businesses. Yeah. And when you take loan from these kind of banks, not that you should default, even if you default, because there is government guarantee, IDBI also will not worry too much before giving loan. Yeah. Previous session I was telling you about the footpath vendors and these guys getting the loans. Now why it has become easy for them to get loans? The pressure is from the other side also. Even banks have a target, branch has a target, government has given target to the bank, chase people and give loan. It is other way around now, correct? So that more liquid, this is called liquidity. So that more liquidity comes to the market, more people should have money so that they can start more businesses. Maybe small business, but let people start having access to credit. Earlier, the big problem 10-15 years ago, getting loan was very difficult. You did not have apps, you did not have these websites. Now if you want to take a policy, health insurance, life insurance, vehicle insurance, if you go to policybazaar.com, you get all type of insurance that are available in the country. It's a kind of Amazon, Flipkart for insurance. It's an aggregator. You have people who need insurance, and then there are 25 companies which offer different varieties of insurance. This was not the case 10-15 years ago. If you wanted insurance, there used to be one common person in the family. I call them LIC uncles. You know what is LIC uncle? There is that LIC guy who always wants you to take one policy at least. They would chase you. Other than that, it was difficult to get one insurance agent other than the one you don't want. But they would have come and told you that I am an agent, why don't you take a policy? But that's not the case today. Right now in class, if you can check on phone, 25 insurance company details will come to you. You share your number once with Policy Bazaar. After that, you will install Truecaller also. Yeah, they chase you literally that many calls. That means getting insurance, getting loans, getting short-term funding today is not difficult because everybody wants more people to have insurance, more people to have loans. So why people go to IDBI itself when there are so many options available is because of the rate of interest, terms, and government itself is giving guarantee. Then it becomes much easy. Documentation will also be less. But again, remember IDBI is a government bank, PSU, public sector bank. Half of the money is held by government itself. In terms of documentation and speed, private banks have always been better than PSU banks. But in terms of rate of interest, PSU banks are cheaper than private banks. Convenience, private banks are better. But hidden cost, some private banks have this problem. You never know, suddenly end of the year they debit one number and they say this charge, some random charge, you don't even know what it is. But PSUs don't try doing all of that. So it depends on whether you want lower cost or better convenience. That's why most of the people go for both variety loans. IDBI is anyway a PSU, so rate of interest is slightly on a lower side. Next one, deep discount bond and zero coupon bond. Both are kind of similar but not 100% same. Read, name itself says deep discount bond is a kind of zero interest bond. And zero coupon bond. Coupon means interest and do not carry any interest, but it is sold by the issuing company at a discount. Now, what happens when you buy a debenture or a bond? You invest money, they pay you annual interest, and then they redeem the principal. So this is the way. 100 rupee you pay, 8 rupee interest, plus they redeem. This is interest, this is your redemption, redeemable value. This is your investment, correct? Instead of this, they say, I'm not giving you interest. This 100 rupee bond itself, I am giving you at 9 rupee discount. Redemption will happen at par value. That means what is your income now? You invested 91. You will get back 100. 9 rupee itself should be understood as your income. Now look at these numbers. 100 rupee you invest. With interest, I will repay after 1 year. One possibility. Second, 92 you invest. I will repay 100 rupee to you. Now tell me, as an investor, which scheme do you think is better? A or B? Or both are same? Take time, think and tell. Which scheme is better from investor's angle? Or is both are same? A is better, B is better, or both are same? B is better. Observe. How do you see? Return is 8 rupee. Here 100 becomes 108. Here also 8 rupee. But how do you calculate rate of return? 8 rupee extra for 100 rupee investment. 8%. But here you are earning 8 rupee by investing only 92. Now if you do 8 by 92 into 100, do you think you will get more than 8 or less than 8? More than 8. That means second one is better than the first. Correct? No doubt you will earn 8, but you have to invest 100. Here you will earn 8 by investing only 92. This is why these kind of bonds have become attractive now, because I pay less, but I get back par value. Some cases they may even redeem it at premium now. 92 you invest, 101 you get back. Yeah, remember the name coupon. Coupon means interest, and when name itself is zero coupon, no question of even asking will I get anything. Name itself is zero coupon. Where is the discussion? Then why should people buy? The difference between issue price and redeemable value. They are issuing it at 92. They are going to redeem it at 100. The extra money that I am going to get is 8 rupee. And when I do rate of return, 8 by 92 into 100. This comes in percentage. Able to follow? Next, floating rate notes or bonds. This, as the name suggests, is a bond underlying where the interest rate is not fixed and allowed to float depending upon market condition. Observe this. A Limited is issuing a bond and Mr. J has invested 100 rupee. 5 years bond, 8% interest, redemption is at par. Now every year he is earning 8 rupee and 5th year he will get back the principal. We know this is the basic thing. Now what is the name? Floating rate. What do you mean by floating rate? This 8 won't be constant. 8 can become 8.1, 8.3, can become 7.8, can remain at 8. This rate can also change. If the rate is also changing, then it is called floating rate notes. Can you tell me why will anybody invest in a floating rate note? Think from investor angle. Why should I buy floating rate note? Why not select a fixed one? Is the interest rate same always? No. Interest rate depends on the RBI's, correct? Heard of this? Repo rate? And this can change. Now, do you remember? I don't know how many of you. Okay. If you ask your parents today, they'll tell you 20 years back there were schemes where in 5 years, or say on a conservative side, in 6 years, even in bank FD, money used to get doubled. Ask them. You will not know this because now it's not 6 years, even 9 years you can't double the money. Tell me what is the meaning of doubling the money in 6 years? If you invest 100, it should become 200. In how many years? 6 years. Compound interest. Then what should be the rate of interest? 200 is equal to P into, correct? 1 plus R to the power N. Basic compounding formula, correct? Now 200 by 100 should be 1 plus R to the power 6. This will be what? 2. Am I correct? 1 plus R to the power 6. With trial and error you can find out. But easily it will be somewhere around 12 to 13%. Yeah. If you have calci, try this. 100 plus 12%. Keep doing 6 times. Plus 12. Plus 12. Plus 12. Plus 12. 190. No. I'm asking this. Plus, plus, plus. If you do 6 times, what's the number you are getting? 197 approximately. Not exactly. Approximately. That means correct answer is slightly more than 12. Because I want it to become 200, correct? So let's assume, say 12.1%. This used to be the FD rate of interest. Do you know what is the FD rate of interest today? Half of this almost. 6.5, 7%. Ask them. This doubling scheme was very, very popular 20 years ago. Risk free, that too. Bank FD, I'm saying. 1 lakh you invest. In 6 years, money will become 2 lakh rupee. Lot of investment was happening. Now tell me, if FD rate is going down year after year after year, don't you think it will discourage people from keeping money in bank? Why should I keep if it is just giving me 6%? What if inflation itself is 7.8%? Then even after keeping in FD, you will still be poorer by 1.8%. 1 year later, items would have gone up by 7-8% and your money has gone up only by 6%. Right? Now you know a new problem that banks are facing. They have shortage of money. Why shortage of money? You know why shortage of money. People are not keeping money, that's why shortage of money. How do banks get money? Either current account or saving account or FD or RD. Correct? Now this is called CASA accounts, CASA. If you read any newspaper or watch news channels, you will listen to this conversation. CASA deposits have come down. CASA money is coming down. Current account, saving account. This at least they have to pay a good amount of interest. On this you get very less interest. Current account is almost zero. Saving account, do you earn interest? You all have a saving account. Do you earn interest? Do you know the percentage? Around 2.5% you get. But you have never felt it. Because you never kept good balance. Simple. And that too they credit once in 3 months. Therefore it is further into 3 by 12. So very less chance that you will feel that number also. Imagine you keep it 835 rupee balance. What happens? 835 into 2.3% into 3 months by 12 months. This number will come to your bank account. It will get credited, but you will never feel because it's in single digit most of the time. And that itself will go in minimum charges, not maintained, ATM withdrawal, all the charges. So you will never feel that you're actually earning something. Which means more money in CASA account, it is good for the banks because they don't have to pay a lot of interest. RD, FD, they have to at least pay recurring deposit, fixed deposit. You know, from last 2.5 years, what is one big problem most of Indian banks are facing? This money has gone down drastically. People are not keeping money in their bank account. Then what are they doing? If you and I, if you are not keeping money here, then where is the money? It has all gone to mutual funds, going to capital market, stock market, or we are spending either Zomato app or Zomato share. It's not in bank basically. Tell me, how will this create a problem? If banks don't have enough money with them, they can't lend. They can't print and lend anyway. They need to get money from people. And if people are not keeping money, then they cannot give much of loans. And if they don't give loans, they can't earn interest. Their main income is interest from loan. And people are not keeping much of money. They used to keep earlier, but now because of SIP and other things, even if they keep by next month end, that money is going to a mutual fund company. And no doubt, check last 2.5-3 years, mutual fund SIP contribution is only on an upside. increasing year after year, month after month, every month. Even this latest month, even when the market was down, more than 20,000 crore is monthly SIP. Every month, 20,000 crore. If this SIP mutual fund craze was not there, that much of money would be with banks. For SIP to happen, it's getting debited from somebody's saving account only, right? The banks are facing this problem. Why people are not keeping money in bank FD? Because rates are very low, and you keep 6% forever, 6 years, and then what if inflation rate goes up 7%, 8%? Now the one who has kept money in bank deposit will cry. His money is growing at 6%, but inflation is 8%. But once you keep FD, you can't change the rate. Therefore, what investors want is, if the inflation is going up, let the interest rate also change year after year. Therefore, I do not want to invest in a fixed interest fund. I want to invest in a floating interest fund. And that is why this is becoming slowly popular. People are investing in a bond where the rate keeps changing according to the inflation. Otherwise, I will never be able to defeat inflation. Inflation is always 1% ahead of my bank FD. So even after keeping money in bank FD, I will have shortage 1 year later. And one problem with FD, once rate is decided at 6%, if you keep money for 6 years, all 6 years rate is same. In between, you can't go and change that rate. But if it is floating rate, you know the rate keeps changing. If inflation is high, I will also get high rate of interest. Next one, secured premium note. Underline this, detachable warrant. And it is redeemable after a period of 4 to 7 years. Underline, there are two components. Yes, listen, the wording is detachable warrant. I'm writing, but in reality it is not in paper form. I'm writing for your understanding purpose. Suppose there is an instrument, we call it bond certificate, debenture certificate, and the word used is detachable instrument. That means this is a separate part, this is a separate part, and I am holding this bond with me. Okay, 100 rupee I have invested, 5 years time, 5 years time, 8% interest. That means with this part of the bond, I am eligible to get 8 rupee interest for 5 years. And what is this? They said, read, you have underlined just now, detachable warrant. This will give me right to convert one bond into 5 shares or 10 shares, as may be decided by them. 5 shares or 10 shares after 5 years. Now what I can do, I will keep the bond with me, entire, both parts with me. I will earn interest for 5 years. 5th year, after 5 years, tell me this has no validity now. This warrant is with me. Either I can go to company and say, give me 5 shares. Or if I don't want to keep it, I can sell this warrant to someone else. That person who is buying warrant from me, later he will go to the company and he says, give me 5 shares. One possibility. Second, you know what many investors do? They will first buy this and they will not even wait for 5 years. After 3 or 4 years itself, they will sell this warrant because they have understood now the share prices are high. When share price is high, definitely warrant also will have a good valuation. Now itself, let me sell. 5 years later, I don't want to become shareholder in this company. Why to wait for that day? Anyway, share price is at peak, and understand one warrant gives you right of 5 shares. Correct? And now if share price in the market is going up, then definitely warrant will also have a higher valuation. Imagine one share is 500 rupee. Then you can sell this warrant for 2500. What if this becomes 600? Then obviously you will sell it for 3000. Once you realize it is at its peak, you can sell the warrant. Now even after selling the warrant, remember, you will still get 88888. That's why they said detachable instrument, and they say it comes in two parts. They said 4 to 7 years period. I wrote 5 years. And that person who purchases this warrant from you after 3 years, no condition that he has to get the shares. He can sell that warrant to someone else. Able to follow? If the 5 year is the time period, up to 5 years, it can move from one person to another person. I sold it to her, she sold it to him, he sold it to him. Finally, fifth year, that day, whoever has it, he will go and get those 5 or 10 shares. Following? Huh. Even after selling the warrant, the original bondholder will get all 5 years interest without any disturbance. Warrant is a separate thing. That's why they have used the word detachable. It is not part of the main document. Right? Imagine two paper. One you can tear off and pass it on. The other one, I'll continue to earn the interest. Yes, this is more like a convertible debenture. But the only difference is in convertible debenture, you have to wait for 5 years. This warrant you can sell any day. Why 3 years? First day itself, sell the warrant. Then also 5 years you'll earn interest. Let that warrant move from hand to hand. How does it matter to you? You are anyway not interested to become the shareholder. And warrant again is a derivative instrument. Warrant will have better value if the share in the market has better value, because that warrant represents 5 shares. That warrant represents 10 shares. If you have the warrant, it's as good as you have those shares. Following? Read it. SPM is more like a debenture. The warrant that comes with SPM can be converted to equity after the agreed period. In my example, the agreed period was 5 years. Next, financial instruments in international trade. First one is external commercial borrowing. Wording is very simple. Commercial borrowing, that means loan taken for business. External, that means taken outside India. Right? Pay attention and tell me why my idea is not going to happen in reality. Suppose a company A Limited has its head office in India, say Bangalore. They have a branch in Singapore. We use INR currency. They use Singapore dollar currency. Now, this is my head office. This is my branch. This branch is in need of 10,000 Singapore dollars. They need loan. What are the two options we have? Option number one, I will take loan in Indian bank. Suppose currency conversion rate is say 50 rupee, just example for discussion purpose. 5 lakh rupee, I will take loan here and then transfer it to my branch. When I transfer, they will then convert to SGD and then they use it daily. But the challenge comes, every month loan EMI has to be paid. Who will have to pay that EMI? Head office only. And for that, again every month this branch has to transfer. Again that will be in SGD. Again you have to convert to INR and again you have to repay here. And so on. This is one option. Option number two, why getting into this headache? Let's go and take loan in Singapore itself. Now loan amount is also in SGD. Monthly EMI is also in SGD. You don't have to transfer anything back and forth. Correct? Tell me now, why second one is preferred and not first one? Tell me why companies don't prefer first route, why they prefer second route. By the way, second route is called external commercial borrowing, taking loans outside India. Loan itself is in foreign currency. Now tell me why first route is not a good idea. Sorry. Number one, every time you convert, one, there is a risk because currency conversion rate may change. Second, every time you convert, there is a cost. Bank will charge some processing fee and other things. Two, what is the third challenge? You have to take RBI approval for this. This is not even allowed in some countries. Imagine if this is allowed. I'm not saying India and Singapore, just any random two countries. If FD interest in Singapore is 8% and bank loan in India is available at 6%. Tell me the scheme now. Tell me what can I do? Take loan here, keep FD here. Anyway, you have a branch there. And you earn 8% there, pay 6% here. Without working, you made 2% extra. Correct? Tell me, isn't this a loss to Indian bank? That they are charging you only 6% and you are keeping that money elsewhere and earning 8%. And then shift that money back. Without doing any extra work, you are making 2%. Therefore, RBI says this is not allowed. If you are shifting the money to another country only to repay the loan monthly basis, you have to take RBI permission and RBI won't give permission. And if RBI doesn't give permission, you cannot do any foreign transfer. Sir, I can do, I have done one. My cousin was in Dubai, I paid money. Personal one-to-one transfer money is not restricted by RBI. A company current account to another company's current account is not permitted. You sending a gift or you receiving money, that too there is a limit. You can't do beyond a point within a year. If I'm correct, some maybe $2,000, $5,000 for individuals. If you transfer, you don't need RBI permission. Or think about it. If somebody wants to go for a foreign trip, now they need foreign currency. Right? Then they are doing that conversion. So there is no restriction when you and I do on personal spending basis. But if company is doing this, then they have to take one permission. And that permission every time if you have to pay EMI on monthly basis. And RBI will not permit. This is not possible now. Long ago, I'll tell you a small story. Long ago, many companies in some countries, they misused this and made good money. Whoever has interest today, read about it. It was called Mauritius route. Okay, you know what is Mauritius route? Not now, by the way. If you want to do it now, it's not possible. Don't think it's a money making idea discussion. People did. You'll then understand why this RBI permission is too strict nowadays. Mauritius is one such country that time which had very, very, very low income tax rate, something like 0.12%. Very low income tax rate. Okay, there is one company in India, software company. INR currency, 30% is tax rate. Our office is in Bangalore. We have one customer who is from Mysore. Same country, same currency. If we sell something to him, anyway, we are a software company, nothing physically is going. It's a license to software. We give him username, password. If we sell it, 10 lakh rupee is our sale value minus our cost. Say 2 lakh rupees our cost. 8 lakh profit on that 30%. 2.4 lakh. To avoid this, what many companies did, they opened one branch in Mauritius. This company, software Bangalore company, opens a branch in Mauritius. And then do what? From here to here, for 2 lakh, they do one branch transfer at cost. Anyway, your own company, between HO and branch, there is no profit. And from Mauritius, they sell it to Mysore customer. And show all the profit in Mauritius books. And there you show 8 lakh profit. On that you pay 0.12% tax. Understanding? And all the profit that you make in Mauritius will ultimately come back to head office because ultimately it is just a branch. The only problem was this Mysore customer would call and ask, why is my invoice coming from Mauritius? Why is it in a different currency? When you are in Bangalore, I am in Mysore. Shouldn't everything be in INR and why is the address different? Then they would say, boss, we have a branch there. From there we are billing. If you want, we are ready to give 5% discount also. Who will not give if you can help us save 30% tax? Now that Mysore guy was also happy. His cost also has come down. You know, it reached a point where once an investigation was conducted in Mauritius in one single building, there were more than 400 companies registered. Single building, registration office of more than 400. I think it is still a small number. It is much, much more than 400. Nobody is working there. Everyone would hire a place as big as this, 5 by 5, and put your company board, hire one receptionist there and call it branch. Why do you have to set up? Because you can take the tax benefit. Just open one branch. How much of space you need? No employee needed. And what is their job? Pass one entry, purchase from head office, pass one more journal entry, sold to Mysore. That's it. And pay the taxes at 0.12%. Not one, not two. hundreds of Indian software companies had a branch in Mauritius. It became so famous, people used to call it Mauritius route. It reached a point where someone says we also have a branch in Mauritius, people would doubt you. Even if you're a genuine businessman, they would doubt you. You opened a branch only for all of this. Then they realized, how can there be 400 companies in a single building? That to somewhere in same floor, 30, 40 companies in one floor. How is it possible? They went there, they realized everyone has only receptionist area. That's it, start and end of the company. And they have one computer, only to pass those two journal entries. Then, now tell me, who is losing in this? In this whole game, who is losing? Government of India is losing tax. Correct? Now, can you go and pressurize Mauritius government, change your tax law? They will say, who are you to tell us? Right? Maximum what government of India can do. Now it is not possible by the way it used to be. They said if your company has one office in India and one office in Mauritius, your income tax rate will be the rate applicable to either in India or in Mauritius, whichever is higher. Within 3 months, this 400 came down to 35. All of them vacated the building. They understood there is no use of staying in this country. The whole purpose was only to move money from taxed country to a non-taxed country. Now, without an RBI permission, money cannot go from Mysore to Mauritius. This is why RBI permission became relevant. Now, if Mysore guy is paying to, you have to pay because invoice has come from there. Before paying, you have to take RBI permission. They will ask, why are you paying? Whom are you paying? Give me the details, invoice number, company name. Do they have a head office in India? They started tracking the data. They got to know people are doing this. Then government of India pressurized. By the way, not only Indian companies, across the world, everyone had Mauritius branch. US companies, Japan companies, South Korean companies, all of them had Mauritius branch. Mauritius became famous among companies for this reason. Therefore, this idea of taking loan in low rate country and keeping FD in high rate country, having one branch in low rate income tax country and moving money is not at all possible today. Because the moment you transfer money, RBI will send a notice. Why did you pay without a permission? And you can't even pay because it's a foreign transfer. You don't have currency in your pocket, correct? You have to buy from bank and banks can't give you without asking these documents. Now you know what is the rule. If an Indian company, say Infosys, has to pay to something outside India, say Google, they have to take RBI permission and they have to get this certified by a CA. That CA has to check what is the purpose, what is the invoice, is it genuine, and that signature, with that only you should go to RBI because RBI officer will not have time to check the genuinity. You may give some fake information, correct, saying we purchased something from Google. Who will check whether you actually purchased or not? Now CA has to check that invoice against which you're making the payment, and there is one format in which she has to check and fill everything and sign. Without that, RBI permission also will not be given, and unless you get RBI permission, money cannot be transferred. Therefore, this idea of taking loan here and giving it to them and monthly they will pay you EMI, you will pay to your bank, this idea will not work. The best way is take this commercial borrowing externally, that is take the loan itself in Singapore currency, then everything becomes easy. Only thing you will have to do at the end of the year when you prepare balance sheet, your Singapore balance sheet will be in that currency. But when you consolidate head office and branch books, head office is in INR. That means this has to be converted back to INR. This you will study in accounting standard what to do for all these foreign currency transactions. Because the day you took loan, conversion rate was different. Every EMI 12 months rate will be different. Last month as on 31st March, it's called balance sheet date rate. That day rate may be different. 12-month EMI is called transaction date rate. Now which rate to apply, the loss or gain, how to do is all part of accounting. But the best and the easiest way is taking loan in the foreign country itself. That's why it's called external commercial borrowing. See this. Under the automatic route, there is no need to take RBI or government approval, whereas such approval is needed if you go by approval routes. Even today, for some of this, you have to take RBI permission. They have categorized what purposes you can take without permission and what can be done with permission. Next one, euro bond. Most important thing you should underline in this is last sentence that I have added specifically. Read once and tell me, did you understand what is printed? Euro and Europe has no connection. Don't mug up. Euro bonds are issued in Europe. That is what people do if they don't study. Euro means international. Simple. That is, an Indian investor buying a German bond. It's called international bond actually. But then, sir, why are we calling it Euro bond? The international bond market's head office was in Europe. That's why it became famous as Euro bond. Able to follow? Tell me, in India, where do we have our stock market? Major one, BSC, NSE, where do we have? Mumbai. Internationally, if you want to buy bond, that means a German investor wants to buy a Japan company bond. For them, a common market was in Europe. Therefore, Europe became a head office for the international bond transactions. That's why international bond was that time, and even today it's continued to be called as Euro bond. It has no relationship to Europe, nor it is in their currency. Understanding? Please answer. If there is an Indian, you and me, wants to purchase Japanese company bond, which currency Japan uses? Yen. Tell me, what is the way? How do I buy a Japanese company bond? Imagine this Euro bond is not there. Then what is the way out? Tell me, sir, go to that company's website. That company's website. Then go to the bond shares section and then click on purchase. Then a different currency will come. But my bank account is in HDFC, Bangalore, Karnataka. This is in INR. Now I have to convert. The moment I have to transfer money from this place to another, that too when it's a company, it's not personal to personal now. It's not me and my friend, it's me and another company. Then I have to take RBI approval again. I told you, unless it is person to person, you need RBI approval. Number one. Number two, I have to convert my currency to their currency. That time there is a cost involved. End of the year they will pay interest, but that interest will be in their currency. Again that has to come back to my currency. Again RBI permission. Again currency conversion. 5 years later I want to redeem that bond. Again when I sell it is in that currency. Every time if I keep doing it, all the gains that I make will go in just RBI permission, paperwork and foreign currency transfer. Correct? Therefore, what is the best way? For me and them, there is a common market. And that common market is called Euro bond market. And there when I buy Euro, I told you not to get confused with the word. It's called international bond market. In international bond market, I can buy Japanese bond. German guy can buy Singapore company's bond. All of us go to one common place. Clear? Most of you do not know, in Europe and in US, the size of bond market is almost equal to the size of equity stock market. That means if there is say 10 lakh crore worth share market, there is almost 8 to 9 lakh crore worth bond market. People invest equally, almost equally in both. What is one advantage of bond? Fixed rate. Correct? This is all fluctuating, high risky. And in Europe and in America, people if they have invested 10,000 here, they would have invested at least 8 to 9,000 here. Even today in Japan, people invest huge money in post office deposits. Not small chunk, huge money. Why? Government. And safe, easy, convenient, risk free, and as good as investing in a bond. Lot of money. You won't even believe that much of money. As I told you, as much as investing in stock market. Indians are not, I'm not saying they don't invest much, but that's not their most favorite choice as on today. They still keep in bank FD. They keep in recurring deposits. Now slowly people are keeping in mutual funds. Then gold. Indians invest lot in physical gold, and then some money in gold ETF and other things, and then in stock market. But in Japan, also in some European countries and US, equal money, almost equal money is in bond market as well as stock market. If you watch CNBC TV 18 at the bottom, they show you Nifty, Sensex, US, NYSC, Nasdaq, S&P 500. Just next to that, they even show bond yield on daily basis. Even the bond rates keeps fluctuating. In India, nobody talks much about bonds because people don't invest much in bond market. I think the other day I told bond market as on today is not very popular in India because people like FD. Anyway, bond is also fixed interest. Why to go there? People prefer this. But I am very sure maybe 3 years or 5 years from now, Indian bond market will be equally big. People used to invest extreme heavy money in stock market in last 1 or 2 years. Now from last 3 months, they have understood why some money should be invested in bonds also. Because now most of the people are sitting with negative returns in their portfolio. Now they're understanding, had I kept half money at least in bond, 100 would have become 108. I have kept entire 200 in stock market, 200 has come down to 155. Had I done 100 in bank or bond, another 100 in stock market, that 100 would have come down to 70. But the other 100 would have at least gone to 108. People are finally understanding something about diversification. Okay. And one serious suggestion to all of you. We are discussing this based on what is happening in 2024, November, December, Jan, Feb. Markets are down and people are talking a lot about market being down and this and that. One thing you should know, most of the people who are talking today about market being down, especially youngsters, they started investing only after COVID. So they have never seen market going down. First time they're seeing 8-10% down. Therefore, all this overreaction is happening on Instagram and YouTube shorts. Had they started investing in 2018 or 19 itself, compared to COVID, what is happening right now, you will not even feel your portfolio is down. I had seen my portfolio going down 38%. 38. Some stocks had gone down more than 50%. One stock was 58%. That was the highest fall. Now, if you have seen 58% down and still you had kept that share, now 8%, 10%, why will you overreact? Most of people came to stock market in last 4-5 years. From the time they came, they've only seen upward trend. Now suddenly a downward trend is creating trouble to them. That's why you notice if that person is slightly old, the one who is doing this reel or short, he is not saying market is in big danger, etc., etc. All these young people have extra time to do Instagram reel, who started investing from 2021-22. From that it was only green and green and green. Suddenly they are seeing red for the first time, and these guys bought heavily in 2023-24 when market was all-time high. First of all, you should not buy when market is at all-time high. If you buy at all-time high, from there even 10% fall is a big fall because you're falling from a high point. Now you need, these guys who bought in 2023-24 will learn a good lesson. According to me, lesson is yet to come. One more big lesson. Luckily, they should thank Nirmala madam this time that she did not do anything in budget to affect stock market further. Had she increased security transaction tax or capital gain on stocks by even 0.23%, these people would have uninstalled not Demat account, even Instagram by now. Okay, luckily finance minister did not do anything related to stock market. Even then you see fall is more than 10-12%. Even today as we speak, market is further down. Why people are talking too much? Because they have never seen a down. Understanding what I'm saying? Those who have started investing from 2004-5, they have seen Manmohan Singh government going out. That day, single day market was down 15%. Single day, Nifty was down. Single day, not over a couple of months. Market opened at 9:15. 9:20 they closed market that day. Once it comes to a particular point, they don't deal. It's called lower circuit, upper circuit. If it reaches too high or too low, they stop. Single day, if you want, I'll send that video. 2004, after Manmohan Singh's government went out, 15% single day down. Today's people don't know how it feels. Single day 15%, and next day morning it did not come up, by the way. It went down 5% more over a week. And then 2008 Satyam scam, dot-com bubble, Lehman Brothers, and then directly 2020 COVID. Whoever has seen these already, they are not crying from last 4 5 months because 8-10% is just a pause in a long run. So according to them, it is not even a, a big fall. They're not even reacting to all of this. In fact, they're happy. They're adding funds and buying good stocks. They wanted this kind of fall someday. Finally happened. Understanding? So all this overreaction that you see is only because of people who started investing after 2020. You know how people behave. They saw someone making more money in stock market. They feel, okay, I should have also started. At least let me start now. Like this, they started in 23, 24. And 23, some of them started. Ukraine war started. Then it went down. After some people started, then now from last October 2024, they have been seeing the fall after fall after fall. It may fall further also, but these guys, if they don't know how to handle red, then they will never know how to enjoy green. So whoever is talking too much, they should have understood you should diversify. Why bond fixed rate is a good instrument when market is falling like this. At least instead of putting full 200 in stock, had you invested 100 in bond, first of all 100 is safe, plus you earn 8. In stock market 100 itself is not safe. Forget earning plus 8. People thought I'll make 200 into 21%. Forget plus 21%. Your principal itself is down. So why you should also learn to diversify. This is the reason. When markets are down, at least some part of your portfolio will be safe, if not full. That is why even today, many stock market investors also buy side. They may not buy a house with a depreciating asset, but they also buy side because they know land is an appreciating asset. Even if bank FD rate goes down, even if stock market is down, at least land will have an appreciation. So if they have say 1 crore portfolio, 40 lakh will be inside, 30 lakh will be in stocks, another 30 lakh in FD. So under any circumstance, they will have net green. 2 may be red, 1 will be green, or 2 may be green, 1 may be. If all 3 are green, fantastic. They withdraw some money in that time. Enjoy money, making super profits. So bond is one such instrument which is for diversification from high risky stock market. Some money at least should be in a low risky bond market. I am sure after 2-3 rounds of bear market in India, people will start checking where to invest for fixed rate of return. My guess, the so-called boring FD will get attraction in few years. Okay, people will start making real why FD is good. Now reverse is the trend. You will see this also, because one day people will understand I should not put all my money in stock market. Then the next best and easiest is to put money either in gold or silver or land. If not anywhere, then bank FDs. So the trend is going to come back. May not be exact bank FD, but surely bonds will become more and more popular in the years to come. More the volatile market, more people will search which is a safer investment. Yes. And you notice this also. Whenever the stock market is at peak, gold goes down. And whenever stock market is down, gold rates go up. Because people want to shift from high risky place to low risk. What I am saying is from day one only you segregate money. Instead of waiting for the bad day to come and then search for which is a safer place. From start you do equal investment in both the places. Right. Just a second. I had one. I think this was the one. Yes. You're able to see? Blue line is, you can see here, gold. And the other one is Nifty. And if you see in last 15 years, 2008 onwards, they've always gone in reverse direction. Can you see my mouse pointer also? Yes. Hmm. You see this initially 2008, and then you see the reverse trend, and then 2012. Hardly there are any points where these two lines met. Can you see? This is one place where they both met, and this is your 2010, 11, 12, when the gold was considered better than the stock market, and this is when this Satyam's effect, Lehman Brothers problem came into. And you know what happened in 2020? This is your COVID period, and look at the gold around that time. Whenever market goes down drastically, people invest in a safer place. And then you see now what is happening. 2024 markets have given better return, therefore gold, I'm not saying it is down, gold is overall gone up. In comparison, if you see, these two lines never meet. Very rarely, only at a crossing point they meet. After that, one is up, the other one is down. This is what people do for diversification. Look at this, one is very high and the other one is low. Everywhere you see, the day this has gone up, the reverse trend has started. See, this is low, this is up. Look at this, this is too low, and this was, I think, 2020 COVID period. And then market recovered by end of that year. People, that was one point. You know what happened? Funny thing here, between 2020 and 2022, if you can see here, both rates were almost same. This was the point. I still remember I had laughed at this image that day. First wave had gone, second wave was about to come. So people did not know seriously whether COVID has gone or not. So they did not know whether to still keep in gold or shift to stock market. That's when this was happening. When you know COVID has not gone, you will still prefer a safer one. Some people thought COVID will never come again. Some people thought one more wave is about to come. People were in that confusion. You were also in that confusion. I was also in that confusion. First wave went, we thought, okay, done now, no more. And then we realized again, second wave came, and look at what happened. When second wave came, again 2012, if you remember, 22, the reverse started. I still remember that day, news anchor was saying, for the first time in many, many years, gold and market both are in same point. That was the point. I remember I was in one of the events in some family function. They allowed functions to happen because government also thought COVID is gone. And first wave had gone. Second wave, some were doubting, some were sure. Nobody had idea, but you know, everyone was making their own theories. And then you see, over a long period, if you check, these two never met. Whenever they met, that was only to cross. See here, this started going up, this went down. After that, this was continuously down, this was up. And then they met once and then again reversed. This was the only period where I can see 2010, around this time, where both were almost together for a couple of months. Otherwise, you see the long run graph, they were always in reverse trend. What I am saying is, instead of doing this circus, why don't you from the beginning invest equally in a risky place and a low risky place? And this is what they call as diversification, right? Bond is one such instrument which is very good for diversification. Yes, fixed interest. I'm not saying gold and silver will give you fixed interest, but if you see long run gold, long run silver prices over 3, 5, 10 years, the risk involved is much less compared to a stock. I know Infosys would have given better return than silver, but then Infosys gives you that risk also, correct? But silver or gold will not jump too high or jump too low. If it jumps too low, imagine gold goes down drastically, what will happen? People will be in queue tomorrow in front of all jewelry shops, and then suddenly demand will pick up, price will go up again. Therefore, people will not let that price also fall. If it falls, I told you, demand supply gap, again, I will also be in queue. If gold comes to half of what it is today, everybody will be in queue. Suddenly you can't create gold, right? So because of demand supply gap. Why I am saying silver, those who are interested, check about it. Most of the solar panels, most of the computer devices, most of the electric vehicles, laptops and all of this, they need silver. And silver also has some medicinal value. Silver demand is more in industries than for you and me for household consumption. And people have started accumulating physical silver like how they used to accumulate gold. And as gold becomes costly, silver starts appearing cheap. It's not cheap, but those who can't buy gold, at least they can buy silver now. I wanted to gift you gold, but it's too costly. I am gifting you silver. Like this, there are many people. And normally during Dasra Diwali, people buy gold, 1 gram coin, etc. This time they bought more silver in India for the first time. More silver was purchased than gold in the history. And I think most of you know in economics, any bank, if they have to print notes, they have to keep gold reserve. Correct? They can't print just like that. For the first time, 3, 4 big countries, including Russia, they have started accepting silver to print notes. That means going forward now, even banks will start buying silver. All of this together, silver demand has shot up, and silver is also as safe as investing in gold. Therefore, if you want to invest in stock market, some amount at least, if not equal amount, should be parallelly invested in one of this. You may not invest in bonds because of high principal value, but definitely silver and gold at small amount level, on monthly level, more like an SIP. I seriously encourage all of you to read more and then decide. But silver and gold should also be in your portfolio if you want some peace of mind in long run. Okay, short run, I know that thrill won't come in gold and silver, that comes only in stock market. But in long run, people don't want thrill, people want peace over a period of time. And today you want thrill. As you grow old, you will not like thrill much. Okay, so you would choose a safer, slightly less return kind of instrument. Silver and gold are two good investments. Okay. Foreign bonds, again, euro bond and foreign bond both are same, but there is a small difference. If you read the definition or the text, you will get to look at this. Euro bond, I'm reading. US company, its bond denominated in USD, issued in Japan in yen currency. If you read once again, US company, originally their bond is in their currency. They went to Japan, but they're not issuing it in their currency, they're changing the currency also. That means here country also changed, currency also changed. Able to follow? Now tell me, if you're a Japanese investor, you are buying that foreign bond in your home currency because company is converting. Now read foreign bond. Read second line. This is more like euro bond, just with the difference with respect to currency in which the bond is issued. A British firm placing dollar denominated bond in USA. Now, for British, currency is different. Now, if you compare previous one and this one, country also changed, currency also changed. But here, both are not changing. Read the difference, both you will understand. A British firm company here, a British company is issuing dollar denominated bonds in USA. Again, whether it is foreign bond or euro bond, the transaction will have to happen across the border. But nobody physically has to go today, and you will not require those permissions and foreign currency conversion and all of that. That is a main convenience fact. This is interesting. Some will have confusion also. Read floating rate. Floating rate, when you see, one thing is sure, the rate of interest is not same, keeps changing. Read once again. These are issued up to 7 years maturity. Interest rate is underlined, adjusted to reflect the prevailing exchange rate. They provide cheaper money than foreign loans. What is this? Interest rate is adjusted to reflect prevailing exchange rate. Follow. I'm an Indian. My currency is INR. I'm investing in a US company bond. $100, $8 is annual interest. My problem is I will convert it to my currency, and that my currency conversion, I'm just taking an example, 100 rupee, then I'm getting 800 rupees interest every year. Now please tell me, even if they pay same $8, 5 years, are you sure you will get same 800 rupee? You understood my question? They will pay same, but will you get same? Why will you not get? Because of the conversion. Correct? Now what some companies do, they will give you an offer. Boss, you want 800 rupees every year? Okay. You will get 800 rupee every year. What they do, they will adjust the interest accordingly. Suppose currency conversion is 100, they will give you 8. If currency conversion is 120, they will give you less than that. In Calci, do 800 by 120. 7 point. Now what they do, they'll not give you $8, they'll give you only 6.67. Okay, what if currency conversion is 89 rupee? Now do this. 800 by 89, they will give you 8.98. Now tell me, by doing this, what is happening? The investor is getting fixed interest in his home currency. That's why in the textbook you see what they said. Interest rate is adjusted to reflect the prevailing exchange rate. Whenever exchange rate is changing, they will change the interest rate also, so that you sitting here will get a fixed amount. Because the whole purpose of investing in bond is that you get fixed amount. And then if you still have currency changing like this, then you will never have fixed amount. Therefore, some companies offer this also. You want 800, we will give you 800. Currency conversion, we will take. In a way, becomes good for an Indian investor. You don't have to check what is the dollar INR rate also now. Because you know all that you are going to get is 800 only. Next one, Euro commercial paper. I think in previous session we discussed commercial paper. Remember the problem, Diwan Housing Finance. And again the word is Euro, means international. That means if an Indian company issues commercial paper to non-Indian, a foreign investor, then it is called international commercial paper, or in simple words, Euro commercial papers. Just a second. Yes. Next one is fully hedged bonds. This is difficult to understand if you do not know what is hedging. So I'll first explain some basic examples on hedging, and then you'll understand what is hedged bonds. Listen. Suppose there is this is not a correct example, but easy one for you to understand. Okay. Suppose there is India Bangladesh match. Those who follow cricket, India Bangladesh match is happening today. Now I want to bet, saying India will win 1000 rupee bet. Tell me what is the risk that I am taking in this bet? I may lose 1000. What is the expected return if India wins? 1000 rupee. Simple question. This is risk because it can go anyway. Tell me, how do I reduce the risk? I want to do betting, but I want to reduce the risk. What to do? Sorry? Instead of this, sir, bet 500 saying India will win, another 500 saying Bangladesh will. What will I make end of the day? Zero. Guys, I want to still make some money. I'm ready to take some risk, but I don't want to have a risk of 1000. Then tell me how to do the bet. I hope you're understanding a question. Very simple one. I want to bet. I'm ready to lose something, gain something, but I don't want to take a risk of losing 1000, gaining 1000. Tell me, how should I bet? You don't play Dream 11. Boys, at least answer this. You don't play Dream 11. Rummy Circle. You get those coupons, no? Never used. You know, funny story. 17 crore people in India play Dream 11 and Rummy Circle. 17 crore. Only 3 crore people have mutual funds. See our seriousness towards money. 3 crore people in mutual fund. 17 crore Rummy Circle, Dream 11. Tell me how to bet such a simple question. I want to bet. I'm now listen, don't give me zero profit, zero loss idea. This 500 won't help. Okay. I want to bet, but want to bet with limited risk, limited profit. Tell me what should I bet? I was expecting answer for this question at least. I am betting 1,000 rupees saying India will win. How to reduce my risk? Definitely, if risk comes down, reward also will come down. I am okay, but I don't want to risk so much. Tell me what should I do? Huh? Bet 800 rupees saying Bangladesh will win. Now you tell me, what is one outcome? India wins. How much is my net gain? 200 rupee. What is another outcome? Bangladesh may win. Then how much is net outcome? 200 rupee. Sir, now also there is risk, but understand, from 1,000 rupee risk I brought down to 200 rupee risk. I said I want to bet, but I don't want to risk 1,000 rupee. You know what I did? This is called hedging. Hedging is basically protecting yourself against unlimited risk. Able to follow? Sir, why did you bet less money for Bangladesh? You could have done more money. You know, this more or less depends on whether I think India has a better chance or Bangladesh has a better chance. I think India has a better chance, therefore I'll bet slightly higher. You know, those who can't take too much risk, what they do? They bet 980 rupee here. Now tell me, maximum risk, loss of 20, maximum reward, gain of 20. You are still playing the bet, but you have reduced your risk. So hedging doesn't mean you will reach zero. Hedging only means you will reduce the level of risk. You may still lose. Don't give me idea 1,000, then don't call it betting. Sleep at home. What is the use of 1,000? This is not even betting, correct? There should be some risk. There should be some reward also. If you don't want to take even this risk, then go for 995. Maximum loss 5 rupee, maximum gain 5 rupee. Up to 999 it's called betting. At 1,000 don't call it betting. That means one thing many people do not know. Hedging doesn't mean you will make your losses zero. There can still be loss, but then the level of loss will come down. It's like wearing a helmet while going in bike. I'm not saying you'll never die, but with helmet chances of death is less. You may still die. Who said you cannot? Not you. Okay, I may. No, people don't like this conversation. I wear helmet, there is still a chance of accident, but with helmet the risk has come down. Correct? Now tell me, what is hedging in foreign currency? If you understand basic hedging, then you will understand those three lines. What is hedging in foreign currency? Same way, $100 I have to pay somebody 3 months later. Right? Today currency conversion rate is say 83 rupee. That means today itself, if I purchase those dollars and keep it with me, 8,300 is the outflow. But I won't pay today. I'll be paying after 3 months. Sir, then do one thing. Don't do anything for 2 months, 29 days. That day go to bank, buy dollars that day. What if that day rate is 88 rupee? Then unnecessarily I'll pay 500 rupee extra. Correct? Therefore, now how to hedge it? If you are going to pay somebody after 3 months, also create another contract where you will be receiving $100. Now what happens that day? If 83 becomes 85, both way it is 85. Able to follow? But again, as I told you, betting will not be same 83. It will be slight difference, at least 82.9, like the Bangladesh betting one. 82.9 or 83.1 depends on where you think it may go. So what is hedging now? If I have to promise somebody that I will pay you $100 after 3 months, I also sign a contract with somebody saying I will buy $100 from you. So if the rate 83 becomes 87 here, this also 83 will become 87. In a way, I am safe. Rate may be too high, rate may be too low. I know if I lose this side, I will gain that side. Net, I have reduced my risk. Hedging means this. I won't remember, it won't be exact money. This is 87.1, this may be 86.9. But Instead of sitting without any protection, with hedging, I protect myself, right? If I say I will collect from somebody and I'm worried what if rate comes down, also sign a contract to sell it to somebody. If rate comes down, rate is down here also. If rate is up here also. Some of this is called natural hedging. This you will study in CA final. What is natural hedging? You do both import and export. Now tell me, you are not worried much about the foreign currency conversion because goods are coming to you, dollar is going out, and goods are going out, dollar is coming in. Net net, whatever fluctuation happens here, that gets adjusted here. But how many companies do both import and export? Many will do only import of raw material and supply within the country. Or many people buy within the country, supply outside the country. That means natural hedging happens well and good, but both coming and going in USD may not happen to a lot of the companies. Therefore, they have to manually do hedging. Naturally, it will not get hedged. Yes, you tell me, if you have to pay $100 to somebody on 1st June, and you also have to receive $100 from somebody on 1st June. You have to pay somebody, you have to receive from somebody. Same $100, same date. Are you worried? Should you check the rate? Does it matter to you? No. 1st June, whatever is the rate, it will come here, it will go here. This is called hedging. Now imagine if this was not there, only one was there. I have to pay $100 to somebody. Then every day you are checking. Is the rate up, rate down? Should I buy now only? Should I wait? Should I sign a contract? All of this because there is no hedging. Able to follow? Now what is fully hedged bond? That bond which gives you protection against the foreign currency fluctuation. Not every bond will give you this fluctuation. I told you one of the bonds, whenever rate was changing, they were changing the interest. Net net what happened? Your 800 did not change. That means in a way you protected yourself. Tell me, by taking an insurance, is it not a kind of hedging? If I don't have an insurance, I am sitting with unlimited risk. With insurance, I know at least some burden is reduced. By the way, do you know even with insurance, if you get admitted to hospital, some money you will still have to pay. It's not 100% that taken care by them. If bill is 48,000, you may still have to pay 2-3,000. But if you don't have insurance, then entire 48 is on your shoulder. Correct? Insurance is also, wearing helmet also is a kind of hedging. It is not that it will make your pain zero, but it will reduce the effect of the pain. Yes, everyone who is doing foreign currency transactions, they do the hedging. Some people sign forward contract to hedge. What is forward contract? Sign today a contract to be executed after 3 months. Whatever is the rate in the market, I will buy at this rate. Now I know with peace my rate is this only. Market may be high, market may be low. I think one of the sessions we discussed callable bond, puttable bond. They have a call option to cancel, right? Take an example, everyone. Listen to this, understand. Follow the numbers, otherwise you will get in trouble. Suppose there is a tender coconut trader and then there is a farmer. Okay. On 1st June, this tender coconut trader wants to buy 10,000 coconuts from this farmer. Now, today, suppose we are standing on 1st of April. One option, don't do anything today. Let entire April get over, entire May get over. 1st June, you go and buy from him. But the problem is, 2 months, you will be checking what is the rate. Because it may go up, it may come down. So what is the best thing to do? On 1st April itself, they will sign a contract saying what? On 1st June, 10,000 coconuts I will buy from you at 35 rupees. And they agree. Now you tell me, on 1st June, possibility number 1, rate in the market may be 37 rupees. Correct? Now please answer, is the trader happy or unhappy with this? Hope you are following the numbers. Contract is for 35, and this rate is called spot rate, by the way. And this rate is called forward rate. Forward rate because it was signed, correct, in the past for a future period. Now tell me, is trader happy? Why is he happy? In market 37, but you have a contract at 35, buy at 35, sell at 37 that day itself. Then also you make 2 rupee profit. Okay. Second, what if spot rate is 31 rupee? Will trader be happy? No, is unhappy. Is farmer happy now? Yes. Can trader now call farmer and say, I am not coming, I won't buy from you? Can they do so? No. In a forward contract or future contract, you can't do this. But if it is, don't get confused, if it is option contract, then even this is possible. What is the possibility? Now, the trader will decide whether on 1st June he will come and execute the contract or not. Now apply common sense. If in the market rate is 31 rupee, will trader come and buy it at 35? No. Why to pay 4 rupee extra? But if in the market it is trading at 38 rupee, will he come and buy? Yes, because it is available at 35. Sir, but if you do this way, it is only helping trader. No, farmer is not getting any benefit in this deal. 31, trader won't come. 38, trader will come, but farmer is not happy. Correct? Therefore, you know what farmer says? If you want this option, you give me 5,000 rupee today itself. And this money is non-refundable. They call it as option premium. This is what you see in stock market. Call option premium. You pay premium now only. Now tell me, on 1st April, what has happened? Trader has paid 5,000 rupee to farmer. Correct? Now on 1st June, if the rate is 31, you answer. Will trader come to farmer? Yes or no? Guys, you have to think, don't be like this. If in the market rate is 31, will trader come and buy at 35? Why will he buy at 35? Because in market it is available at 31. That means this contract will be lapsed. But this 5,000 that is paid already will not be refunded. Now how much is the gain to the farmer? 5,000 rupee only. Hello? Sir, but farmer will have to sell it in the market at 31. Why should you sell at 31? Farmer will wait. He will wait for another 2-3 days, 5 days, 10 days when the rate is good. He will sell anyway. That 5,000 is his money. Now tell me, in the market if rate is 38 rupee, will trader go to farmer? Yes. He will buy it at what rate? 10,000 into 35. Now farmer will feel, sir, market rate is 38, but I am selling it at 35. I am losing 3 rupee. If there was no contract, I would have made 3 rupee extra. How many coconuts you are selling? 10,000. That means he thinks he has lost 30,000, but actually has not lost 30,000. He has already collected 5,000 premium. Net he is losing only 25,000. If it is 31, entire 5,000 is his gain. If it is 38, this guy will come. That time I have to sell at 35 only. But at least good thing I did is I collected 5,000 premium. Sir, if this is the case, we'll collect more premium only. You are ready to collect, but trader should give you. Understanding? Now in stock market, this trader is a call option buyer because he's buying a right to purchase coconut, and this guy is a call option seller because he has collected premium. Once premium is collected, farmer is not at all worried. Even if rate goes up or down, he knows at least that 5,000 is safe. Anything else can happen on June 1st, but 5,000 is at least safe. So why people do all of this? Both of them want that piece. 35 is known to both of them. This is called hedging. Now the market rate may be 31 or 34 or 35 or 39 or may go to 41 also. But both of them know that deal is already signed for 35. Understanding? By the way, you should know one more thing. You will get confused. This trader, when he is signing this contract with farmer, he would have signed another contract with another trader to sell these coconuts also. Correct? So ultimately farmer is growing. After that, from this trader to this to this to this keeps happening. And if you change Coconut make it Infosys share, and that is what we are discussing in stock market. Call option, put option. Call option is a right to buy. This guy has a right to buy, whether to buy at 35 or not, that he will decide on June 1st, depending upon whether the rate is 31 or 38. For that right to enjoy, he has to pay premium. Correct? That means farmer is selling the call option. Trader is buying the call option. People buy Infosys call option. I explained to you with tender coconut call option. Yes. Now, why hedging is important? The 35 rupee, why was it important? Both of them know that I don't have to check the rate in market. This hedging is done for foreign currency. This is done for commodity. This is done shares. This is done for bonds, because nobody wants to have unexpected too high, nor they want to have a too low. Yes. Again, the wording is euro issues, but don't understand euro issues as European. Euro issues is anything. Yes, international. Three varieties: global depository receipt, American depository receipt. Some of you have studied these two, but in reality, there is one more, but nobody talks about this much because they're not very famous. They're called Indian depository receipt. Can we take a quick break? Yep, 5 minutes. We'll then continue. Yes. Continuing with this euro issues, basically again international investments. In that first one is American Depository Receipt. Mark this: ADR, GDR, both important. IDR is also important, but once you understand ADR and GDR, it becomes easy. You can also check this after the class. Some of the Indian companies have American Depository Receipts. HDFC Bank has, Infosys has. You can just type Infosys ADR, you will get to. Listen, let's understand why we need ADR, why we need GDR. Suppose there is one investor in USA. Now his local currency for him, its home currency is dollar, and he has his account in New York Stock Exchange, yeah, like BSE, NSE, for them it is NYSE. Now he wants to buy Infosys shares. Now Infosys company is using INR and listed in Bombay Stock Exchange or National Stock Exchange, right? Now how will he buy the share? First of all, okay, if you want to buy the share, what is the procedure? If I want to buy, if she wants to buy, what is the way? What to do? Open a demat account. Now to open a demat account, they ask some documents. Tell me, whoever has opened, what are the documents that they ask? PAN number, Aadhaar number, OTP verification, that means your local mobile number, India number. What else? Video verification sometimes, or the photo, signature on a paper, take a photo, all of that. Now tell me, will USA investor, will he be holding Aadhaar number, PAN number? Then how will he buy Infosys share from BSE, NSE? Correct? He can open one special variety account. When you guys open demat account, it will ask you nationality. By default for you, Indian will be ticked and you will move to next category. But if you select the drop down and you change the nationality, then the document list and other things will change. But even then the problem is, his money is in his currency, but Infosys share is not in that currency. Infosys share is in another currency. That means first he has to open one stock trading or demat account in India. For that, all documents are different. Second, he has to convert his dollar to INR. Third, Infosys will give dividend at the end of the year, but that dividend will be in INR. He has to again convert it back. Fourth, someday he will sell Infosys share. That income will come in INR. He has to convert again to dollar. Every time conversion, one, there is a cost. Second, there is permission from the bank. Third, rate may go up or down. There is that uncertainty. If you do all of this, a USA investor will never invest in Infosys share with all this paperwork and procedure. And luckily now we don't have this problem. 15-20 years ago we had one more problem, whether to tax that income in India or in US. Some places it used to get taxed twice. We pay 9 rupee dividend. There you pay tax in India, take only 8 rupee. In your country on 8 also you pay tax. Now these problems have been sorted out. In CA final you will study something called as DTAA, Double Taxation Avoidance Agreement. Two countries have signed an agreement where a same individual for same income will not pay taxes twice. That's it. That's why it's called Double Tax Avoidance Agreement. Now you don't have this problem. Earlier even this was a problem. You pay tax on same income in two different countries at two different rates. Yeah. Therefore, what is the solution? Can Infosys go to USA and list in NYSE itself? Again, the problem, to get listed in NYSE, they have a rule that you should have company's head office in our country. Now, can Apple come and get listed in Bombay Stock Exchange? Not possible, because they should first have an office here. Head office should be here. It should be an Indian company. As of now, it's not an Indian company. Therefore, what is the solution to this problem? Infosys will convert 10 shares and make it one depository receipt. And since it is happening in America, it's called American Depository Receipt. Now, this one ADR is listed in NYSE. Now, if this investor wants to buy Infosys share, he will not buy Infosys share, he will buy the ADR. Now, buying one ADR means buying 10 shares. But good news is he will buy in his country, his currency, his stock exchange. He will not have to even worry about Indian Aadhaar card, this number, that number, conversion, permission. Nothing is required because everything is happening in his country's stock market. Now, whenever they give dividend, if one share dividend is 9 rupee, then for 10 shares it should be 90 rupee. That for one ADR will be paid in dollar. Then when he sells also, he is not selling the share, he is selling the ADR. That sale will also happen in dollar only. Now, no question of conversion, no permission needed, no risk also. Able to follow? Now the question, sir, why only America? Can a German guy purchase ADR? For you to buy ADR, you should first have account in American stock market. Now, why is it only for Americans? Why not for German, Japan, or Australia, Singapore citizens? Okay, even if there is global depository, next one GDR, why only for America's one and rest of the world one more? Why can't it be every country one variety? Next heading is GDR, global depository. Sir, maybe for everybody other than American, it is GDR. Good guess. But even then I am asking, why only for America one variety? Why can't it be GDR for everybody then? More than that, Americans have so much money to invest that they are ready to invest in every country's every company. No one invests as much as US people invest. Almost half of the population there have a demat account. In India, it is 4%. They have crossed 50%. Half of the population has demat account. Investing is like a default setting. If you are an American citizen, that means you invest. You are in stock market. They invest a lot. Now they have invested so much in their country company, they want to invest even outside their country. But going outside creates all that problem. Therefore, companies only go to their place. And all of you know America is world's largest economy. A country cannot be largest economy unless their stock market is super wealthy. And you have a lot of individual big investors, a lot of mutual fund companies, insurance companies, banks. China is next. Currently, India is the 5th largest economy in the world. Now, if it is first largest economy, one of the reason is also because people want to invest. People are ready to take risk. Americans are risk takers compared to other countries. Okay. That is why most of these companies, Infosys has gone to America, and Infosys was the first company to register its ADR, first Indian company to go. Now you have a lot of Indian companies, and that event made a headlines in the world newspaper. That first Indian company to have ADR listed in NYSE, Infosys was that company. That video of, it's more like an IPO not of shares, IPO of ADRs in that market. That was a very big recognition for Infosys. Now every day, what people do? Indian market starts at 9:15 a.m. That time US in India night is USA previous day, correct? So how will Indian Infosys share move up and down? People predict based on how much was ADR price. Okay, you missed it. 9:15 a.m. to 3:30 p.m. India stock market. Then Indians have to sleep peacefully. Next, when will Indian stock market open? 9:50. Tell me, from 3:30 p.m. to 9:15 p.m. when it is night to us, it is daytime in US. That time, tell me, in US market, Infosys, if it was trading here, Infosys ADR is trading there. Suppose there is some bad news about Infosys at 8 p.m. Now tell me, Indians will get to know the effect of this only tomorrow. But then before that, if you get up early and check at 5 o'clock what is happening in USA stock market, If it is a bad news, that bad news will already be there in the ADR itself. If ADR has fallen by 4%, you also be ready. 9:15 when they open, here also it will easily fall 4%, because ADR is nothing but collection of shares. One ADR is 10 shares. That means if share is going to go down, ADR also will go down. And Americans check Indian stock prices before starting their trade, because by then we would have completed our day. Understanding what I'm saying? If Indian time evening 8:30 p.m. is when US stock market opens. Now somebody who wants to buy this Infosys ADR 829, he will check what was the 3:30 p.m. closing price in India, because he will get a hint where it may open at 8:30, and these guys will close when India time is around 4:30 midnight. For them it's an afternoon. So if something is bad news, that bad news will reflect anyway in ADR. Okay, you can read about it. If you have phone, just quickly check once. Everyone, check this Infosys ADR. Are you getting a number? Infosys 21 point. Which website you checked? Investing.com. This one. If you see here, yes. See this. All of this is in dollars. See, this is all about Infosys only. That means the person who is buying this Infosys ADR is technically buying Infosys shares. But buying share will have those issues of converting INR and permission and all that. So all the story that you have is about Infosys only. He's technically buying Infosys instead of buying stock. He is buying ADR. All these details are related to Infosys only. There is no some other entity called Infosys ADR. Same Infosys converted to that currency. Yes, if you type Infosys ADR, see this. What is the meaning of? I'm just checking what Google is showing it. The Infosys financial year ends on March 31st. In which stock exchange are the Infosys shares? American Deposit. Some random Google search. This is. It says American Depository Receipt. The equity shares of Infosys are listed on BSE NSE in India, and its ADR is listed in New York Stock Exchange in USA. It is not ADS, it is ADR, American Depository Receipt. And they ask what is the price. This is the ongoing price. See this. No, this is something else. No. See this. American Depository Receipt offers US investors a means to gain investment exposure in non-US stock. That guy is not buying that country's stock. He's buying an Indian stock. Dealing in without, this is what I told you, without the complexity of dealing in foreign stock market, they represent some of the most familiar companies in global business, including household names such as Nokia, Shell, and Unilever. These companies, a lot of Indian companies are there now, but the first company was Infosys. See this. How many shares one ADR is equal to? HDFC Bank, one ADR is 3 shares. In my example, I told you 1:10. That depends on, see this, each ADR is backed by specific number of issuers' local share or a fraction thereof. HDFC also has ADR. You can check any. See this, is HDFC listed? The equity shares of HDFC are listed in BSE and NSE. Its American Depository Receipts are available in NYSE. That means that company stock is not listed. But if they want to buy, they have to buy it through this route. Understanding? Can I close this? Everyone, come to GDR. You tell me what must be GDR now. If American Depository Receipt, read from textbook. If ADR is for American investor, then what must be GDR? Global Depository Receipt. That means this is not restricted to just America. Yeah, read. I'll read ADR once again for your clarity. These are securities offered by non-US company. We took Infosys example. Infosys is a non-US company. They want to list on any of the US exchanges. That means Indian company want to go there. Each ADR represents certain number of regular shares. I told you 1:10. You saw HDFC was 1:3. This will allow US investor to buy share of these companies without the cost of investing directly in foreign stock market. So they don't have to worry about this cross-border investing and that RBI permission and all that headache. Now coming to GDR, look at this. Held in the bank of one country, representing the specific number of shares of a stock traded on the exchange of another country. Now that means this is not restricted to America. That means a Japanese company can issue JDR in Singapore. An Australian company can do this in Germany. But when it is done exclusively in America, it is called American Depository Receipt. Why only for America one separate system? Because of the amount of investment that they are ready to do. Now, I want you to answer without reading from textbook. What must be Indian Depository Receipt? Give me example. Sir, there is an Indian investor, Mr. A. His account is in INR and he has his account in BSc NSC. Okay, now tell me what is IDR? A non-Indian company. Am I correct? A non-Indian company, let's say Google. Okay, Google Inc. Continue. What they should do now? They should come to India, BSc NSC. Okay, then convert what? Google's 10 share will become 1 IDR, and this guy in his account he can buy 1 IDR. Now if he wants to then sell it, he will sell IDR only and everything is in INR. Exactly reverse, where Infosys went to US, now Google has to come to India. Please answer, why is it not so popular? Because Indians don't invest. Forget investing in Google. Indians don't invest in Indian company itself. Where is the question of you investing in Google? Understanding? There is one more thing I want you guys to read. There are certain mutual funds who invest in non-Indian companies also. That means if you do your say monthly SIP there, all your money is going to non-Indian companies. That means some money, at least if not 100%, some money they invest in outside of India also. That means if you want to buy Tesla shares or Google shares, Microsoft, heard of a Chinese company called Alibaba? Know this name? Now how do I buy a share of Alibaba company? How do I buy Facebook share? How do I buy shares of Google? I can't, because number one, their IDR may not be there in India. If it is there, well and good. If it's not there, then there is no scope. A lot of mutual fund companies have come up now where you give them money, they buy. And they can buy because they're getting so much of SIP money, they are sitting with hundreds of crores of money. They can easily buy. You and me buying can be problematic, paperwork, procedure, RBI permission, but they do it in bulk, becomes easy for them. For your reading purpose only, this is not investment advisory. There is one mutual fund called Parag Parekh, PPFAS, Parag Parekh Mutual Fund Company, and they have one fund called Flexi Cap. Okay, you know, large cap, mid cap, and small cap. Flexi Cap is they move money between these. Their fund, if you check, almost 15 to 18% of the SIP monies goes to US companies. Okay, this is one way in which if you want to invest outside India, you can do so. Yeah. There are a lot of mutual fund companies. I just got this name in mind, so I told you. There are mutual fund name itself which has this US Technology Opportunity Fund. That means 100% of your SIP is going to US tech companies. Only tech, not non-tech. But uh, these companies, this company particularly, they invest outside also. If you just have 1 minute, I can show it. Parag Flexi Cap. Out of anyone knows this? Hmm? Sorry? He is a CA. That's okay. Do you know about the fund? Parag Flexi Cap Fund. By the way, this is not recommendation. They're not giving me any commission for doing this. See this. This is the one I was talking about. And if you see where they invest money, holding is where they invest. Okay. And if you look at some of the companies after HDFC and this list, can you see this? Meta, Alphabet, Amazon, Microsoft, and I remember there was one more. Anyway, even otherwise, okay, it's a big list. Somewhere 1 out of 130. If you see this, one second. There are a lot of, there was a list. I don't know why I'm not getting this. If you see this, sorry, there's a big list of 139 companies. Here it is. Yes. Can you see the percentage here? So if your SIP is 100 rupee, in that 8 rupee goes to this. That's the meaning of this table. If you just see here, this is about here. Can you see foreign equity? This is what I was trying to check. 3.9. This is 3.7. Another 3.15. Another 2.94. And this is CD is certificate of deposit, treasury bills, equity, and almost everything else is equity. Futures also they buy some of this. Here they invest 79% in equity, 19.5% debt, meaning bonds, debentures, etc., and balance 1.4% they keep it with them. Now there are companies like this, something called fact sheet. I think it will take too much time. Whoever has interest, you can check this. So if you want to invest outside India, this is one more way now. You don't have to buy IDR because IDR is not cheap, correct? 10 shares you have to buy, not one at a time. Therefore, the better way, if you're a small investor, go ahead with something like this. Yeah. See this, the concept of depository receipt, which is used to raise fund in foreign currency, has been applied here also. IDR is similar to ADR in the sense that the foreign companies can issue IDR to rise from Indian stock market in the same manner in which Indian companies go outside India to get that foreign capital. So it is almost in a way reverse of what we have discussed. Sorry? Yes. Can buy and sell. Morning you buy, evening you sell. Just like stock. But again, it is slightly illiquid. You may not have too many people buying and selling because again, this is done by slightly big investors because you can't buy 1, 2, 3. First of all, it's in dollar. Convert to INR, then not one. You have to buy minimum 10, 20, 30. Yes, part B questions, most of it we have already covered. Debt securitization, bridge finance, floating rate, euro bond, floating rate, almost all of this, commercial paper, leasing, call bond, put, ECGC guarantee, and these things we have discussed already in the previous session also. Done. So with this, what is printed in the text is done. Okay. Do you guys have study material with you, or should I open on screen? How many of you have it? Study material hard copy. Okay, let me see. Just a second. One second. This topic is in module 2, 1. Just a second. So this is the latest one that we have. The font comfortable. If you want to shift those, or in those 2 rows, if you want to shift, you can shift. Yes, whatever is not there in the class material, newly added part is here. So we are only marking those and discussing what is already done. The repetition, we will not waste time on that. There are a couple of new things called green bonds, ESG bonds, and these things that we will cover now. Okay. Yes. Coming to ICA study material, I'm just discussing all of that which is not there in the class material. These things: equity, classification by source, shares, debentures, long term, short term. We have covered all of this. Owner's equity, you have the table also: advantage, disadvantage. Initial 3-4 page in the class material was same thing. Preference share capital, and then you have debenture, reserves and surplus. All of this has already been covered in class material. Bonds, callable and puttable. These are some of the bonds. Foreign currency convertible bond, name itself tells you. If you have hard copy with you, just mark this table as important. Whoever has it, please mark it. Foreign currency convertible bonds, name itself tells you. Bonds are traded in foreign currency and then they are convertible in nature. And this bond has to be redeemed, obviously, on maturity, right? Plain vanilla bond. Read this. This is a newly added thing. The issuer would pay the principal amount along with the interest. This type of bond would not have any option. Now, plain vanilla bond is nothing but a simple bond. Otherwise, what is a feature? Conversion or warrant correct? Or callable, puttable, all of that. When nothing is there, what happens? You pay principal, I give you interest. After a agreed period, I will return your principal money. That means it is a simple bond. Name looks like it's something else altogether. This bond can be issued in the form of discounted bond or can be issued in the form of coupon bearing bond. Two variety, either issue at a discount, redeem at par, or issue at par, give some coupon. Either issue at 92, redeem at 100, or issue at 100, redeem at 107 or 108. Either can be at par or at discount. That's it. People think plain vanilla bond is some uh, new concept as such. Nothing. It is simple bond. Done. Convertible floating rate bonds. Again, floating rate bonds we discussed. The rate keeps changing. Convertible, that means you have an option to convert it to the equity share. Drop lock bond. Underline this. It is a floating rate note with normal floating rate. The floating rate bond would be automatically converted into fixed rate bond if interest rate falls below a predetermined level. What does it mean? We agree that look, once it is below 5%, your rate will not be floating. It will be 5 only. But if it is above 5, whatever is the ongoing rate, I will pay you. I'll give you an example. Suppose 5 years. First year 6%. Next year 6.8%. Next year 5.3%. Next year 4.8%. Don't worry. We agreed below 5 it will never happen. Once it goes below 5, from that you will get 5 only. But if it comes back to 5.4, then you'll start getting 5.4. That means you are in a way assured that at least 5% will come to you. That is why the name drop lock. The lower side has been locked. Read once again. The floating rate bond will automatically become a fixed rate bond if the interest rate goes below a predetermined level. That means they decide below 5%, we will never let this go. If it goes, you will get fixed 5%. That means on a lower side, you have a safety. That is why name easy to remember, drop lock bond. The new fixed rate stays till the drop lock bond reaches its maturity. That means you don't have to worry now, 5% only you will get till the time of maturity. That means you are on a safer side when you buy these kind of bonds. Otherwise, you can go to 7, can go to 3.7, again go to 7.5, can go down to 2.9. You don't want that to happen. You know 5% once it reaches, it gets locked. After that, no question of getting anything less than 5. Next, variable rate demand obligation. A normal floating rate note with a nominal maturity. The holder of the floating rate note can sell the obligation back to the trustee at par plus accrued interest. Again, read once again. Holder has an option to sell it back to trustee. That means it is more like a put option. If you remember, puttable bond where the holder has a right. Remember, callable bond where company can take it back early. Puttable bond is when investor has the right to sell it back. That's what they're saying. You can sell it back along with the interest receivable. Think about it. All of you follow this. 1st April I issued a bond. I am the company, you are the buyer. 100 rupee, 8% interest. When will you get that 8 rupee? 1st April I issued, you gave me 100. When will I give you 8 rupee? 31st March. On 10th March, you want to sell that bond. If you sell it to somebody at 100 itself, are you not at loss? Because that person who is buying on 10th March, in 20 days he will get 8 rupee. Correct? Therefore, what you can do, 100 plus 8% into whatever number of days, say 340 days by 360 days, that's called accrued interest. Add that and sell it back to the company. That means you can give it back to the company at 100 plus almost 7.8 rupee. That means I will buy it back from you at 107.8. Read what they said. The holder of the floating rate note can sell the obligation back to the trustee at par value 100 plus accrued interest. Accrued interest is interest up to that day. 10th March, you are in urgent need of money, you can't wait for 20 days, then don't worry, don't sell it to somebody else, give it back to the company. Accrued interest itself, we are ready to give you. Basically, it's a kind of buyback, but not just 100, it is plus accrued interest. That means in between, if you want to repay, return the bond, you have an option here. Yield curve note. Now this is difficult to understand at intermediate level, but read second and third point. Yield increases when interest rate goes down and yield decreases when the prevailing interest rate goes up. If you remember, we discussed one similar bond like this. When foreign currency rate changes, the interest rate was changing. That person wanted 800 rupee, just half an hour back, 800 rupee. So we kept changing, correct? So same way, what if it is same guy in US? Now no question of conversion also. So if the overall market interest is going up, that company will pay you slightly on a higher side, and if the overall market is up, that company will pay you on a slightly lower side. That means you will neither have a too high nor you will have a too low rate of interest. Yeah, this is used to hedge the interest rate. I told you, when the market rate is high, you will get at a lower one. When the market rate is low, you will get it at a higher one. On an average, you will never get too high or too low, because on the other side you have taken a hedge. I've explained what is hedge, and this requires some CA final knowledge of interest rate hedging, which is not part of your syllabus. Do not worry. I think Eurobond we discussed. Emerging market bond. You read the word emerging market. What must be the meaning? Emerging market. That means these are not the stock markets which are famous already. And whole world says India is an emerging market even today, because we are still not a well developed stock market. Definitely true, given that we have very less people who invest in stock market, and our stock market size is much smaller compared to US and China and all of this. Therefore they consider India as an emerging market. Indian bonds, I think some of these we have discussed already. Masala bond is done. We discussed yesterday, right? Municipal bond, government bond. This loan from financial institution, this part you don't have to go through. They have just given the year when they started the bank. I don't know what is the use of students knowing all of this. Okay, loan from commercial bank, bridge finance we discussed. Venture capital, 4 variety, all of this we have discussed. Debt securitization, I discussed with an example. In leasing, operating lease, finance lease, and the stable differences also we have covered. Sale and lease back we discussed. I think this is the same order in which you have it in the book already. Leveraged one, sales aid, close ended, trade credit, accrued expense, advance, commercial paper we discussed. Certificate of deposit, short term, OD, clean OD, cash credit, advance against goods, bills, discount. Financing of export, just yesterday we covered clean packing credit. LOC, we have discussed most of this. Hypothecation and pledge, ECGC guarantee. Forward exchange contract, I gave you a couple of examples. The tender coconut was a forward exchange contract. Discounting, ECGC we have covered. Bills sent for collection. Advance against duty drawback. Do you know what is duty drawback? Anybody, what is duty drawback? You know what is cashback at least? Tell me how cashback works. You pay first, then they'll give you some money. Next time when you do shopping, you can use that points or coins, whatever you call it. Same way, duty drawback is you first pay the duty and then government will give that money back to you. Duty drawback. But the problem is first you have to pay the duty and then claim from government. In between there is a time gap. Understanding? So what some companies do, they first pay the duty, say 25,000 duty they have paid, and then they apply to government for drawback of money. But in between there is a 30-40 days gap. They go to bank and take loan, saying what? Once that duty drawback comes to me, I will give you that money. Understanding? That's why the name is advance against duty drawback. Correct? There is always this 30-40 days of time gap. I will first pay, government will give me, but the problem is when government has to give, there is no time limit. They may delay. You know this very well. Most of the times when government has to pay money to you and me, there is no exact date on which I'm going to get. Sometimes it comes on time. Most of the time it is late. But then if it is late, it's a problem to businessman. So he goes to bank meanwhile and takes a loan. And when will he repay? the day he gets the money from the government. Subsidy is also same way. You first purchase and then submit the bill, and government will give you some concession. Basically, more like a cash back scheme. After this, intercompany deposits, some of this you will study in company law. Can one company keep money in another company? If yes, then it's called intercompany deposit. Some of them are with interest, some of them are without interest. Public deposit, this was that Sahara case that I told you. They took money from general public, more like bond, but bond and debenture value is high. This public deposit can be less also, 1000 rupee, 2500, 800. Mass public will invest than very few people investing 10 lakh, 20 lakh. One good case study for you to read about it is Sahara, India, but that is good to read, but in reality they defaulted repayment. So you will know what wrong they did than what right they did. Okay. Other sources, seed capital we discussed, accruals we discussed, unsecured loan, deferred payment. Deferring basically means delaying. This capital incentives market, this is given by government if you have a factory or an outlet in certain areas. Once you study GST law, you will get to know this. Some places, if you have a business, your tax rules are different. Some states, if you have some permission limits, are different. Some of you may know this. There is something called EOU, export oriented undertakings, economic zone, special SEZ, at least you have come across. Now, if I set up my factory in SEZ, there are a lot of tax benefits that I get. Read first line only, you'll understand. The backward area development incentive available often determine the location of the new industrial unit. These incentives usually consist of lump sum subsidy and exemption from the taxes to be paid. The quantum of incentive is decided by the degree of backwardness of the location. That means more backward the location, more benefits given to you, so that you get attracted and go and set up the factory there. Now what government of India has done, they have identified certain districts in every state like this, where there are no jobs, high poverty, and people leave that district and go to other places a lot. Not every district will have this problem. Some districts are economically backward. Therefore, what government does, they say you set up factory there, 10 years, no need to pay GST. 5 years, no need to pay this tax. You want loan, we get it at low rate of interest. All benefits, so that people go there. Companies go there. Now, a lot of northeastern states get this benefit. A lot of SEZs, they get this benefit. If you open your factory in a particular district, then government says market value of land, you get 30% discount. Otherwise, you have to buy in bigger city, bigger developing area, land rate is also very high. This is an underdeveloped district. Please start your factory there so that you can give jobs, so the local economy slightly improves. That is the basic purpose. Read this. The special capital incentive in form of lump sum subsidy is a quantum sanctioned by implementing agency as a percentage of fixed capital investment subject to an overall ceiling. So they say if you are making an investment, company is making an investment of say 80 crore to set up the factory, government says we will help you with 20% funding. Balance you have to invest. Now why government is doing it? So that you can go and set up the factory. Say you have a factory or an outlet in certain areas. Once you study GST law, you will get to know this. Some places, if you have a business, your tax rules are different. Some states, if you have some permission limits, are different. Some of you may know this. There is something called EOU, export oriented undertakings, economic zone, special SEZ, at least you have come across. Now, if I set up my factory in SEZ, there are a lot of tax benefits that I get. Read first line only, you'll understand. The backward area development incentive available often determine the location of the new industrial unit. These incentives usually consist of lump sum subsidy and exemption from the taxes to be paid. The quantum of incentive is decided by the degree of backwardness of the location. That means more backward the location, more benefits given to you, so that you get attracted and go and set up the factory there. Now what government of India has done, they have identified certain districts in every state like this, where there are no jobs, high poverty, and people leave that district and go to other places a lot. Not every district will have this problem. Some districts are economically backward. Therefore, what government does, they say you set up factory there, 10 years, no need to pay GST. 5 years, no need to pay this tax. You want loan, we get it at low rate of interest. All benefits so that people go there. Companies go there. Now, a lot of northeastern states get this benefit. A lot of SEZs, they get this benefit. If you open your factory in a particular district, then government says market value of land, you get 30% discount. Otherwise, you have to buy in bigger city, bigger developing area, land rate is also very high. This is an underdeveloped district. Please start your factory there so that you can give jobs, so the local economy slightly improves. That is the basic purpose. Read this. The special capital incentive in form of lump sum subsidy is a quantum sanctioned by implementing agency as a percentage of fixed capital investment subject to an overall ceiling. So they say if you are making an investment, company is making an investment of say 80 crore to set up the factory, government says we will help you with 20% funding. Balance you have to invest. Now why government is doing it? So that you can go and set up the factory. Same factory in a developing district, I have to put full my money, but if I go to this underdeveloped district, I get this subsidy from the government. You can download the list of these districts, and lot of companies have taken the benefit of this. They go exclusively there only to get the tax benefit. This is not like Mauritius route that I told. This is not illegally doing. Government, they themselves allow you to do. Go, but there are some conditions in some state that you should give job only to the person born in that state, or he should have that as his language of school. At least that is a way to determine whether he belongs to that particular state or not. I don't know whether they have changed it or not. 1.5 years back, Haryana introduced this law that 50% of the job should be given to those who are born, or at least their parents should be born in Haryana. But I think they Karnataka introduced and then later took back and said we will relook into it, and after that they did not do anything because it has the other side also story. A lot of companies will not like this. They say no, your state is good, but we don't get good talent. State is good, but we don't want to restrict hiring only for that state's graduates. We want to hire people from outside also. Bit of politics also involved in this. So this is a never-ending story in India. But states can do. If they can't do this job kind of reservation, but at least they can put these restrictions that you should not shift back to another state in 10 years, 20 years, and so on. I remember one of my clients, he opened one small unit in UP in a particular district, in a particular product. They had much more ceiling limit. It should be in that district, it should be that product only. And what they said, first 5 years in your GST, you have CGST and SGST, the state one. They said 5 years state GST exempt to you. Central you pay, state part we will exempt it. So therefore, for those who do not know, if that client buys something and 100 is the base bill, 9 rupee plus 9 rupee, 18% GST, in that 9 is central and this is state. They said 118 is the cost to you. You pay 118 and buy. But this 9 whatever you have paid, government will give it back to you. Only state government, they said, central did not say that, but then you still save 9 rupee money. Correct? So any cost to others is 118. To this company in that particular district was only 109 because you only had to pay CGST. So this states are free to do. Correct? Easy to track. You file your monthly returns, in that whatever is the SGST amount, you tell us, we will refund. Easiest way to calculate. Every bill has bifurcation. Only when it is IGST, interstate, then you will not have 9 and 9, it will be 18. So that they said that we can't help. But whatever is with both, any SGST you pay, my state will reimburse it to you. If you pay 2000 rupee SGST, month end, you submit that return to us, we will transfer that money back to your bank account. So specific state, specific districts, some places specific product, if you do, you get these financial benefits. I think these things we discussed already. Deep discount, secured premium, zero interest, option, inflation bonds. I told you that your interest keeps changing as the inflation rate keeps changing. Floating rate we discussed. Uh, what is high yield bonds? What is a nice name inside the bracket? Junk. What is junk bond? What is junk? Anything what is junk? Attractive but not good. Correct? Now you know what this is. Read. Junk bond is a bond that is rated below investment grade. Yesterday, I was explaining this to you. NHA has highest credit rating. Okay, from that lowest there is a list: AAA plus, AA plus, A plus, and so on. What is the meaning of junk? The lowest one. That means no one should ever buy this bond. But sir, they said high yielding. Correct. They will offer you unbelievable interest. But you know it is junk because it is high risky. No guarantee even your principal will come back to you. Understanding? Easy to remember also. Read. It has low credit rating and high risk of default. What is risk of default? Forget interest, even principal won't come back. Because of the high risk, investors are compensated with high interest also, which is why junk bonds are also called as high yield bonds. But you should never buy. If you see credit rating list, you will understand last name itself is junk. Credit rating. Can you see this? Yeah. Look at this. Don't worry about agencies. Moody's, S&P, these are all rating agencies. If you see AAA, AA, AA, and so on, high grade, upper, high, and see the junk starts here, red one. Can you see this? That means you should never buy any bond whose rating is like this. And you know NHA has AAA. AAA is the top out of all, and junk is one full category. If you buy bond, and by the way, at the time of issue of bond certificate, you can go to their website and download their credit rating. If you see anything below this BB plus, BB, and so on, then you know what type of bond you're buying. Yeah. Sorry. International financing, we discussed most of this already. International capital market, we discussed euro currency, bonds, external commercial borrowings, euro bond, foreign bond, hedged bond. Medium term note, again, this is for frequent need, and time period is neither too long nor too short. Euro commercial paper, I think most of these things I have discussed. Equity warrant we discussed. Warrant is that detachable instrument. Again, euro means all international. Yeah, this part is a newly added thing in new syllabus. Okay, if you have textbook with you, mark it important. Environmental, social, and government linked bonds, ESG. Okay, now these bonds are issued by those companies who invest in the projects which are good for environment and society. That means all this solar, electric, and these kind of things where you don't create negative impact to the overall environment. There is something called green bond. The other day I was discussing with you, like sovereign gold bond, they issued sovereign green bond, SGRB. If you want, check on internet about it. And where will that money go? Only for environmentally good projects. Now, green bonds, just now I discussed. Where will they use this money? Read. These are the most populous ESG bonds that are issued by financial, non-financial public institutions, where the bond proceeds are used only to fund green projects. That means they will mainly use it for solar. Easy to understand is solar, so I'll take that as an example. Green projects are aimed at positive environmental or climate impact, including cultivation of eco-friendly technology. For example, Ghaziabad Municipal Corporation becomes the first municipal corporation to raise 150 crore from green bond in the year 2021. You will get interest just like any other bond, but you know that this money is not going for anything other than environmentally good projects. Yeah, they can't use it for coal mining, by the way. The whole purpose is not to go against environment. Second one is social bond. This is still theoretical in India as of now. Read, these bonds finance socially impactful projects. The projects here are related to social concerns such as human rights, equality, animal welfare, etc. For example, vaccine bonds are social bonds issued to fund the vaccination of vulnerable children and protection of people in lower income countries. Now, again, investing in this is more like a donation also. If you have understood the theory reading, you'll get to know what can I expect in return from these bonds. But they will give you some interest. Again, who will give them that money? They will have to depend on government. Instead of government giving vaccine free, one company says we will give vaccine free. For that, where is the money? We'll collect money from public. Then to public, who will return? Finally, government has to return. But government won't return directly. They will give it to the company. Company will return it. So basically, what government should have done directly, if they cannot do, a company can do so. Third one, sustainability linked bonds. These bonds are combination of green and social bond. That means you should do what is good to society and also environment. Proceeds of these bonds are not meant for specific project but for general corporate purpose to achieve some goals. Example, what Ultratech Cement has done, they have raised 400 million US dollars. What for? They want to reduce underlying carbon emission through the life of bond over 10 years. So what they have promised people, that whatever money comes from this, I will change my factory settings in such a manner that in next 10 years the amount of carbon that we emit will gradually come down, because it's one of the biggest cement companies in the country. That means they will have the biggest factory also. Bigger the factory, higher the carbon emission. They want to cut it down, but for that you need to change your production style. You have to install a lot of additional equipments. For that they needed money. They took money from general public. So what is their goal? In 10 years they should, it can't be zero, but they should at least reduce the level of carbon emission that they have been doing. Yes, euro issue by Indian company. I think we covered all this. American Depository, Global Depository, and also Indian Deposit. Okay. Again, another small new thing added in the syllabus. I think you guys know this better than me. Explain what is crowdfunding. I want to watch a movie tonight. I don't have money. If I collect 10 rupees from all of you, is that crowdfunding? Simple. Therefore, isn't it more like equity shares than general public investing in a company? What is the difference? In shares also what happens? My company will ask you people to invest. In crowdfunding also, I am asking all of you to invest. Then what is the difference? Why is it called new variety? Correct. You do not have, as of now, a very strict legal framework for this. You will not get those voting rights. All that company law section says is not applicable to you. And by the way, in crowdfunding, any stranger can invest in anybody's company. There are websites where people can put their ideas, and anybody in the world can read your idea. If they're convinced, they will invest money. One way Zepto got money was through crowdfunding itself. Okay, I think there was a movie couple of years back where producer did not have money and people funded that. Yeah, I don't remember the movie name, but I know that one of the crowdfunding thing happened in Kannada movie. By the way, they got crowdfunding. They created one website and they asked everyone, we have a fantastic story, movie, everything is ready, but we don't have enough money, and people gave money, and whatever profit they made, they returned the money with some profits, more like shares itself. But then you do not have a very structured legal framework. There is no crowdfunding act 2025. We do not know what exactly is the way. Anybody, and there are hundreds of websites, by the way. If you have a good business idea, you don't know where to go and pitch, you write that idea in that website, restricted words, 200 300 words. In that you have to put your business idea. Anybody across the world, they can read it. If they are convinced, they will write an email to you. They may invest in your business. Yes. See this second para. In the crowdfunding process, three parties are involved: fundraiser, the one who wants money; second, mediator, that website where you are writing your pitch idea; fund investor, that third party. The platform, I told you, either website or an organization, a group of people. A platform may also charge certain fee for doing this, because I am giving you a platform. You are a stranger, there was another stranger, both of you came on my website, I created that website, I should get some cut in the amount, maybe some percentage or some fees. There are a lot of websites available for this. Equity crowdfunding, again, you take money but allot them shares. Not very easy. Indians don't trust some random guy who gives a business idea. That way in India everybody has a business idea, correct? Therefore crowdfunding is much of theory as of now in Indian context, but in some of the other countries, especially Western countries, this has become quite popular now. People invest in stranger company, but Indians don't invest in unknown company. People don't trust companies like Infosys, Reliance. Then I have doubt how will anybody trust a random stranger guy. It's not easy. With money in India, convincing people is not that easy. That too on a website, if you tell them there is a website you can invest money, they think it's a dangerous scheme. Yeah. Peer-to-peer lending. Here, understand, this is a good concept, quite popular in India also. I know some groups in Bangalore itself who do this peer-to-peer lending. 25 startup owners create one group. Okay, peer-to-peer. I am also running a business. She is also running. He is also running. But we are not competitors. We are all running different variety business. I am into tech. She is into food processing. He is into textile. But all of us are new businessmen. What happens? In a year, 3-4 months, I have shortage of cash. That is when she has excess sales. And some other month she will have shortage of cash. I have good peak season. Therefore, we rotate money among ourselves. Whenever somebody has a shortage, they take from somebody. When I have excess, I give it to somebody. That's why name itself is peer to peer. All of them are businessmen. Somebody is running a business which has peak season in Feb, March and April. They have too much of sales and too much of cash collection. Same month, some other person is in need of cash. So they move money here. All officially, nothing unaccounted. They create one common trust. Through that, they move the money. And they trust each other also. I should not run away after taking somebody's money. Why it is called peer-to-peer? Because it's not investor and company. All are companies. They help each other because no one is helping them. So they help each other. I am a new businessman. I understand the problem that another new businessman is facing. So it becomes easy to help each other. Understand, big businesses won't understand the problem of small businesses. Therefore, this group also should be of all small people. Read in bracket they have given in third line. The fund raised are paid back by the borrower with interest. Though this kind of lending involves some level of risk, just as bank bear the risk in conventional style, even there it is a risk. What if I take money from her and then I don't come to that group meeting? It leave WhatsApp group also, run away with the money. This is still a risk. But then if you need money, you should be ready to help somebody. There is that risk involved. If all of us are in good terms, then this can be a successful model. Startup funding. I think I've explained this to you already. Banks won't trust startup companies so easily because they can't give security. They don't have past business experience. There is no balance sheet P&L. New idea can fail also. Young people, so they never have experience of even working in some place. How will banks trust? So getting money for startups is difficult. Again, there are platforms, either websites or clubs, where you can become a member and you get a chance to present your business idea. There are a lot of these startup events that keep happening where both side people will come, investors and people who want to pitch the idea, hackathons and these things. Government conducts it. If not government, then some private organizations also do. In Bangalore, at least one event like this keeps happening every month. Okay, if you have a business idea, something in food industry, then you have to go to that company, that website, search on Google which are the food startup investors and find out where they meet and give your presentation. If they like, then they will invite you for the detailed discussion, and then agreement, sign paperwork, and all of that will happen. Similar to Shark Tank episode without camera and mic. Donation based crowdfunding. They have given 3 4 website names. You can also search GoFundMe. Keto, I think some of you know this. More for medical treatment and other things. Fuel a dream. Again, something that will create a positive social impact. If you want money, I'm not saying these will not be successful in India. What I'm saying is people don't trust a stranger, that too on a website in India, that easy. Okay, that too nowadays, whenever you call, you are starting getting that message also from government. Don't trust some random this and that and so. That means if you say click this link, you can donate. People won't even click that link. Forget going to website and then deciding not. People have become serious not to click some random website links. So these are still in the initial stages. Someday maybe these things will pick. So all the summary is given here. You can just go through this MCQ section, and these questions are again same things that are there in the, see, this answers are all given like this, refer to that para, this para, which means it's all part of the same textbook. So these were those additional things newly added in the study material, especially this ESG, startup, crowdfunding. Uh, these green bonds is that part of ESG. These things you just go through extra, other than whatever small bits and piece extra thing we had, I have anyway completed. Yes, with this we are done with this full chapter.